Good morning, friends. Good morning, friends, and welcome to all of you to Bank of Baroda's annual banking conference. This is our first edition of this conference, and we'll be having this on an ongoing basis. Fine. Yeah. Every year. The theme for this particular conference is Banking Beyond Tomorrow. So all of us keep talking of banking, about what happened in the past, what's happening right now. I think that's what we are normally obsessed with. So we thought we'll have a change in theme and really see that, okay, we have done quite well in the past. Whatever problems were there were largely being addressed. So now we're talking of the future as to what kind of shape can we expect from the banking system. And I think the best way to go about it is to get the regulator, Mr. Shaktikanta Das, Governor of RBI here. And we are actually honored to have you here, sir. And we'd like to thank you profusely for accepting our invitation to be our chief guest for today and to set the proceedings. I would like to welcome Governor, Mr. Shaktikanta Das, onto the stage, as well as Mr. Sanjeev Chadha, our MD and CEO. As we all know, Mr. Shaktikanta Das took over as governor of RBI in 2018, and he's had the privilege of working in the ministry as well as the Reserve Bank of India. And for we economists, we always keep saying that the fiscal arm should always be talking to the monetary arm. And I think the best way to do it, as we have seen in the last 4 years or so, is that there's been a lot of harmony in terms of functioning of monetary policy with fiscal policy. And I think the experience which the governor brings along with him, having worked in the Ministry of Finance, Department of Revenue, Department of Economic Affairs, and more importantly, handled the formulation of the budget. Because every time we are obsessed with the fiscal deficit, the borrowing program of the government, and I think who knows this best? I think that's Mr. Shaktikanta Das, who has a knowledge about how the budgets are formulated, how monetary policy is formulated. As you all know that during the COVID times, I think the RBI has done an exemplary job in making sure that things were stable, and there was a very good flow of funds to the system to ensure that to the extent that the Reserve Bank of India as a central bank could assist the entire proceedings. I think that was done in a very non-obtrusive manner. And I think that's there for all us to see, that when we say that the economy has gotten out from the slump, I think a lot of this has got to do with what the RBI has done. So now let's formally welcome Governor Shaktikanta Das with a bouquet of flowers, which I would request our MD, Mr. Sanjeev Chadha, to present. We shall formally start the proceedings. So we'll be lighting the lamp. So I would request Governor Mr. Shaktikanta Das, Mr. Sanjeev Chadha, and I would also invite our executive directors, Mr. Ajay Khurana, Mr. Joydeep Datta, Mr. Dev Datta Chand, Mr. Vikramaditya Khichi, to please come up as we begin our function with the lighting of the lamp. Great moment for all of us in Bank of Baroda. This is the first annual banking conference that we're hosting. Privileged to have Governor honor our function. Before I welcome our MD, Mr. Sanjeev Chadha, to make the welcome address, I think I need to inform you, Governor, that both Sanjeev and I, we are also Stephanians, and we take a lot of pride in the fact that you also postgraduated from St. Stephen's College, Delhi University. So as a Stephanian, we feel very proud of it. Probably not to be said in a Bank of Baroda function, but yes, I shall take this liberty, having the honor of having this mic in front of me. Sanjeev, it's all yours.
Governor Mr. Shaktikanta Das, esteemed guests, ladies and gentlemen. It's my pleasure and privilege to welcome you all at Bank of Baroda's annual banking conference. As we gingerly step into the post-COVID era, it's a world where, on the one hand, past templates look hopelessly out of date, but it is also a world where possibly, for the first time in many years, our attention and focus is not solely on fashioning a response to an overwhelming crisis. We have the opportunity to shut out the cacophony of the here and now that often diminishes the space for a longer-term perspective and steer the discussion away from the burning issues of the day towards identifying the contours of banking beyond tomorrow. It is this longer-term perspective that we hope shall define discussions today as well as in subsequent editions. The other perspective that has informed the design of the conference is that banking beyond tomorrow would not be about bankers. The one thing that we have learned over the last few years is that banks need not and cannot do everything themselves. Banks, on the other hand, need to extend their focus beyond traditional key stakeholders to include partners who are now no longer associated with only the peripheral areas of banking, but who are increasingly embedded in what we might consider core banking areas: underwriting, risk management, compliance, regulatory reporting, almost everything. The success of a bank, therefore, may no longer depend on its own core competency, but more on its ability to work with partners. And to work with partners, you need to listen to these partners. The conference is therefore all about an outside-in perspective, a discussion of how leaders of fintechs, private equity funds, NBFCs see their own businesses and how are they evolving their businesses, and how the secondary impact of these business plans and perspectives may in aggregation define the future of banks in a primary manner. Overseeing this landscape is of course the central bank, which will finally determine both the direction of travel and the nature of engagement between banks and the broader ecosystem. Under leadership of Governor Das, we have already seen the RBI demonstrate clarity on both counts. We are on the one hand seeing a long-term perspective that emphasizes evolution and non-disruptive change in regulation, recent announcements vis-a-vis the role of NBFCs and fintechs, particularly in areas that verged on banking activities being cases in point. There has been an equal commitment to foster innovation and the enrichment of the ecosystem through promoting and preserving the presence of a variety of players. It is therefore a particular privilege to begin proceedings with an inaugural address from Governor Shaktikant Das, who will set the tone not only for today, but also the agenda for subsequent editions of the conference. Governor Das, it's my privilege to welcome you.
इसको पीछे कर लो। Mr. Sanjeev Chadha, MD, CEO, Bank of Baroda, Executive Directors and other senior executives and all other officers from Bank of Baroda, distinguished bankers, many senior bankers who are present here, past and present, ladies and gentlemen, members from the media. I'm extremely delighted to be here among such a distinguished gathering at the Bank of Baroda Banking Conference. I wish to compliment Mr. Chadha and his colleagues for organizing this event in the physical mode and having chosen a theme which is so relevant today, that is banking beyond tomorrow. So we are not just looking at tomorrow, but we are looking at beyond tomorrow. It's a futuristic plan and banks need to move in tune with the requirements of changing times that we are living in. Given that the banking landscape is witnessing far-reaching changes in the backdrop of rapid innovation, disruption, and evolution of new business models, I believe the theme of today's conference merits very active discussion, and I once again compliment Bank of Baroda for having selected this topic for as the theme of this conference. In my address today, I propose to touch upon the current macroeconomic situation, followed by highlighting the special role played by the banks and the new trends emerging in the banking sector. I shall also attempt to highlight what banking beyond tomorrow may look like and the opportunities and the challenges that it may bring along. Let me first talk about the macroeconomic situation. I would like to focus specifically on where we stand today. We are living in very turbulent times. The continuing war in Europe and the COVID-19 pandemic have rendered the global macroeconomic outlook highly uncertain. Countries are facing unexpectedly high inflation, including food inflation, supply chain disruptions, and demand-supply imbalances in both product and labor markets. Central banks are tightening monetary policy at a very rapid pace, raising fears of imminent recession. Commodity prices have eased somewhat in June, but they remain elevated. Higher interest rates in the United States, along with increased risk aversion among global investors, have fueled safe haven demand and strengthening of the US dollar. Currencies of emerging market economies and even currencies of some advanced economies are depreciating vis-a-vis the US dollar. Consequently, inflationary pressures are building up and external funding conditions are becoming tighter, posing financial stability challenges in emerging markets in particular. Overall, the global situation remains grim amidst fluid geopolitical situation, while the war and the pandemic add to the forces of disintegration and fragmentation of the global economy. In such an environment, the Indian economy remains relatively better placed, drawing strength from its macroeconomic fundamentals. The financial system is well capitalized, asset quality indicators have improved, balance sheets are stronger, and banks have returned to profitability. We are also seeing healthy pickup in credit demand. The external sector is well buffered to withstand the ongoing terms of trade shocks and the portfolio outflows. The recently released Financial Stability Report of the Reserve Bank highlights that the Indian financial system remains resilient and supportive of the ongoing economic revival. It also shows that banks are well positioned to withstand even severe stress scenarios without falling below the minimum capital requirement. The Reserve Bank continues to remain watchful of the headwinds and shall be proactive in taking measures as may be necessary from time to time to ensure financial stability. Recent developments in the forex market have generated intense debate, including predictions of rupee dropping to record lows as foreign portfolio funds exit India. I would like to address the issue in a balanced and factual manner, and I have attempted to be as objective as possible. First, it is important to recognize that spillovers from the global monetary policy tightening, the geopolitical situation, the still elevated commodity prices, especially prices of crude, and the lingering effects of the pandemic all coming together have become overwhelming for countries world over. Even reserve currencies such as the Japanese yen, the euro, and the British pound sterling have not been spared. Portfolio funds are selling off assets and fleeing to safe haven. Emerging market economies are particularly affected by capital outflows, currency depreciations, and reserve drawdowns, complicating macroeconomic management in these countries. Second, the impact of these overwhelming spillovers on India has been relatively modest. In fact, the Indian rupee is holding up well relative to both advanced and EME peers. This is because our underlying fundamentals are strong, resilient, and intact. The recovery is gradually strengthening. The current account deficit is modest. Inflation is stabilizing. The financial sector is well capitalized and sound. The external debt to GDP ratio is declining. The foreign exchange reserves are adequate. Third, in recognition of the fact that there is a genuine shortfall of supply of forex in the market relative to the demand because of import and debt servicing requirements and portfolio outflows, the Reserve Bank has been supplying US dollars to the market to ensure that there is adequate forex liquidity. After all, this is the very purpose for which we had accumulated reserves when capital flows were strong. And may I add that you buy an umbrella to use it when it rains. Fourth, a predominant part of the outstanding ECBs is effectively hedged. Let me elaborate. According to the June 2022, the last month's financial stability report of the Reserve Bank, the outstanding ECBs of the outstanding ECBs of 180 billion US dollars, 44% or 79 billion US dollars is unhedged. Now this includes about 40 billion dollars liabilities of public sector companies, mainly in the petroleum, railways and power sectors, which have assets with a natural hedge character. Besides, being public sector entities, their foreign exchange risk, if any, can be absorbed by the government if so required, but that possibility is highly unlikely. The remaining US $39 billion ECB represents 22% of total ECB's outstanding. Even this includes borrowings of those companies which have a natural hedge, that is earnings in foreign currencies. This would leave a small portion of the total outstanding ECB that are truly unhedged. So it is necessary to look, the so-called unhedged forex reserves in its proper context, rather than get carried away or get alarmed by what is revealed on the surface. We need to look at it deeper, we need to dissect it and look it in a manner that is objective and fair and true to facts. So that's why I am saying that the truly unhedged portion of our so-called unhedged ECB outstandings are far too lower than the $79 billion, about which I think there has been some conversation in the recent days and weeks. Now, corporate entities eventually face a trade-off. If they hedge their foreign exposure completely, the cost of borrowing goes up and the advantage of cheaper borrowing in foreign currencies is lost. On the other hand, to the extent they do not hedge, debt servicing can go up when the exchange rate is under pressure. This has led to the concept of optimal hedge ratio, which calculates the proportion of hedging that minimizes the variance of portfolio. For India, our internal research, that is the internal research of the Reserve Bank research team, estimates the optimal hedging ratio at 63%. In fact, this was one of the bulletin research articles which was published sometime perhaps last year. Now, taking into account natural hedges and the exposure of public sector companies, the optimal hedge ratio condition of India at the moment is comfortably satisfied in the case of the stock of ECBs, in which, ECBs in India's external debt. Due to the RBI's actions, including measures to encourage inflows, the movements of the rupee have been relatively smooth and orderly. By eschewing sudden and volatile shifts, we have ensured that expectations remain anchored and forex market functions in a stable and liquid manner. We will continue to engage with the forex market and ensure that the rupee finds its level in line with its fundamentals. I would like to reiterate that we have no particular level of the rupee in mind, but we would like to ensure its orderly evolution, and we have zero tolerance for volatile and bumpy movements. I would now like to focus and turn towards banking. Banks are special and not like any other commercial entity. They are not just custodians of shareholders' interest, but more fundamentally the trust of the depositors. Depositors are at the very core of the entire banking system. Protection of depositors' interest is paramount to a robust, reliable, and stable financial system in the country. It is important for banks to always remember that the funds they deploy belong to the depositors, and this should reflect in proper risk management, governance, and internal control systems. Some of these points were touched upon very briefly by Mr. Sanjeev Chadha in his welcome remarks. Banks are also expected to be permanent institutions after they obtain a license from the regulator. They are governed by sound regulatory and supervisory practices. The bigger responsibility, however, lies with the banks themselves to ensure robust governance and risk management, which are integral to the functioning of a bank. Going beyond regulatory prescriptions in terms of capital, liquidity, and provisioning norms, and even exceeding them, would be a sign of good governance and robust risk management. This will future-proof the banks and enable them to fall back on their own balance sheet during situations of stress. It needs to be emphasized that while shareholders' interest is important in the business of banking, even more important is the interest of depositors. Shareholders of banks should focus on long-term profitability and long-term market valuation. This should lead investors to look at a banking entity for the value it would generate over the medium to long term. This approach will usher in a new paradigm of banking and will stand in good state for our economy. I would now like to focus on, the main theme that is preparing the banks for tomorrow, that is banking beyond tomorrow. The banking sector is going through a period of churning. The future of banking would witness a major shift in customers' choices and preferences with enhanced expectations from the banking industry. Each of the developments would present unique opportunities and challenges to the existing and newer players. It has to be borne in mind that sometimes the disruptions can be so sudden that it is impossible to anticipate them. To me, however, it seems reasonable that banking beyond tomorrow would revolve around, number one, the adoption of emerging technologies, customization of products and services, enhanced business and process automation, and number two, development of suitable business models with strong governance frameworks, better information management, changes in the mode of working, building of enhanced resilience capabilities, and more responsible societal and environmental role for the banks. Let me dwell upon the above in some more detail. The Indian banking system has undergone significant changes. The increased adoption of technology by traditional banks through self-upgradation or collaboration with fintechs is resonating with the idea of new age banking. This is leading to innovative products and services and newer business models. In this context, it is often cited that banks will face competition from fintechs, which are already making their presence felt within the financial services space. Today's customers, especially the retail customers, expect banks to provide them quick, reliable, and personalized services. Therefore, to stay relevant, banks would need to embrace newer and tested technologies for effective and timely business decision making, understanding the needs of their customers, and delivering personalized services to them. Banking beyond tomorrow would necessitate significant investment in technology and organizational capability. Globally, banking is becoming more open, facilitated by availability of newer technologies and application programming interfaces, that is APIs, that allow interoperability among banks as also fintechs. This development presents unique opportunities for collaboration among various participants for faster and improved delivery of products and services suited to the customers. Unlike other developed countries, India has embraced a hybrid model where both the regulator and the market have collaborated for the development of open banking. UPI marked a watershed in the commencement of open banking in India. The success of UPI, implementation of the account aggregator framework, and the mass adoption of digital banking services, with all these, India is witnessing an emergence of new business models. More and more banks are opening up for collaboration with new age service providers for facilitating customers to make better use of their data and avail a wider and richer set of services. Now, given the digitization wave in banking world over, and with the new tech-savvy customers that we have and whose numbers are growing from day to day, banks must also strike a fine balance between digital and paper-based forms of communication. While the apps and websites of banks have grown in leaps and bounds over the years, there is still substantial scope for facilitating easy navigation for customers. Simplifying disclosures and access to information, and innovative deployment of tools such as chatbots to help customers navigate through the websites and mobile applications will greatly enhance the banking experience. Financial inclusion has been pursued vigorously with steady improvements as reflected in the Financial Inclusion Index introduced by the Reserve Bank of India. In fact, we released the latest Financial Inclusion Index, and it shows substantial improvement over what we had in 2019. And 2019 itself was a substantial improvement over the previous period. Receiving digital payments such as wage payments, government cash transfers, and domestic remittances are catalyzing the financial inclusion drive. With digital technologies, while digital technologies are also offering a powerful way to overcome barriers to access banking and financial services, we also need to be sensitive to the requirements of our people to avoid any kind of digital divide. The presence of human touch in traditional branch banking would still be relevant for customers in many respects and in many areas. There is also a need for providing timely and seamless credit to agriculture and MSME sectors as a part of the focus on financial inclusion. Social media is an alternative platform for reaching millions of customers. Indians on an average spend around 2.4 hours daily on social media. Further, the number of social media users has been growing very steadily. The analysis of social media use has the potential to help banks in reviewing their strategies in terms of customer segmentation, customer acquisition, and furthering financial inclusion. Social media can also be used in customer grievance redress management. With advancement in digital banking, cybersecurity will remain an important challenge for all stakeholders. The increasing use of IT systems by banks, remote working arrangements, accelerated adoption of digital banking services by customers, along with increased dependence on third parties for various services, would warrant enhanced resilience capabilities to ensure business continuity. This would include building strong defenses against cyber attacks and malicious attempts at disrupting, disabling, or destroying a computing infrastructure, or stealing confidential information and data. Banks would need to undertake constant upskilling of personnel in this regard. Continuous knowledge acquisition and staying ahead of the curve would become even more crucial in the days to come. Climate-related risks will be the focus area in times to come. Such risks will impact the business models of banks. The increased requirements of funding businesses and industry for tackling climate change would be greatly influenced by the global move on climate-related risk management. Various stakeholders already consider environmental, social, and governance, that is ESG, as an important aspect while making investment decisions. banks are also increasingly aligning their businesses, including assessment of financing assets, with the global climate sustainability agenda. The need for banks would be to develop appropriate business strategies and strengthen the governance framework to gauge the associated risks. In line with international best practices, a forward-looking, comprehensive and strategic approach would be required to address the climate-related risks. Let me now try and conclude. Going ahead, the world of banking is expected to be more collaborative as well as competitive, with newer players offering innovative financial products. Banks need to prepare themselves for facing the dynamic environment while keeping their focus on appropriate business models, sustainability, stability, and customer centrality. More importantly, good governance remains fundamental to success and should not be compromised at any time. Due care needs to be taken to protect the stakeholders from digital frauds, data breaches, and cyber crimes. At the end of the day, banking is a service, and enhanced customer protection and experience should be given primacy it deserves. From the regulator's perspective, the Reserve Bank is fully committed to build an enabling environment for accommodating the new disruptive innovations in a sustainable manner while preserving financial stability. History suggests that when technology, market participants, and regulators join hands, revolutionary innovations and growth would follow. I hope our banks of tomorrow will make it come true, and that is precisely the essence of, that is precisely what would constitute the essence of banking beyond tomorrow. Thank you very much.
Thanks a lot, Governor, for your address. I think it covers all the subjects which we're going to discuss during the course of the day. And I think you've set the tone for it. You've actually brought up all the issues that need to be discussed. And that's going to be very enriching for all of us. We're now going to have a fireside chat with Governor, and our MD, Mr. Sanjeev Chadha, will be conducting it. So it's over to you.
Thank you very much, Governor, once again for that tour de force. We are really reassured about the fact that in terms of the external sector, despite what's happening in the neighboring countries, India is in a different and a very strong place. Also, I think the areas you covered in terms of what banks need to focus on, I'm sure that will define the agenda for not only this conference, but also for next few years. A few questions, Governor, first on the monetary environment, and then a few other areas that you also touched upon. So first again, it seems to be the case that we may be moving now from an era of great moderation to a time of great uncertainty, or even perhaps great volatility. Volatility in terms of commodity prices, supply chains, supply shocks, inflation and interest rates. Inflation targeting has worked very well in the time of great moderation. However, the question is it an appropriate framework during great volatility, or central banks need to have the advantage of a little more flexible framework?
I think the current framework that we have with regard to inflation targeting has worked very well over the years. We positioned this inflation targeting framework in our country in 2016, and the average inflation, CPI inflation, till the onset of the COVID-19 pandemic in February of 2020, till that period, from 2016 to the onset of the pandemic, the average CPI, the headline inflation, if I remember correctly, was 3.9%. Now thereafter, we had the huge shock coming from COVID, and because we have flexibility inbuilt into the target, 4% plus minus 2, so the MPC, as you are aware, decided to use that flexibility, to use that space to tolerate a slightly higher inflation that is higher than 4%. And that it is that flexibility which is built into the inflation targeting framework that allowed the MPC to, allowed the MPC and the Reserve Bank of India to reduce policy rates, to inject huge amount of liquidity, and several other measures which were taken by the Reserve Bank to fight the onslaught or the impact that the COVID was producing, not only on the financial sector, but also on the real economy. So the entire framework has worked quite well, and inflation targeting is something which is important at all times. And ultimately, as it is said and as it is well known, the common person, he suffers the most if there is high inflation. And inflation and, without any price stability framework may lead to other kind of consequences which will undermine the, the financial stability of the country. Going forward, unless the central bank is mandated to control inflation and maintain price stability, unless the central bank as a follow-up to this mandate takes steps to adjust the policy rate accordingly from time to time, the negative interest rates will increase. It will act as a big disincentive to savers. It will be a big disincentive for financial savings, and less of financial savings will obviously have an impact on the investment outlook or the entire investment climate of any country. Now, there are other consequences also. So I feel that because we have gone through this kind of crisis, the COVID, and now the the war in Europe, which has again produced a lot of consequences in the real sector, in the real market, in the real economy. I think having an inflation target and trying to achieve that ensures that the aspect of financial stability, not only in India, but world over, is maintained. And that is the key to maintaining financial stability. And so far as India is concerned, the framework has worked well before the pandemic, during the pandemic, and even now. I would say that we are very much in line with the requirements of time in terms of the steps that need to be taken. So therefore, I feel that it is the framework has worked well and needs to continue. And my personal opinion, and also I think this is the opinion of all of us in the Reserve Bank, is that let's not shift the goalpost to just suit our convenience, because the larger requirement of the economy and the financial sector is to have such a framework.
Thank you, Governor. Just a connected question. While almost all central banks have moved to tighten policy, almost in a coordinated manner, they are in very different situations. For the ECB, it seems to be all bad choices: either control inflation or confront a potential sovereign debt crisis, while the Fed seems to be better placed, with the underlying dynamism of the US economy likely to remain intact even if it were to engineer a recession. How would you rate India in this context? Could rate hikes threaten an incipient recovery, or is growth momentum likely to continue to gather pace, despite what is the normalization of interest rates possibly?
You see, as the MPC has, as the MPC statement, the minutes of the MPC resolution, as it has been clearly stating, and as I have also mentioned it earlier and in my statements, our decisions on rate hikes or decisions relating to liquidity, they always take into consideration the aspect of growth. Now, the mandate says, that is the law says, the mandate says that RBI is responsible to maintain price stability, keeping in mind the objective of growth. So the objective of growth has to be kept in mind at all times. We have now changed the sequence, meaning in sequence of priorities, currently our focus is on inflation followed by growth. So any decision that we take with regard to liquidity, with regard to the policy rates, always takes into consideration the kind of impact it is going to produce on the growth and the revival of economic activity. What you call the high frequency indicators in the first 3 months of this year and even in July, so far as India is concerned, they're looking very positive. And in fact, whether you look at GST collections or you look at e-way bills, there was a slight dip in between, but they have improved. The, aggregate demand has also improved. Urban demand is fairly strong. The rural demand is showing now signs of picking up. The demand for, Mahatma Gandhi Narega, the demand for work under Mahatma Gandhi Narega has also moderated. So there are several signs of high frequency indicators, or for that matter, the sale of passenger vehicles, the sale of tractors. I think all of this is showing they are showing positive development. So our approach is to deal with the problem of inflation squarely, but keeping in mind the objective of growth. And ultimately, we cannot, as I have said earlier, that our target is and will continue to ensure that we have a soft landing for our economy. We had reached a kind of soft landing till the war broke out, the war in Europe. Then the war has created new challenges. And now there are new complexity of challenges, there are new issues, new problems which have come up, which are not under our control, commodity prices, crude prices, and the impact they are having on us, monetary policy tightening, their spillover, capital outflows, currency depreciation. We are dealing with all these issues, and our target is, and we are confident, and our endeavor shall be to ensure a soft landing for our economy, where inflation is brought down closer to the target of 4% over a period of time. At the same time, the growth sacrifice is not unduly, the growth sacrifice is also within manageable limits.
Thank you, Governor. Soft landing, of course, means that it's how monetary policy plays out over a period of time. So the question I have is, while the short-term trajectory of interest rates is apparent, there still remains some ambiguity as to where we are in the interest rate cycle. Is it an accelerated normalization of rates, which then transits into a rate stability, or is it a response aimed at anchoring inflationary expectations, managing the external environment, domestic?
You see, our approach, as we have said earlier in the last MPC, is, withdrawal of accommodation. The policy rate is still lower than where we were before the pandemic. Before the pandemic, our policy rate was 5.15%. Now the policy rate is 4.9%. In terms of liquidity, we are still below the pre-pandemic level, but the liquidity has been brought down substantially over the past several months, and we had initiated action already through the VRRRs and through the other measures, and so the liquidity has come down, but nonetheless it is still higher than where we were at the time of the onset of the pandemic. Of course, you have a new challenge and a new issues arising out of the war in Europe. So we are still on the mode of withdrawal of accommodation. Our objective is to anchor inflation expectations, and that is how we are proceeding forward. What was the other part of your question?
So whether demand management is also part of it, or again, because it is largely the temporary factors in terms of the external environment, there's a possibility of retracing the steps that we are taking now.
No, our objective, as I can say, as I said, let me just summarize: withdrawal of accommodation, number one. Number two, taking steps and ensure anchoring of inflation expectations. Number three, through monetary policy action to ensure a balance between demand supply. That is something which we are targeting. So it's not a question of compressing the demand unduly, or, it's basically finding a balance. The monetary policy, the rates should ensure that there is a balance between demand and supply conditions.
So just a small follow-up on the last part, what you said, Governor. To the extent that predictability is a desirable goal of communication and a policy tool, would a dot plot like the ones provided by the FOMC members be a good idea for the RBI?
You see, first thing is that FOMC meets once in 6 months. Our MPC meets once in 2 months. The situation today, and it's been earlier also, is extremely volatile and extremely uncertain. In such uncertain times, giving a dot plot may create unnecessary expectations on either side. It will create expectations which you may or may not be able to fulfill going forward through your actions. Now you look at it, in February first week when we presented the monetary policy, nobody, even around the 19th or 20th of February, nobody expected a war of this magnitude and the impact that it has created. Nobody expected that to happen. So supposing you had given a dot plot kind of thing and you had been very specific that this is how we are going to move, that is representing each member's thinking. then the situation turns totally, completely undergoes a change. So therefore, you create unnecessarily, you would create expectations which you may or may not be able to meet. So therefore, in such uncertain and volatile times, I think having a dot plot approach is a problem because you have to change your stance every time. And communication, there should be some amount of consistency. I agree, the situation is volatile, and as they say, when facts change, I also change my actions. But the point is, broadly, there has to be some kind of consistency in our approach. But that whole, that what the dot plot is achieving in US, I feel will create expectations which you may or may not be able to live, and in any case, forward guidance is provided through the monetary policy statement that we are making, and the thinking of each of the individual members is given out when the minutes are released exactly 2 weeks after the MPC. So we are already doing it, but a dot plot and binding yourself to specific points will not work, I feel, in these current times when the situation is so uncertain and volatile.
Thank you, Governor. Let me just now touch on a few areas that you have covered in your speech. Central banks ensure the stability of the financial system by regulating the major entities and activities. How much of a challenge is it to deliver on this mandate when important financial activities, payments, lending, quasi-lending is migrating to unregulated institutions?
That is an issue we are dealing with. There are large number of unregulated, unlicensed entities which are, doing various kinds of lending. There are licensed entities also which are entering into activities which they are not supposed to undertake. So we are dealing with these issues, and as you know, we have formed a committee. The committee's recommendations we have examined, and we will be issuing the relevant guidelines in this regard very shortly. It has taken more time than we had initially, what we had initially in our mind, but the situation is so complex. We are being very careful and very cautious. On the one hand, you have to support innovation. You have to support something new, a new product or a new approach which is coming, you have to support that. At this other, that is one aspect. On the other hand, you have to maintain financial stability and see that undue leverage or risks are not built up. So therefore, you have to find a very delicate balance, and therefore we are dealing with the issue very carefully. I would feel in the next few days it would come out. I have said this even earlier also that we are expecting it shortly, but we have taken more time because the situation, because the entire the entire dynamics of the whole thing is very complex, and we are being very cautious, and we are trying our best to take a very balanced call that supports innovation at the same time, that also does not in any manner compromise financial stability or leads to over leveraging or creates unnecessary financial risks.
Thank you, Governor. I think you have almost answered my next question, I think, when you talked about the balanced call. But let me ask it anyway. RBI itself has recently launched an innovation hub, which the Governor inaugurated. What role do you envisage for the central bank in terms of promoting innovation and technology?
Is it twofold? One is that we have certain thoughts and ideas in our mind, especially relating to the payments space and other kind of fintech initiatives. As you know, we have a regulatory sandbox, and already number of products which were part of the regulatory sandbox. The trials have been completed, and we have said that we are okay with it. Now it is for those players to take it forward. So number one, we have certain priorities. We feel that there are certain areas, particularly in payment systems, in ensuring that without internet or in what best way we can improve the entire payment ecosystem in our country. On the other hand, there is a lot of new innovations, new initiatives, startups, they are all coming up with, fantastic ideas and new ideas. So, therefore, the Innovation Hub, number one, will focus on our priority areas. Number two, they will also themselves, because it's an autonomous board and they have complete freedom to sort of decide the priorities. They also suggest ideas to us that RBI should look at this. So first is to try and work on those areas. Second is to work and partner with the private sector initiatives and all that is happening in the startup ecosystem and in the innovation ecosystem, to work with them and try to sort of provide incubation facilities so that the startup companies or a startup entrepreneur is able to commercialize his product and take it forward. The Bank of International Settlements, the BIS, has set up innovation hubs in multiple places. We had the option of trying and getting one of their centers in India, but we decided to go on our own, because if we are on our own, we have two advantages. Number one, we have flexibility. We can do whatever we want. Number two, we can always leverage on what the BIS is doing, because there is constant dialogue also with the BIS Innovation Hub. So therefore, that is something which we have launched as an RBI institution, and already the board is functional, and as far as I know, I have been sort of tracking what all is happening. I think the developments are looking very promising.
Thank you, Governor. My last question would really cover what you have covered in the last part of your address in terms of banking and banks beyond tomorrow. So banks have emerged from the pandemic in reasonable shape. What might be the residual concerns of the Reserve Bank, and what are the key enhancements that the RBI might have it on its agenda for next few years?
No, there is a room for constant improvement. During the last 3 years, notwithstanding the pandemic, the lockdown, etc., as you know, we came out with a new document. We came out with certain guidelines for relating to governance in scheduled commercial banks. We have come out with a new regulatory architecture for microfinance lending, a new regulatory framework for NBFCs, a new regulatory framework very recently relating to the urban cooperative banks. So constantly we are endeavoring to sort of see that the banks, in terms of risk management, in terms of governance, in terms of responding to the changing needs of the time, the banks are in a position to sort of move forward. But then our intention is not to interfere at all in any commercial activities. The banks and their technology teams, their commercial teams, their risk management teams are sufficiently capable of dealing with all these issues. But as a regulator and supervisor, we have to ensure that overall the financial stability is maintained. Now, there are new challenges coming up with regard to financial stability from time to time. So we have to keep close track of developments in individual banking entities as well as what's happening in the entire ecosystem, and then work closely with the banks, in partnership with the banks, to see that they remain robust at all times. You will remember that during the pandemic, with the banks, regularly we were having interactions those days during the pandemic. Even during the lockdown, we were having these video meetings with both public and private sector banks. And one point which we were constantly emphasizing was to raise capital, because we knew that going forward there can be a stress to the balance sheet of the banks. And I'm very happy to say here that I think almost every bank responded very positively, and most of the banks raised capital, and today that is how we have the strong, the financials and the strong, we have a strong capital adequacy in the banks. So the idea is that to work constantly with the banks with regard to the challenges that we have currently. One is this whole digital and this technology space, where the banks also need to move in, in tandem with the requirements of time. Banks are also facing challenge from new entities. So whether we should try and regulate the new entities, or if we decide to regulate, how we regulate them. So I think basically what remains to be done depends on how the situation evolves and how we read the evolving situation. So it's a constant exercise that goes on. The challenges of today will be, will undergo change, and the challenges of tomorrow will be completely different. The challenges of beyond tomorrow will also be far more different. So we have to be in tune with the times.
Thank you, Governor. You have been very kind, very frank and forthright as always. With your permission, since we have a little bit of time, we might take a few questions from the audience.
I think somebody is there asking. He's asking where.
Governor, you talked about the issue of commodity price inflation.
Can you please introduce yourself?
Yeah, my name is Y. Pitalwala. I represent Business India magazine. You talked about the issue of commodity price inflation and the resultant impact which is having, particularly with respect to the war that we are experiencing. To the extent that the Indian GDP growth as well as exports also has a very high import intensity. To what extent do you see exchange rate also contributing to this inflationary expectations? Because that too will play in terms of how you go about anchoring those inflation expectations and the reality, right?
No, naturally when the commodity prices go up, we are major importers of crude oil. And when the price of crude oil per barrel goes up from $85 per barrel, it went up to 120. In fact, it touched 130, as you know. Today, now it's about 106 or so. In the morning I had seen. So naturally, we are paying more for that barrel of crude oil. So when you pay more for importing, for two factors. Number one, the prices have gone up. Number two, the currencies are facing depreciation. So naturally, that is what is called imported inflation. So our approach also, monetary policy action also looks at the imported component of inflation. In all our assessment, when we make projections, we have given a projection of, for the current year, the 6.7% as the average inflation for the current financial year. We will be reviewing it as a part of the next MPC. I will not like to comment on that because our research teams are already working on it, and we will discuss it during the MPC, monetary policy meeting, and we will decide. So obviously it is a component which impacts our inflation, and our action, monetary policy action, will naturally factor that in, and it factors that in. The price rise of commodity prices as well as the further rise due to, due to currency depreciation. They are definitely important factors. Imported inflation is a challenge. And today, as we have said, even food inflation, as we had stated in the last policy meeting, now we are surplus in wheat. But the wheat prices went up because international prices of wheat went up. So therefore, that naturally impacts our local inflation. So all these factors are analyzed and as a part of our inflation calculation and projections.
One more question. You talked about the issue of negative interest rates and the impact that it will have on savings and investments and therefore growth. And you also pointed out that pre-COVID, it is post-COVID that we've had this. To what extent, given the volatile situation that you see, we continue to forecast that the Indian economy will have negative real interest rates for savers? Because historically we've always been a savings intensive economy, particularly when you look at the household sector.
No, the savings are picking up with growth of credit. In fact, credit growth has now touched 14%. Our official figures which we have given out, the latest number is about 13.5 or something we have given out. 13.4 or something, but I think internally we are aware that it has already touched 14%. So when there is credit offtake, naturally the liquidity will, there will be a draining out of liquidity. And there is always a leakage of liquidity through currency in circulation going up. So we are also increasing our policy rates. So going forward, the banks who have already started, adjusting their asset prices, that is the interest rates they charge on the loans. In the liability side also, some banks have already started increasing the deposit rates. But going forward, when there is a requirement of liquidity, and I think the banks will steadily and slowly increase the deposit rates. And policy rates, basically, when we increase the policy rates, that also impacts on, the deposit rates in the system, in the liability side. There's a transmission time, but eventually it will transmit to deposit rates also.
Yeah, good morning. I am basically finance controller of Vimal Intertrade. My question is,
You're from? Sorry, I didn't get.
I am a finance controller from Vimal Intertrade Private Limited. My question is, recently RBI has decided to allow the settlement of international trade in rupees. So what is the impact of same on overall economy of India? Whether India will have a dependency on USD, or how it will be, how it will affect the Indian economy?
No, it's too early to say. It's an additional facility that we have given to the importers and exporters. So far, all the, the import, export and all the international trade so far as India is concerned has been by and large dollar denominated. This is a new facility we have opened up. There was a demand from the industry for quite some time. This idea was under discussion and was under assessment in the Reserve Bank of India, and we have been working on this whole idea. So the idea was to give an additional a new avenue, a new option to the importers and exporters to do their trade in rupees. It is too early to assess its impact, but I think over a period of time it should pick up, but we have to wait and see. It's too early to say how it will shape up in the future, but potential is good.
Thank you very much. Yeah, thank you.
Good morning, sir. I'm Arundhati Bhattacharya, CEO of
You need no
Salesforce.
introduction.
So, thank you. Sir, first of all, thank you for your very reassuring and erudite speech. It is very reassuring to hear the kind of things that you said from this podium. What I really wanted to ask is on climate change. You mentioned that as one of those events that are, definitely going to impact us. India has, on the whole, overall as a country, given a net zero goal for itself, which is way out. You control a very large sector of the economy. You are the regulator for the BFSI sector. And the BFSI sector in turn lends to many of the industries that are, very far from, achieving net zero status. We also know that in India, mandates work best. So do y'all as the regulator have in mind any mandate for the BFSI sector to achieve net zero status?
You see, in this area, whatever we want to do, we would like to do it in a collaborative manner. And precisely with this objective, we are coming out with a discussion paper on climate change and climate-related risks. The discussion paper should be coming out sometime next week, I would expect. And based on that, it's a discussion paper, so we would like to get suggestions, ideas from all stakeholders. And after getting the ideas and inputs, then we will examine them internally and we will go forward. We'll move forward. So far as the climate change targets are concerned, I think India has done very well. All the goals, all the milestones for India under COP26 have been achieved. Quite a number of developed countries have not done that, but India has achieved all the targets under COP26. I mean, having been a Sherpa for G20, I still keep track of what's happening in these areas. So we have achieved all our mandate, and India has a target of net zero, which you have mentioned. We have to move in a very calibrated manner. There is the aspect of not compromising on growth. There is the aspect of not sacrificing too much of growth. There is the aspect of looking at the cost. At the same time, there is the requirement to give due and sufficient priority to climate-related risks. So a balanced approach, as always, needs to be taken. I would look forward for very valued comments from senior bankers and other stakeholders, academicians and finance professionals and others on our discussion paper. When it comes, we will, we don't want to be too prescriptive without having a proper consultation. Our approach has been consultative. We will consult and then move forward.
So the IT industry can definitely contribute hugely. We'll look forward to doing that.
Sure, definitely, yeah.
So, good morning, Governor and Sanjeev sir. My name is Mohit Deegan. I am currently employed with MasterCard, but my question's not from that perspective. I ask you as a question of a student of cybersecurity. I'm doing a course on cybersecurity, and I've been reading about the challenges that banks across the world have been facing. As we say, with challenges, there are opportunities. So it works the vice versa as well, with the opportunities, and especially in digital, the explosion in digital that we've seen over because of COVID and other technology things that banks have adopted. My question to you, Governor, is does cybersecurity threat give you sleepless nights? And if so, what would be your recommendation to banks on the whole?
I never have a sleepless night, whatever be the situation, because what is happening all around, you cannot control everything, but you have to deal with it. So you have to sleep well so that you go out to do your batting and you bat well. A good night's sleep is very essential for doing very well on the cricket pitch. And since I am a cricket fan, I always use the cricketing, analogy. Now, cybersecurity is a real problem, is a real threat. When the COVID pandemic, started, Mr. Chadha would recall, and other senior bankers present here would recall, around 20th of February that year, in 2020, internally we sort of heightened our cyber, alertness. And we sensitized all the banks, not just by writing a letter to all the banks, but we had interaction with the IT heads of all the banks. We also had a meeting with the CEOs of banks, because that was a time where we expected the number of attacks, cyber attacks, to go up, because the guys on the other side will think that now people are focused on COVID, so this is the best time to attack. So therefore, everybody was sensitized, and this is a challenge, and this is one area where I think the IT systems of every bank, every financial institution, including the Reserve Bank of India, will have to be one step ahead of the of the attackers. And the kind of cyber attacks or any problem, the threats that may come, and that requires knowledge acquisition, that requires being constantly alert, and people have been talking of ethical hacking. That is up to institutions to decide, because ethical hacking also has its downsides and risks. But basically and I think I touched upon it in my speech also, the idea is to sort of constantly upgrade knowledge, constantly know what is happening all around, and keep on investing more in IT systems and internal skills of banks and financial institutions. Because in days to come, it is going to, as a problem, it's going to become bigger and bigger. And we have to be very alert to deal with it. We just cannot afford, compromising our financial system and the huge data that we carry in any manner.
Good morning, Governor. This is Dipanvita Mazumdar from Bank of Baroda. I would like to ask you one question. The system level liquidity has gone down and liquidity normalization has happened, but durable liquidity is still at an elevated level. And going forward in the second half, when currency demand picks up and RBI's FX intervention pans out, so how would that impact the level of liquidity, and what will be the impact on rates? Thank you so much.
Impact on rates, I cannot say. You will have to wait for the Monetary Policy Committee meetings. the rates will depend on the evolving, as I have always said, the rates will depend on the evolving inflation growth dynamics. So far as liquidity is concerned, today, if you put together the variable, and these are not any secret figures, it's known to everybody. I think the VRRR 14 days and the VRRR 28 days and the daily, the liquidity which comes back to us through the SDF, that works out to about 2.8 lakh crores, 2.9 lakh crores or so. That was yesterday's figure. And there is a government cash balance also. So put together, we have about 5 to 6 lakh crore of liquidity in the system. So liquidity still is very, very comfortable. But yes, you are right, going forward as credit offtake takes place, as government spending, picks up, because usually government spending picks up from the second quarter onwards, and more so after the monsoon. So as credit offtake picks up, as government expenditure, the pace of government expenditure picks up, and you mentioned the forex intervention also, which the Reserve Bank does from time to time, I think liquidity will come down to sort of, the level of liquidity will come down. But as I have said earlier, we will ensure that there is always adequate liquidity in the system to meet the credit requirements of the economy. So beyond that, I will not be able to say how much liquidity is, we are comfortable with how much liquidity. I will not be able to say. We will ensure that credit offtake is not sacrificed, credit offtake is not affected due to problems of liquidity. So it will depend on how the situation evolves. Okay, I think we can conclude.
So thank you very much again, and thank you again, Governor, again, for patiently asking so many questions.
Actually, there's something very odd out here. We don't have too many media people asking you questions. I don't know what their plan is. So anyway, Governor, we are very thankful to you for coming here and setting the tone for the proceedings for today. And as a token of our appreciation, I would request our MD, Mr. Sanjeev Chadha, to present a memento to you. Thanks a lot, Governor, again. Take a few photographs. So friends, we are having a short break right now. We will reassemble at 12 o'clock.
love and tears. I've cried for you 1,000 times. What you gonna do? What you gonna do? What you gonna do? What you gonna do? Love and tears. What you gonna do? What you gonna do? What you gonna do? What you gonna do? Love and tears. What you gonna do? What you gonna do? What you gonna do? What you gonna do? I know you're in love with me, and I love you too. I know you're in love with me, and I love you too. 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 Ooh, it's a love and tears. Love and tears. I cried for you. Love and tears. I cried for you. I know you're in love with me, and I love you too. I know you're in love with me, and I love you too. I know you're in love with me, and I love you too. I know you're in love with me, and I love you too. And I love you too. Love and tears. And I love you too. I cried for you. And I love you too. And I love you too. Love and tears. And I love you too. I cried for you. And I love you too. And I love you too.
Attention everyone, we'll be starting in the next 5 minutes, so could you all please take your coffee, tea and settle down? Okay, our next session starts at noon time, we just about have 3 to 5 minutes. Attention everyone, could you all please settle down? We are starting the first panel discussion. May I? Invite the panelists to come on stage. Yeah, I'd like to request Mr. Sanjeev Chadda to come on stage. Ms. Arundhati Bhattacharya. Mr. Ashish Gupta. And I think what the governor had said for Ms. Bhattacharya is that she doesn't require an introduction. So I'm not introducing the other speakers also. I think it'll come on the screen. Mr. Ashish Gupta, Mr. Deep Gupta. And Mr. Rasesh Shah. So we're just flashing the profiles of the speakers. And the way we'll go about these panel discussions is that the moderator will set the tone of the discussion by telling us exactly what to expect. And then he's going to start quizzing the other panelists, and you'll have to give the replies. It's of course a serious discussion which we're having. So the first panel is called Banking Beyond Tomorrow. This was the theme of our overall conference. So we're going to take away certain thoughts from what the governor had shared with us, and we're going to focus more on that in this particular panel discussion. So it's over to you, Sanjeev.
Very good morning, or is it nearly good afternoon once again, and welcome to our first session. We'll focus on what is, as Madan said, the theme for the conference, Banking Beyond Tomorrow. But as I mentioned in the welcome address, it will be from the perspective of the industry leaders that I have with me, who even as they make their strategic choices and build their own businesses, they're also contributing to defining the emerging contours of banking. So we have with us a stellar panel, one that does not require much introduction, and particularly after the governor insisted that Mrs. Bhattacharya does not require introduction, I think it would be extremely presumptuous on my part to really introduce the speakers. They are doyens, industry leaders in their own right. So I think we'll spend the time much better in terms of just focusing on understanding their perspective, first in terms of their own businesses, and then of course how do they impact banks today, and also if banks have to profit from what they are doing in their own businesses, what is it that we need to do as banks? So as I mentioned, an outside-in perspective in terms of how our partners view banks, and what is it that they expect for themselves, their businesses, and also from us. So let me just begin in that case with Mrs. Bhattacharya. So there's no doubt about the fact that technology is the basic building block for banks. But it's also true that technology is no longer owned in any appreciable measure by banks. It is not proprietary at all. It is again companies like Salesforce which allow us to do what we want to do. Now does it mean to some extent that in a medium-term perspective at least, that technology is not really something which we talk in terms of competitive advantage, at least among the leading cohort, and more in terms of how you can maximize the value of your business. Particularly again, if we look at it from the perspective of Salesforce, which has done a number of acquisitions, particularly in the BFSI space, and now with Mrs. Bhattacharya in the lead, it's making a very, very active attempt to become a dominant force in terms of powering banks also.
So, first of all, thank you, Sanjeev, for having me here. It's indeed an honor, and the first session, as I told you, was really excellent. Having said that, let's look at what the ecosystem is like. If you look at the ecosystem today, it is predicted that we will have 3.8 billion people across the world who will be using digital banking services by 2024. If you look at one of the McKinsey studies, it says that 71% of the respondents very clearly stated that they want multi-channel access. Now, 25% also said that they want multi-channel, but they want also a seamless switch to manual and physical if they so need, okay? If you look at the payment industry, and the governor was talking about it, today in India alone, we have a 3 trillion turnover, and it is expected that by 2026, this is going to triple to more than 10 trillion. Now, when you are looking at an ecosystem like that, there is no way that you can feel that technology is not part of banking. In fact, technology for every single industry, not alone banking, it's like your spine, it's like having a backbone. If you don't have a backbone, you're lying down, you're not standing, you're not moving. Your brain is not getting the signals. Technology has become like that. For every industry now, it is the backbone, and unless and until you sort of bring it in as part of the activities that you do, you are not simply in a position to give your people, that is your customers, the experience that they want or deserve. Now, having said that, there was a time, I remember when I was in the bank, there was a feeling that banks would become technology companies, and technology companies would actually do banking. Is that a fact? Now, having been in the world of technology for just 2 years, so I'm still a youngster here, though not maybe in age, but still. But now I do believe that that is not necessarily true, because every business has its own business model that they must pursue. And technology, on the other hand, is on such a swift evolution that if you concentrate on that, you will lose your focus on your main business activity. So what is really required is a collaborative approach, as you said, partners, and that is your theme for this session. So that's what you need to do. You need to collaborate with technology as your backbone, with various people in the ecosystem, in order to bring the best products for your customers and ensure that you are literally leveraging what you have, that you are unlocking it, you are unpacking it to give the best possible insights to your employees, so that every customer interaction is a fruitful interaction.
Thank you. I think Ashish is again somebody all of you would know. He might prefer that some of the bankers here might forget him. But again, he was the person who talked of house of debt so presciently that in so many ways really defined conversation for nearly 10 years. But now again, Ashish is on to a different theme. Technology, as we know, as Madam said, is an enabler, but it can also offer potential for disruption. So Ashish has issued a report that talks of 2 sources of disruption in particular: digital banks and open banking, and goes on to identify open banking as a key threat to incumbents, drawing upon the experience of other Asian countries. So Ashish, can you just walk us through your thought process, and what is the extent to which this can change the competitive landscape, and have you discovered a house of cards after a house of debt?
Thank you, Sanjeev. First of all, again, thank you for inviting me to this panel. I think technology, as ma'am said, is the biggest enabler, right? It's an enabler for banks, but it is also a very big threat, not just because what technology companies will do, but what other banks will do, right? Because what you mentioned, technology is not proprietary, right? So most banks have access to various vendors, including Salesforce. To buy technology, they have access to various consultancies to implement technology. But really what is the key is how the organization can be flexible enough, be adaptive enough to that change and re-engineer itself, right? And that is what will define success. I'm quite sure the rankings among banks will change. Earlier, probably the biggest success factor for the bank was how many branches did you have, right? So if you had enough branches, you had enough deposits, and therefore you could give the most amount of loans. now some of those barriers to entry will fall, right? The other big issue has always been that it is not the assets which are really value creator, but it is the knowledge of the customer which is the value creator. And knowledge of the customer was proprietary to the bank, captive to the bank. So what I did in my bank account with SBI, only SBI knew, right? With open banking, I think that barrier has broken down. Now that information can be sourced by others, with some digital public goods like account aggregator coming in, the access to information not just about your bank account but your mutual fund, of course with the consent of the individual customer, is accessible to any financial service provider. So I think that is a big risk that banks have to tackle with open banking, that some of the captive hold they had on the customer is breaking down. The other issue is how you interact with the customer. When you had branches, the customer was coming to your premises. When you went into ATM or even net banking, the customer experience was still driven by your captive channel. Now, most of the customer experiences are actually driven by third-party channels. In various products, I'm sure, as you're aware at your bank, 40 to 70% of customer interactions happen through third-party channels, non-banking channels. So how do you control those experiences? How do you make sure that the customer comes back to you as the service provider? So those are the challenges that banks will have to face with open banking.
Perfect. But I think, Ashish, you have dodged my question about the degree of disruption. We'll come to that later. Coming to Deep, I think Deep really represents two important aspects where banks have actually interacted with partners. One is private equity firms, which have become more and more important as part of the landscape. You could almost argue that they are the new, within quotes, promoter groups of India. Most of the capital, patient capital, really comes from here. The other part, of course, is that Macquarie has been a consistent player in the infrastructure sector. As banks, we dipped our toes in infrastructure, not with very good results, walked out, and now we are looking at making again a tentative entry again. But Deep and his company, they have been there throughout the cycle. So I think it will be very good to understand from him that in terms of the evolution of the infrastructure sector, the framework in which we operate, what are the changes that he has seen over this period of nearly 15 years? And also what are the changes he might like to see over the next few years to make sure that not only patient, well-informed capital like his, but even again less patient and less well-informed capital like ours can also be part of the story.
Thank you, Mr. Chadha, for inviting me here, and this is obviously a very esteemed panel. I represent the asset side of what the bankers do, and just being very in the sector now for 15 years, I would say that our experience is also mixed, right? So we've also learned. The biggest thing that one point which I can say I've seen across all the financial intermediaries, whether it's banks or ourselves, in this sector in infrastructure, has been that there's been a lot of capacity building. Now we think of it as whenever we talk about emerging markets, we say India is actually ahead in the emerging markets. The reason for that is when we talk to our investment committees and we talk to investors, they know that there is talent available in this country which over the last couple of decades has learned about infrastructure. So I would say that that's probably the biggest thing that's changed. Today, if you were a lender, and I'm pretty sure a lot of bankers are around here, you would almost look at a greenfield road project which has been bid with certain traffic assumptions very differently than, let's say, you were looking at 15 years back. And it's fair to say that some of the government institutions have learned that. They've aided that capacity building by coming out with concessions and with frameworks which are a lot better today after a consultative process. So to me, I mean, if you were to just say that's probably the biggest thing that I've seen change over the years. In addition, where we sit today in the world, and we talked about in the last discussion, the first discussion of the day, India is in a position where you're seeing a lot of volatility globally. It's fair to say that will impact us, But it's also very different because it's probably one of those few times when the entire industry and the banks, the balance sheets are probably the strongest. So when people look at it from a general perspective, when they read the articles that come out in international journals, you think that India is going the same way. I do feel that fundamentally it's a very different time. So when you combine the capacity building and the immense opportunity that is existing today for our country, I just feel that it's just a great time for people like us to be investing in the country, but also for all other financial intermediaries, including the banks and other financial institutions. So I just feel that I'm generally a bit more positive about things. I can talk about the other stuff on banking, but frankly, I'm not an expert, so I'll rely on Ms. Bhattacharya and Mr. Gupta and Mr. Shah on that.
Thanks, Deep. So, a number of us, again, at banks, we like to call ourselves financial supermarkets. But I think in terms of non-banks, if there is one group which actually can accurately answer to that description, it is the Edelweiss Group. Mr. Shah's interest span entire gamut of debt and equity. But let us begin again by talking about the NBFC business, which is one business with which banks have been associated the longest, and in many ways that relationship has been being redefined over very many years now, and it appears that possibly we might now be looking at a new paradigm and settling down to a new paradigm. From a time when NBFCs were underwriting nearly 50% of all new credit in the banking system, to now when we talk in terms of the merit of asset-light models. So my question to Mr. Shah is that, is it really the end of history, or does he believe that picture abhi baki hai and there's a lot of evolution in the sector which is there?
Yeah, I think it's an important question, but first of all, thanks a lot. Very honored to be here. It's an exciting panel. I enjoyed the RBI governor's talk also. I think if you look at India and when you say banking beyond tomorrow, I'm sure people are going to talk about savings and transactions and credit and as well as advisory services, how the banks are evolving in all these four areas. But I think credit, as you said, is one area which, if you go back about 15 years ago, credit and banking was almost synonymous with each other. And I say that it was a single lane, kind of a credit was only a one lane, which was banking. In the last about 15 years, with all the ups and downs, I think we have moved to credit being a expressway with multiple lanes. We have got banks, we got NBFCs, we got HFCs, we got AIFs, private credit funds, we have InvITs, we have REITs, we have obviously the bond market. With insurance companies, corpus is also growing. They are big players in the bond market. So I think credit has become a lot more hybrid, complex and very, very diversified, or it is actually becoming. I think banks will always remain very centric to this because the savings franchise is still with banks and household savings flow easily into the banks. So given that, I think for a lot of NBFCs, and as you very correctly said, I think if you go back and see the last maybe 20 years of NBFCs in India, there have been phases where NBFCs have been partners with banks, and there have been phases where NBFCs have thought of themselves as competitors to banks. I think the long-term model, given that the savings franchise is with banks, and it should be with banks, because that's the most important one, that you want to protect, you want to make sure the household savings are safe, and India has done a great job at that. I think NBFCs can focus a lot more on innovation, on being closer to customers, like for example, the new to credit market, whether it's MFIs or housing finance companies, have been able to innovate a lot more on that. So I think the new evolving approach could be, and at least that is one we in Edelweiss have embraced, in the fullest. Though I think in credit we are very excited by this because we have AIFs, we have private credit funds, we have bond markets. We are very excited by the changes that are happening. I think NBFCs can become asset light, and in a way it's not new. I think we in NBFCs think this is something new we have discovered. I think many industries, from hotel industries to FMCG, a lot of them have gone asset light. A lot of hotel companies used to own hotels, they don't own them. So I think NBFCs will choose to be closer to the customer, use technology a lot more, innovate a lot more, and partner with banks, and that is what we, at least in Edelweiss, think. There is an asset light, but asset light doesn't mean it is effort light. I think it can be very effort heavy, but why do you want to try and use your balance sheet as a competitive advantage when banks have that? So by partnering with banks, I think you can create a win-win situation. Also, I think credit earlier was largely about balance sheet and risk, and as Ashish said, information proprietariness that you had. I think with information opening out, technology coming in, we are actually moving in credit also from a very product-centric world to a customer-centric world. Up till now, I think credit was what customer had to take. Whoever was providing credit had to accept it. Like a home loan is a home loan is a home loan. I think we are moving to really an area where understanding customer needs, designing product. Like we in Edelweiss today, we have 8 products under proof of concept in SME lending. Even I didn't know that 18 months ago, that there are so many product nuances and product innovation you can do. And I think in financial services, we have all taken product innovation for granted because we think a credit card is a credit card, a mutual fund is a mutual fund. But there is a lot of innovation that can happen, that is required. Customers are asking for it. And the moment they have a choice, I think it will become also another differentiator there. So I think NBFCs can focus a lot more on that rather than try to be competitors to banks.
Thank you very much for that. So Mr. Bhattacharya, again, follow up in terms of what you said and what Ashish also said about the importance of banks to innovate, remain abreast, or you have the risk of being left behind. But the challenge, of course, is that a lot of us are legacy banks, and in so many ways, the journey in terms of technological upgradation has been defined and constrained by that legacy to some extent. We are now seeing possibly that we have changes that allow legacy banks to actually profit from innovation much more easily. I think Salesforce has been part of really constructing that design. So possibly you could just tell us again that from your perspective, is this still a big challenge in terms of the legacy systems that you have, or is it something that we can now overcome, hopefully?
No, I think, this is something that you can overcome. Absolutely, those tools and those solutions are today available. In fact, all of y'all are sitting, means at least the big banks, they're all sitting on a wealth which they are not even, aware of, or they are just not leveraging. What you really need to do is to really unpack the data that is available with you, connect them up, unify them, and get the insights that you really need. Today, for instance, I would say that you need to do 4 things. First and foremost, you've got to really invest in technology integration. Integration more than anything else. So many of your stuff, like he said, a home loan is a home loan. A home loan is not a home loan. A home loan can give rise to a host of other products. So the fact of the matter is the silos that are there in the banks, you need to unpack them, be able to compose them, and then unify them. That will give you insights that can create many more, ideas and insights about what your customer needs, and therefore each customer interaction can become far more powerful and meaningful, both for the customer as well as for the bank. The second thing I think, we have to constantly be on the lookout for is cybersecurity. As and when you undertake this journey, because you are a far more regulated entity and therefore known in the market, becoming a target becomes that much more, feasible, and therefore you have to be very conscious about that. The third thing that I think, all the banks, especially the legacy banks, need to do is a constant upgradation of skills. A constant upgradation of skills of their own people, as well as awareness amongst their customers. Remember always, a system is as good as its weakest link. And very often the customer is the weakest link. Means even when you are sending them an OTP and saying over there, do not share this with anybody. I know of people, highly educated people, who have shared the OTP 5 times. 5 transactions, they have one after the other, they have got OTPs, they have been told not to share, they have shared it, and the money has disappeared from their account, and the fifth time they've woken up and then called us in panic. Now, the fact of the matter is there is a very, very big need, and I think this is a place where the regulator also needs to play a part of raising customer awareness. So that's the third thing. And the fourth thing, again, I will go back to what Mr. Shah was saying, which is, innovation. Innovation is something that you need to really work in as a method of working within the organization. An organization that is not innovating is actually on the decline. You need to innovate as fast and in as agile a manner as you can. Now, how do you do all of this? There has to be a way of doing this. Today, actually, there are a large number of models, data models that you can do, and apps that you can adopt in order to very quickly get those customer insights. Not only that, what you can do is you can automate all the repetitive processes and thereby ensure that the customers have a very seamless journey both across digital and the physical. Okay, and that's what they are asking for. Third is that you can actually create the kind of tools, again the governor talked about it, APIs, the API libraries. There are tools that create these for you. You don't have to do it. They actually form a layer over your existing systems, and they create these to enable you to consume API-led applications, which enables you then to become far more agile and nimble. You are not looking at a timeline of 9 months or 1 year to bring a product to market. You bring it to market, test it quickly, try quickly, fail quickly, succeed quickly, whichever way it goes. So you need to keep doing that. And last but not least is the fact that you need to create end-to-end digital journeys, meaning therefore that every single piece of the action that is there, you need to unify it across silos so that the customer gets a seamless experience end-to-end, and again, as I said, is able to choose the channel by which they will interact with you. But whatever channel they choose, the experience will be uniform, and not only that, the person who is interacting will know exactly what to say, because the system itself is showing you what are the possibilities with these customers. I think if we can work on those lines, there is a lot that the banks can do. And actually speaking, at least in public sector banks, this much I can tell you, we are very used to leapfrogging. Okay, that's what we have always done. We have fallen behind, we have lost market share, and then we have leapfrogged, and then we have clawed back market share again. We can do it again. I don't think that's out of the reckoning.
Thank you. Ashish, you spoke about the disruption potential of technology and how that can threaten incumbents through open banking in particular. You also have in the excellent report that Vishur talked in terms of how the changing regulatory landscape, not only in India but all over Asia, can actually benefit incumbents. I think you issued your report sometime in March, and to some extent what you said has come to pass already. So now if you were to look back at your report, what has happened, how do you look at the future and the impact it might have?
So, in fact, I'll again point out to the governor's speech about an hour ago, where he said RBI regulations for fintechs will come out, I think he said in the next few days. But when I did that report earlier this year, what I found very interesting was that when we interacted with regulators across countries in Asia, virtually every regulator was thinking similarly, right? Initially, we only used to think that regulators are keen that deposits are protected, so fintech should not be allowed access to deposits. But when we interacted with regulators, we found that even on the credit side, the regulators are as concerned that it should not be unbridled credit that should be out there, right? And as Governor said, that regulated entities should be the only credit providers, so that you can control the leverage that is built up in the system. Many fintechs came out with products like BNPL, which they were not calling as credit. So they said it's deferred payment and it's not credit, right? So that does not fly with the regulator. Or if you give a first loss guarantee, so you are actually taking the credit risk. So you are actually taking the leverage, so then you need a license. So what we found that the regulators were as concerned on the credit side as deposits, that it should be with regulated entities, people who have licenses to do it. What was even more interesting is that regulators want even the customer experience and the customer journey to be owned by a regulated entity, right? So, and that is to prevent mis-selling, customer protection, having KYC data secure, right? So, so models where the KYC is left to the fintechs, models where the customer just presses the tab on a tech platform and thinks he's getting a loan from the tech platform is not something regulators are comfortable with. So, so they will allow tabs on the platform, but then the tab has to say that it's a Bank of Baroda loan or the Edelweiss loan. So I think across the board, regulators want the regulated entities to own the journey, the customer to be aware who is he availing the financial services from, and I think that's a big advantage to all the incumbents. I think this approach of the regulator is going to help them hold on to the customer. We also ensure that all these platforms want to partner with them, right? And that's why we are seeing rather than independent models, partnership models coming out. But I don't think that absolves or takes away the disruption risk entirely, because even in a partnership, how the economics will be shared will be dependent on what each partner contributes, right? So if the banking partner is only contributing capital, he will just get a basic return on capital. He will not get any excess return, right? So if the customer is brought in by the fintech, if the customer underwriting is done based on the fintech's data, then he will charge a much higher proportion of the total economics, right? So I think the threat does not completely go away, but at least with regulation, it means that banks still have a role to play.
Thanks, Ashish, for that. Deep, again, to return to infrastructure, you spoke about the fact that how when we look at road projects now, we look at them very differently as compared to what we did in the past. But it's also true that of all the areas of infrastructure, if banks have got back into lending with some confidence, roads is one of them. And partly it is because the framework in which we operate has changed dramatically. Risks in terms of land acquisition, in terms of traffic, to some large extent they have been mitigated. So what are the other sectors that you see that might be ripe again in terms of reasonable risk return equation and which would become equally an area of focus for banks without again taking on your balance sheet risks which you actually cannot bear, as which happened the last time around?
Sure. Given that Macquarie Asset Management is the largest infrastructure player globally, I could just say that, you know, we can just look at our pipeline and what we have done in the last 12 months to give an indication where we can go. Transport obviously has been one area which you talked about. There are two other areas where we see a lot of interest, but also, as you said, risk return adjusted capital coming in. One is we're talking about a lot about technology here, and obviously infrastructure naturally legacy wise has not been too much of an investment into technology, but that has also meant that there are opportunities which are coming up, and what we've done over the last 12 months or 24 months in Asia Pac is an indication. We've bought data center businesses, we've bought telecom tower businesses, we've bought fiber businesses, undersea cable businesses, bought broadband businesses. So, you know, so it's been a one sector where we definitely see there would be set of opportunities in the next 5 years, I would say. Things always in India come with a lot of force and there's a lot of interest, and then you can't make money initially. But then you start doing the right, having the right thesis and being your expertise. So I think that's one area, and if I was a bank, I would definitely look at that as an area where there should be some internal technical expertise. I'm sure that, you know, banks are working on that already. So that's one area. The other one is, it sounds like, you know, I'm going to repeat this when people talk about, you know, green infrastructure. But I would say that on the green infrastructure, the alpha that we see is being a little ahead of the curve. And what I mean by that is, you know, you can obviously lend to renewables, which are, you know, development assets, etc., which are more secure. People understand them better. But the reality is, as you go towards, and every single organization in the world of substance says they will want to be net zero by some date. Somebody says 2030, 2040, 50. The reality is all of that is not going to come just by doing a lot of renewables. It's going to come because there's an integration which is happening, whether it's on the transmission side through storage, or it's on generating more sustainable renewables like offshore wind, right? So that's going to happen. Now, if banks want to be a little ahead of the curve, I would say that it makes sense to at least have some investment in understanding that. Whether that means you acquire a small 5-member team to really, which is on the cusp of technology to really help you understand it, or whether that means that you're having an in-house capability because you've already done that with some smaller pockets across the wide network that you have, you use that. So I would say that just the energy entire supply or the energy chain plus the digital infrastructure, which seems like, I'm kind of stating the obvious, but it requires a lot of work. I mean, reality is we haven't invested as a fund house in renewables and digital infra over the last 2 years that I've had capital to invest because we find things expensive and sometimes difficult to understand. But you need to spend that much time and energy if you want to be a little ahead of the curve.
Thank you. So, Mr. Shah, again coming back to Edelweiss as a financial conglomerate, so many activities. You've also had a lot of success in attracting funds to different parts of the business. So, you are therefore uniquely placed in terms of assessing investor interest in different parts of the financial services space. So, what is your sense in terms of investment? What are the areas which investors find more attractive and for what reasons?
I think overall, as we look at financial services, as we spoke earlier, I think when I talk to a lot of investors, they find the evolving, I use the word complexity or the diversity of India as very attractive. And if you go back and see, if the US economy was $3 trillion in 1985, and you see asset managers and wealth managers and credit funds and insurance companies and investment banks and your commercial banks, how they all evolved, a lot of them have a hypothesis that something similar is happening in India. India obviously has a huge demand. We have a lot of savings. We have a lot of credit needs of the economy to build out and all. We obviously have the what I call the market clearing mechanisms which are still evolving. Maybe some of them are not evolved, some of them are broken. But I think as the most exciting part of this for a lot of investors is India traditionally was financial services was equal to banks. Now I think we are still a bank-centric financial services, but not a bank-only financial services economy in that sense. And I think as we said earlier, banks will increasingly become more like hubs rather than, and it's also good for banks because as I said, they have the savings, they need to protect that because historically all the risk also resided with the banks. And I think what we are seeing is even risk can get parceled out. And for example, when we talk about NBFCs, as we all know, credit also requires equity. For every 100 rupees of credit you give, you need between 10 to 15 rupees of equity. Today, I think the total equity amongst all banks, the public sector banks, the private sector banks, the NBFCs, HFCs, MFIs put together is maybe 18 lakh crore or 19 lakh crores. About almost 25 to 30% of that is with NBFCs and HFCs. So NBFCs, HFCs also have brought a lot of equity to the table in order to share the risk. So as we spoke about, fintechs will be very good on technology but may not have big, huge capital base. I think NBFCs will have capital base, a little bit of, they will bring equity, they might not bring the borrowing capacity as, taking deposits and all on their balance sheet. So I think this hybrid of all this, where I think banks will play a very big role. So banks are increasingly going to be like the ringmaster in this whole complex that is there because the household savings will come there. But between what is happening in capital markets, which is also very exciting, the asset management space and wealth. And I know that you in Bank of Baroda have been investing a lot. I've seen in the last 3 years what you are doing in wealth management and NBFC and your investment banking advisory services and all. I think this having capabilities of all that and partnerships in all that, even collections and all like ARCs and all of that are becoming more important partners to banks. So I think this entire orchestra, when it starts playing the music, because India's credit need is, I think even today we are able to meet only 70-75% of the credit need at best. So there is a lot of unsaturated demand, and collectively if NBFCs, banks, bond markets, AIFs, all of them come together, there could be a lot more that we can do, and economy will become that much more productive. Because as one of the shortages we have is equity. So banks are also short of equity, NBFCs are short of equity because you can do only so much credit. I think the more we can churn this, the more we can use this smartly, without creating risk, it will need a little bit of innovation, disruption. One of the other things that NBFCs and all have done is also take the operating risk away from banks, because we all talk about financial risk a lot, but now operating risks are also becoming very important. So I think how much risk should reside in the banking system and how much goes outside of the banking system is going to be a very exciting thing to watch.
Thank you. I think we'll need some time for questions from the audience. But before that, I'll just ask a couple of more questions. Can't resist that. So first to Mrs. Bhattacharya. Ma'am, in SBI, you started the YONO project. You also had the foresight to think in terms of customer experience with the InTouch branches. And of course, now you are in Salesforce, a technology company. It's a journey which normally does not work this way, that you move from banks to a technology company. But let's assume it had been the other way around, that you actually had worked in Salesforce for 10 years and then landed in SBI, or if you were fortunate enough in BOB. What would have been your agenda again from the technology viewpoint?
Well, yeah, from hindsight, I now realize, how much more I could have done in the bank had I had this technology experience ahead of time. The first and foremost thing, of course, is that, whenever we are bringing in a solution which tends to leapfrog or tends to change things, you need to bring it in not only as a solution, but you also need to think about how the processes within the bank need to change. So, there is a tendency whenever legacy organizations take up solutions, technology solutions, to do a lift and shift. And that's probably the worst way of doing things. So you actually need a lot of change management within the bank to create the processes that will most efficiently use those solutions. So you don't bend the solutions out of shape in order to fit your processes. Rather, change your processes to fit into the solution. What that gives you is not only the best of results, but it also gives you the agility to keep upgrading that solution as quickly as the upgrades come, and therefore keeps you current. So I think that is one thing that I definitely would have thought about had I seen it from the other side of the table. It also enables you then to not only to adopt the solution, but adopt it very, very quickly. So you go to market much faster, you go with a much smarter process. And again, I keep giving a very simple example, like, if you have a check issuance process. The check issuance process, even today, you have a checkbook, and 4 leaves before the checkbook ends, you have a requisition slip. Okay, and when the checkbook is about to end, that is 4 leaves are left, you sign the requisition slip, you deposit it in the bank will check your signature, send it to the security press will check your address, print the book, send it to you. Even if you do it online, you may not have to deposit the slip, but even then you have to requisition. So there is a bit of service that is required either from both the customer side as well as from the bank side. Actually speaking, if you change this process altogether, and if you put in a little bit of AI and ML behind whatever you are doing, the system can recognize the pattern of your check usage. And when you have 2 months of checks left, the system will order the checkbook, and the checkbook will be with you before your checks are over. Why do you need any human intervention at all? You have done away with either the customer having to do that intervention or the bank having to do anything. So much of time saved, so much of productivity saved. If you remember, there was an airline that removed 1 olive from every salad, and therefore saved, millions of dollars. It's like that. Every single process that you have in the bank, you can automate whatever is, something which is repetitive. Automate all of it. So much of the services that the banks have today, excepting where you are having to dispense heavy cash, where you still need human intervention, even that can be, actually centralized. But other than that, everything else, all of these service requirements can be automated and can be, taken forward. Again, had I had this knowledge, I would have proceeded on those lines rather than on the lines that I proceeded in. But I still think all the same, we didn't do too bad a job. We did a good job. And we are on the journey still, and I'm very hopeful. As I said, I have a lot of hope in public sector banks, and I was actually longing to ask the governor a question regarding that, but then I restrained myself because I thought, I have moved away from that segment. That's not my place to ask. But I really did want to ask him why he is not allowing the public sector CEOs to go up to 70 years when the private sector CEOs can do so. It's a question I really want to ask. And there's a reason behind it, mind you. The reason is because all of these banks have to have very large change agendas. And you cannot do a change agenda in 2 or 3 years. It's impossible to do it. So you are putting a big handicap on the public sector by changing your leading team every 3 years. And I'm not saying that you shouldn't have reviews and you shouldn't change the people you need to change. But you should give them an opportunity so that, the continuity is there so that the changes can take place. That was my reason, nothing else. But anyway, I think that was important. Thank you.
Ashish, again, I think as somebody who really understands investors best, you probably will have the last word. So we have discussed a lot in terms of preparedness of banks. But as Mr. Bhattacharya once, I remember, said when she took over as the chairperson of SBI about the challenges of QSQT, right? Quarter se quarter tak. Now, in that context, how do investors really assess the value of preparedness, or is it something that actually gets manifested only when it does in terms of results of 3 or 4 years?
So actually, value of preparedness for change and technology is very difficult to measure, and not just least because of the fact that it's not quantifiable, right? It's abstract. But even more so because it's a continuous process, right? So maybe you can, through some surveys, assess which bank's app today is better than other banks. But that's today, it's not static. Right, 6 months later, the other bank will have an upgrade, and his app, his interface will be better. Right, so you have to, I think, look at technology and innovation as a dynamic process. You can't have a static judgment about it. As Madam also mentioned earlier, that it is not proprietary. So how do you assess someone? It's just whether you buy it today or you buy it 6 months later. I think the most important point about success is going to be how the bank absorbs the technology, how the vertical silos are broken down, and therefore the technology that is brought can be effectively deployed to offer solutions to customers. You also mentioned the customer-centric approach, and that will drive your preparedness and that will drive success. For outside investors, there are very few ways to really measure that. I think what people use to judge it is really, firstly, the track record of the performance of the management and the bank to adapt to change. So which banks over the last 15, 20 years have been more adaptive to change and which have not been. So you try to extrapolate that track record. You also look at the fact that what is the current performance, right? So you get some quantifiable data about how many journeys have been completely digitized, what percentage of business is now coming digital in various segments. And the third thing maybe you can use to judge is how are fintechs viewing the bank. So which fintechs banks are choosing to partner with, right? Because they are themselves judging which bank is flexible enough that it will be able to meet our needs. So I think you'll have to use a mix of these to try to make a value judgment.
Deep, from you again, I think the Macquarie has been almost a dominant player in the Australian market, which also in terms of funding of infrastructure, particularly in the Asia Pacific, has been a pioneer. So would you want to again highlight some structural advantages that have got built in, some processes that have worked here, which might be good lessons for us here in India?
I guess, I mean, to make money, because we buy assets and then we hold them for 5 to 10 years and sell them. One thing that we've learned is that you need to understand it quite well, what you're buying. And I think to that extent, I talked about the capacity building in the first question that you asked. I think that's probably the most important thing. And we talked about it in the second question that you asked, which I talked about a couple of other sectors. But I think that's one. The other is to understand things, and this is coming to some of the comments that have been made, and Ms. Bhattacharya made that very good comment. I think when you start becoming bigger, when you go from $1 trillion to $3 trillion, it's usually entrepreneurism and a lot of, stuff which is happening very quickly and fast, and then you want to go from 3 to 5 and 5 to 10. I've usually seen that as you start increasing the scale, even for our businesses across Asia Pac, you need to start more and more focusing on systems, processes, right? So then some people don't like it because a lot of people are entrepreneurial and they say, systems are just slowing us down. But the reality is when you're running a very large country or very large bank, you need to have systems in place. So what we've seen is, as we have evolved over the last 20 years in our own journey, is last 3 years for us as Macquarie, as an organization, has really gone into systemizing a lot of process. We are always known, I mean, internally as well as externally, Macquarie is more known for its entrepreneurial, freedom that's been given out to people who are running these businesses in different countries. We've now tried to balance that with some of the systems and processes which are necessary to become even bigger. So our targets are to become 2 times, 3 times the size that we are today in the next 5 to 10 years. And so I would say those are the things. I mean, this is pretty fundamental, basic, and most people understand, but I think the focus on systems kind of, in a country like India, which is growing so fast, kind of gets lost at times.
So let me then ask the last question to Mr. Shah. So we spoke a lot about interest rates with the governor, but that's one area that does not really impact Mrs. Bhattacharya's business very much, right? But again, from your perspective, Mr. Shah, in terms of the choices that you make, investments, the NBFC business, how much of a factor is, again, the fact that we might possibly be looking at a sustained period of relatively higher interest rates? Does that alter business models, or is it again at the end of the day a pass-through cost which you take into your stride and move on with life?
I think what all of us have seen over the years is that it's not whether interest rates are high or low. I think the two things that really matter to customers, I think one is not, they don't articulate as well, but I think the real interest rates matter a lot. So we have always seen where real interest rates are high and positive, all financial assets become more attractive. And when real interest rate, what we have now, is either zero or minus, real assets, owning a road, owning an office complex, because real assets will appreciate with inflation. So when I think the real interest rates do matter to end customers, whether they're making investment choices or whatever choices they're making. So I think keeping in mind the trajectory of the real interest rates is I have learned, an important thing. But I think what is also more important is when things like what is happening in the last 1 year, there is rapid change. The interest rate regime is changing, inflation regime is changing. I think it's your adaptability to change that becomes very important in organization. And I think all of us have spoken, we all have the list, a checklist that I should do this, I should do this, I should do this in the organization. Every CEO that I meet, if they can stop the car and take a pause and restart the car again, they know how to build it. They have the list. But I think all of us have a problem that we have to change the tires while the car is running. And as you said, QS, QT or whatever else, we have to, I think there is a status quo that will always be anchoring the organization. And there is I have learned that there is a finite capacity for change. If all organizations had infinite capacity for change, I think all CEOs will be very happy. Because by the time you become CEO, the one thing you want is change, but you find that organizations have a finite capacity for change. So what happens when interest rate environment is changing, a lot of your organization capacity ends up going into understanding how the customer needs are going to change in that. And I think to also just add to what you said about QSQT and all that, having been in capital markets for 30 years, what I've seen is we all think investors as one homogeneous class. They are not. They are all kinds of investors, and we all as companies, especially listed companies, we are effectively offering either a quick service at a restaurant or a fine dining experience. So it's up to, I think, the management to communicate to investors. If you are a QSR and you are offering a hamburger at 180 rupees and quick turnaround and standardization, you will get those kind of people frequenting you, investors coming to you. If you are a company which says, I'm going to take a 5-year this thing, build organization capacity to be agile and change and all that and communicate that, there are those investors also. Those are maybe fewer investors because the longer the view, the investors have to be that much more careful. The QSR investors are a larger group, but they are not the only group, is what I would say. So I think change is one which is going to be inevitable. And when you say banking beyond tomorrow, I think everybody, maybe banks will not be called banks, they will be called financial solution provider. Like in technology, most companies don't say I'm a database company. They call themselves technology solution provider of whether they offer cloud services or something else. I think we in financial services will have to get there, but how fast we change, how fast we can change is also important.
Oh, thank you very much. I don't think I should stand too much between what I hope is more than a hamburger. But again, I still believe that a few more questions from the audience might be in order. So hand it over.
Yeah, hello, good afternoon. Myself Ramesh Modi from Aarti Industries. My question is on from both banking and fintech side. Today the identity theft is a bigger problem locally and globally. So, every few days we keep on reading that somebody has falsified the document and somebody has misused some or other legal document, PAN, Aadhaar, etc. and availing the loans. Or 2 days back I was just reading that one laborer who was working in industry on a daily wage basis, he got an income tax notice of rupees 66 crore. And then it came to know that somebody has falsified his document and executed some financial transactions and he got the note. So this is the increasing problem, and I think this is not very widespread recognized as a problem, but yes, the identity theft is going to be a big problem, whether we are operating in fintech environment, NBFC or banking environment. See, sometime it happens you get a notice or a loan demand which you have never availed. So again, highlighting my question, how we tackle the identity theft problem in India. Thank you.
So I think Madam possibly spoke about that in the course of a conversation, but if you might want to add to that.
Yes, so basically, there will be lawlessness in society. You can't stop that, right? All you can do is try and make things as safe as possible. It's like when you leave your house, you put a lock on the door. So if you're looking at identity thefts, etc., one of the things, of course, that the providers of credit or the openers of accounts, they have to have very strong KYC processes. And today, on account of the fact that we have the Unique Identification Authority, actually speaking, checking your identity on the basis of biometrics is one way of determining whether this person is the right person to whom you are lending or for whom you're opening the account or not. Thereafter, there are several other solutions, IT solutions today, that gather the ecosystem data, the non-structured data, which was earlier not available, and then they can form a profile of the customer. In fact, just the other day, one of these NBFCs, and this is a very large payments company, was telling me that in 90 seconds, I know my borrower better than his own spouse does. Okay, so that's the kind of thing that they are coming up with, and these are all data models based on non-structured data usage. Data in the public domain, not even in the private domain. Plus you have the account aggregators today who can give you the private financial data if you so authorize them, and the banks or the lenders, NBFCs, can demand that you give us the data through the account aggregator. So there are very many systems by which you can make your system far more fraud proof. What it requires is both for the service provider as well as for the service taker to be aware of these, to be able to incorporate these in their processes, and to be a little process driven where these are concerned, so that you don't go by exception, but this is rather the rule. If that is done, while I am not saying this is not going to happen at all, it can definitely be minimized to a great extent.
One more question, ma'am, on this only. Continuing this question.
So I think,
like as you said.
Can we just move to the second one? We could come back again. With a bit of
Yeah,
time.
sure.
Thanks. Thanks.
Hello, I'm Pooja from IIT Bombay. Yeah, so I just want to ask a few questions regarding the academician point of view, as all are here in the practitioners. So my question is like this, I may go out of the context sometimes. So just want to know how far this Indian banking sector are efficient. This is the questions. If I just want to focus on, there is some studies say that foreign banks are 92.53% efficient than public and private sector bank, but the Friedman test shows that there is no significant difference. So can you put some light on this? Thank you so much.
So I always was hesitating asking the question to Ashish, because I thought the answer is something I might not like, but now that you've asked the question, we'll ask Ashish to reply to that.
I think the question is how do we measure efficiency, right? And I don't want to really limit my answer to saying we measure efficiency by cost income ratio or OPEX to asset ratio. If we use that parameter, I don't think Indian banks are inefficient. Some of the largest banks in the country are operating at cost income ratio which are among the lowest in the world. But I think particularly for India, which is still a growth economy, efficiency should not be measured just in terms of cost income ratio. It should be measured in terms of how much of the credit need of the society we are meeting, what is the degree of financial services we are able to provide, what is the cost at which we are able to provide it, right? So I think if you use that parameter, the fact that the credit penetration in India is barely 55% of GDP, I think there is still a lot of inefficiency in the system. Rashesh mentioned that there are large unmet credit needs. He mentioned that probably 75% of credit needs are met, but probably if you got into the underbanked segments, the unbanked segment, the SMEs, a much larger proportion of credit need is still not met by the formal system. And I would therefore then tend to agree with your first statistic that Indian banking is not efficient in terms of not being able to meet the entire credit needs of the economy.
I'll just add a small point to that. Strangely in India, whenever anybody saves money, they feel they are not getting a good enough return, maybe adjusted for inflation and tax and all. Strangely, anybody who is actually borrowing money feels it is very expensive. So obviously there is this thing called the intermediation cost, but hopefully with scale and technology and all the changes which are happening, I think Indian, I won't say only banking system, the financial system needs to bring the intermediation cost, which is what is given to the savers and what is paid by the users of capital. That intermediation cost needs to come down.
You know, I just want to give a different flavor to this efficiency piece. Efficiency, when you measure by credit penetration, insurance penetration, if you measure by all of those, yes, you may say that Indian banking is inefficient. However, if you measure from the fact that we are still a growing country, a developing country with a huge demographic, with a lot of people still below the poverty line, and if you look at our financial inclusion data, I can tell you for a fact that there are countries around the world, developed countries around the world, who look at our data and are surprised. Means I remember after having done the Prime Minister Jan Dhan Yojana, where we went from almost 55% penetration per family for one bank account to 98.7% penetration in a matter of 7 months. 7 months only. And when I talked about how that program was done to the then FDIC chairman, subsequently a whole team from them came in order to find out exactly how India had done this financial inclusion, because even the US has not been able to do that. Okay, so you have to understand what exactly is the challenge that we have and how we are doing it. Similarly, you know, you ask any banking system in any country, it's my challenge to do demonetization the way we did it. Absolutely no notice. 8 in the evening, you are told that 86% of the currency in circulation, 12% of GDP being in cash is going to be invalidated, and the day after, next day will be a holiday, and the day after you have to open 24,000 branches, 100,000 post offices, and another 20,000 branches of some other banks with new notes, with new processes, with new IT screens, with information to everybody to keep everybody, you know, calm down. You ask any other banking system to do it, it's my challenge, they will not be able to do it. So, you know, before we start talking about efficiencies only from the point of view of, you know, the cost to income and the return on your capital and things like that, the ROIs and the ROCs, you should, or the ROAs, you should definitely also look at the challenge before the Indian banking system and what we are doing for the country in order to increase growth. Just as RBI's mandate is inflation plus growth, so also the mandate in front of the Indian system, Indian banking system, is very much, you know, efficiency plus growth. Yes, we are getting there, we are still a developing nation, we have our own unique challenges, but given all those challenges, I still feel that the banking system in India is pretty efficient. That's a subjective opinion, not objective.
So just to again add to that, I'm actually very grateful to Ashish because he talked in terms of financial inclusion, credit penetration. So just a data point that when Madam talked of Jan Dhan accounts, 97% of Jan Dhan accounts are with public sector banks. I just request Ashish to put it at least in a footnote in one of his reports.
Hi, this is Pital Valaya. Y'all mentioned about interest rates and, you know, the potential increase in interest rates and how that might impact business. Given the fact that a large percentage of the developed world is also looking at a potential recession, whether it's Europe or US for some time, do you see the interest rates also as peaking only temporarily and with the regression coming back in a short to medium term time frame? What is your outlook on that?
So I think that was a question for the RBI governor. So I'm wondering who is going to step into the shoes of the RBI governor. So who is brave enough to answer a question that the RBI governor did not?
Actually, I cannot answer that, but I will, again, from the investor's point of view, I think the two hypotheses going around in the world is, one is inflation will remain high, and the other is recession will kill. I mean, in order to kill inflation, you will induce a recession and you know, slow down growth or kill growth. I think a lot of investors, Indian investors, have been asking us, of the two, how will India, you know, which one is maybe better for India, which is worse for India? From an investor's point of view, I think a recession, a global recession, if it's a short 1 year kind of recession, is good for India. of the two, because inflation is a lot worse for India. A recession is a slightly better outcome for India, because the good thing that happens, what follows recession is oil price comes down and cost of capital comes down, and India imports oil and capital. So I think if there is a hypothesis building around a short, hopefully a short global recession, it is more beneficial to India. If the hypothesis is that inflation is here and will stay high for a long time, India will have its impact.
Can I ask my question?
Yeah, so we'll just leave it now for the last two possibly. Otherwise the hamburgers will get cold.
Yeah. Hi, my name is Abhishek and I represent Kotak Mutual Fund. So just would like to add something to what ma'am said. Well, developed world is finding difficult to manage airports, forget the banking system. But coming back to the question, we spoke about fintechs and we've achieved a real milestone in the fintech world, especially in banking. And if I can say, we've reached the bottom line. If you want to spend 10 rupees also in a local shop, you can easily do through your mobile phones. So while we've achieved so much on one side, but we see a large slippage in the CIC and we don't see anything coming off. And this is a large pool of saving plus hoarding or whatever you want to call. It is having a large impact on the overall system, especially inflation. So what can be done from the banking side, or we do need regulations to act upon it? Because this is one of the big saving pool which is getting choked and impacting the overall economic system. Thank you.
I think Mr. Shah is our nominee again to step into the RBI governor's shoes.
So I'll give a couple of observations and I don't know whether that will answer your question entirely. I think one is we should not look at CIC in absolute terms, right? We should look at it always as a percentage of GDP. So, and I don't think CIC as a percent of GDP is increasing anymore. I think the fact that digitization is happening has meant the usage of cash has come down. Of course, there are parts in the economy where the usage is more limited than others. The other issue is that as a regulator or as a central bank, they look at the total money stock and the money multiplier, right? So CIC, while it's a leakage, it's really only a cost for the RBI. They just have to bear the cost of printing the money, right? Otherwise, if there's excess currency, the total stock of money is controlled by the RBI. The inflationary impact of it is controlled by the RBI based on what the money multiplier is. And actually on CIC, the multiplier doesn't work. So I don't think we should really think that just the fact that currency is high, that is a big challenge for growth. Because if inflationary pressures were potentially lower, then the overall stock of money can go up. So I don't think that by itself is a constraining factor.
I also think, given the fact that, GST is one of those instruments, of where it is formalizing the economy to a great extent, because every single player in the supply chain would like to get that input credit. So even if there is one player over there who's not interested in putting things in cash, the whole chain starts then, getting formalized. I think, that plus UPI, these are the two things that are major drivers in bringing down cash transactions. And as this goes on, frankly, the pandemic has really played into this very well, because even the small guys have begun transacting in a digital mode. So as more and more of this spreads, the ease of doing transaction, which is what we get in the digital mode, as that spreads, and as the need to do it because of the GST and the e-way bill, etc., that formalizes, I think, this is something that will definitely reduce.
So may I then, on behalf of everybody here, thank the panelists for what has been a very stimulating and such a frank discussion. So thank you very much.
I think before we do the other formalities, I have two quick questions. One for Rasesh. I can give a quick answer. 10 years hence, will it be Edelweiss Bank or something? Or will we actually have NBFCs, at least large ones, or will they get converted to banks? Number one. And two, for everyone, today still we say the share price goes by EPS. All the qualitative changes which you're talking of will not get embedded, or finally as an investor you will say that, look, you make profits, the QSQT, then your share price goes up. All this is probably, yeah, what's your view on that? And Rasesh, first for you.
So, actually, I think one of the things I would like, I think all of us, we have very identity statement. I am a bank, I am a mutual fund, I am an NBFC. I think if we become more customer centric, as I said earlier, we'll all become financial solution provider. So 10 years down the line, will we be financial solution provider? Absolutely yes. I think there are so many opportunities that are there. I personally think banking will become very capital intensive and increasingly so from an equity capital point of view. If you want to churn your capital, there are opportunities like asset management, wealth management, even NBFC will become more asset light. So as of now, we are a first generation entrepreneur company. Capital is always going to be scarce with us. So I think we will get more into areas where capital efficiency will be a lot higher given our limited amount of capital.
You still not answered the question whether it will be a bank, will NBFCs exist, or will they all
So
get
as I
converted to
said,
banks?
actually 10 years down the line, I think things will change. We'll all become financial solution providers in some way.
Now,
or
how
the
about the pricing? It's still going to be the EPS which matters, or?
So I think there's no disconnect between the two. So I think if you have the technology upgrade, the EPS will also come through. So I think there's no disconnect between the two. Both will move hand in hand.
Okay, thanks a lot. So now may I request our MD, Mr. Sanjeev Chandra, to give a memento to our guests. We'll take on mask, we'll take photographs. To Ms. Arundhati Bhattacharya first. For Ashish. It's for Deep. And now to Rasesh. A slight reversal of roles. Ma'am, you will have to give a memento to Sanjeev. Okay, thanks a lot. I'll take it at the end. Okay, thanks a lot. This session has lasted for longer than what we had expected. So maybe Akhil, we have learned a lesson that even 1 hour is not really adequate. Yeah? We've crossed 1 hour. Yeah, we assemble in the next half an hour. I would like everybody to get back. Yeah? We're having a lunch break right now, okay? Thanks.
cried for you 1,000 times. What you gonna do? What you gonna do? What you gonna do? What you gonna do? Love and see what you gonna do? What you gonna do? What you gonna do? What you gonna do? Love and see what you gonna do? What you
Attention everyone, we'll be starting the next session. So I would request you all to please come and sit down. Give me exactly 5 minutes, please. You all may bring your lunch plates to the table or your chair, wherever you all are sitting. All right? Thank you. 5 minutes, please. Yeah. In fact, we have a special session now. It's going to be a fireside chat session with Mr. Dilip Asbe, the MD and CEO of NPCI. It is going to be conducted by Akhil Handa, our Chief Digital Officer. So kindly come and take your seats. We are sitting at the table, whatever it is. Please hurry up. You all.
Dilip, just checking in. Can you hear me?
Yes, I can hear you.
Great, excellent. So good afternoon everyone. We have a very exciting speaker coming up next. I know the lunch is delicious. I promise this conversation will be even more so. So as quickly as we can wrap up the lunch, please come around and you can bring your lunch plates over to the table and finish it. Before we move forward, let me introduce our next guest. Dilip Asbe, the CEO of NPCI. Of course, he's someone who needs no introduction, but let me nonetheless do that. So, Dilip is the current CEO of NPCI. Prior to this, he was the Chief Operating Officer at NPCI. He's played a pivotal role in designing, building, operationalizing, and management of large-scale innovative payments processing platforms, like the UPI, BHIM, IMPS, and propelling the homegrown network that is RuPay to the pole position it is in today. Recently, Dilip was awarded the Change Maker of the Year award for the revolutionary product that is UPI. And he's of course got multiple awards, but I think the most sweet one, the sweetest, has been the ET Award 2018 for the Policy Change Agent of the Year. So, ladies and gentlemen, please put your hands together for Dilip Asbe. Dilip, first, thank you very much for joining us at, I know Dilip is very busy traveling and he very kindly agreed to squeeze in the time and have an interaction with us today. So thank you very much, Dilip.
Thank you so much, Akhil, and I first apologize to all the audience being present there. I think I missed an opportunity to be there to experience such an exciting atmosphere, and I can feel and see the buzz since morning. Even when the governor spoke, it's a very vibrant atmosphere.
Right. No, we were pretty honored by the governor spending the time with us this morning. He touched upon multiple things, including, the growth of digital payments, innovation, and of course, he also rounded up with cybersecurity. So over the course of the next half an hour, I intend to touch upon much of it. So let's start off with some crystal ball glazing. Now, we've seen the payments volume, which has grown up rapidly over the last 4 to 5 years. UPI has been a phenomenal success. It's really overshadowed much of the successes of even some of the other payment products, which are equally successful, be it IMPS, be it the RuPay network. So if we look at the next 5 years, Dilip, what are the key milestones we are looking at?
So Akhil, when we look at the past, right, and we have seen some good kind of takeoff of many of the platforms, and actually as you rightly said, we don't look at some of the platforms which have not scaled up as UPI, but are immensely successful and actually adding a lot of value like UPI. And just to give a couple of examples, like toll collection, for example, 95% of the toll that is collected today on the national highways, right? The concessionaire actually gets the money within 3 hours or 4 hours after the actual vehicle is passed, right? So you look at it, initially it used to take about 2 weeks, 3 weeks to get the money back. Look at the actual toll collection amount has actually more than doubled, or I think it's closer to 3 times in just last 2.5, 3 years. So what it means is it has been able to, obviously it has to grow a lot, it has to bring in a lot more improvements, but what I'm trying to tell is, the waiting time of the citizens, the actual collection value, the efficiency in getting the money faster back to the concessionaire who has built the road. So in all aspects, it has actually added a lot of value to the country, and some of the other products I don't want to spend our time maybe during the course of the conversation we talk about. Now, at this stage, we keep thinking that what more has to happen in next 5 years' time, right? And if I just have to give a high-level number, when we look at current UPI, about 250 million digital users in the country. Technically, it can grow up to 750 million as looking at the adult population. Smartphones, now we have the feature phone solution on UPI. So technically, we can grow up to 250 million, 750 million users. Even on the merchant side, we have about 50 million merchants, and it can potentially grow up to 100 plus million merchants. And so, if you actually equate the 3x growth on both sides, technically about 10x growth is still possible, right? So we are somewhere at the beginning of the S-curve of the journey in my assessment. Obviously, not many things to be done. What we have done today is not sufficient to take that 10x growth. But I'm talking about lot many things which are underway, right? And I believe that when we look at this 5 years, a billion-a-day vision is not very far off, right? In that sense. Today, when you look at platforms like UPI, we do about 400 million customer-initiated transaction, right? Both financial and non-financial put together. And to service this 400 million transactions, our UPI platform service about 4 billion APIs on a daily basis, right? Request response put together, 4 billion requests and 4 billion responses, right? Together. So 8 billion individual requests. So it's kind of scaled up, it has proven its mettle, but the future is brighter than where we stand today.
Excellent. So the key milestone we're watching for is 1 billion transactions a day, which is almost nearly the universal, adult population doing one transaction a day. So which is very ambitious, nearly 10 times, I think 15 times from where we are right now. So what are the key innovations you see that will propel us to the 10 times volume? Will it be UPI? Will it be micropayments, IoT? How should we look at it?
See, the way we look at it at NPCI, we look at it like combination of all will drive to this, 10x volume than what we stand today. So it will be the tokenization, getting the card tokenized, getting the contactless transactions on card. NCMC, we are betting very heavily on NCMC to ensure that, we do this low ticket transaction in super efficient way, right? Now, I think the large ticket, predominantly more than 5,000, 10,000, actually, I don't think anybody is giving that much of cash and doing the transaction. But I think the huge conversion scope exists on the low ticket, right? So how do we do the low ticket very efficiently? So UPI Lite is another example. I'm sure everybody has heard about it in terms of doing the near offline transactions on UPI, so that we are able to avoid that debit leg to the customer's bank. So we are looking at IoT. We are looking at UPI on the go. In fact, in the Prime Minister's function at Ahmedabad, the Digital India function, we launched the variety of form factors on UPI on the go. We are also looking at expanding the toll scenarios, trying to bring it to parking, trying to bring it to the petrol stations. So variety of things that are BBPS, I think, which is one of the again raring to scale up to the next level. So variety of things which we are doing at NPCI to look at that billion a day or a 10x volume what we can call about. So I don't think there is a single bullet here, and I think we'll have to keep on working on variety of things, because see, I think the one thing which I personally like is Reserve Bank of India's approach of having a consumer choice, right? So today he wants to pay back to a merchant. There are variety of choices available using the cards, UPI or wallets. Similarly, I want to send money to somebody. Again, there are variety of choices, including NEFT, IMPS, UPI. So I'm saying that the variety of kind of a bouquet of Indian payment systems, which is innovative from all aspects, and which kind of increases the speed of money, contributes to the economy. I think we will look at growth in most of these payment systems which we have set up today.
Right. So very exciting times ahead. In the last discussion we had Ashish talk about Ashish Gupta from Credit Suisse, who was very prescient in calling out the house of debt, but that's a separate conversation. So he talked about how cash in circulation is now kind of stabilized, and we saw it rise for a period of time, even co-terminus with the exponential rise of digital payments. But now it looks like the CIC has stabilized. And we've seen that as of now, we are nearly at about, I think, 40 to 45% of the transactions by value is in digital. If you look at 5 years down, what do you think that mix would look like?
See, the cash in circulation, again, it's a complex topic because of, one side, and because of multiple reasons, let me articulate those reasons. One is, government is trying to bring in most of the last 5 years, we have seen that most of the cash benefit transfer back to the direct benefit transfers, right? So what has happened is, variety of the benefits which were actually going part of as an informal economy by means of cash, now those are part of formal economy, right? So that's where you see the customer withdrawing the cash, and because of the direct benefit transfer, large number of citizens getting part of the formal economy, right? And there you see the large number of cash outs happening back on a micro ATMs last 5 years. The second part is because of the COVID, right? The cash, the holding cash has increased, and you could have seen that in the average ticket size increase in the ATM and point of sale, right? So this is the second trend which we have seen. Now the counter trend on digital payments, again going up big time. But I still believe that, unless we see that 1/3 population on both demand and supply side having the digital payment traction is very critical for start seeing some reduction in cash in circulation. And I think maybe a 12 to 18 month window, we should be able to start seeing that in our assessment, Akhil. And any developed economy is near, either it's in single digit of the cash to cash in circulation to GDP ratio, or near that single digit, right? The closer to the 10 mark, right? And I strongly believe that next 5 years, knowing that the affinity of cash to such a large diverse population at different education and awareness levels, I think we should, it's a great target to have, to aspire to have at least a single digit or a closer single digit, closer to the single digit cash in circulation to GDP ratio.
Right. Now, just staying on the thematic of the trends, you talked about cash transfers, the direct benefit transfers, and large part of it is happening to the Jan Dhan accounts. And our internal data, we've seen that the digital activation rates in the rural population that we have as a customers is now, gone above the metro population. Of course, there's a base effect as well. But is this something that you see as a trend going forward, that rural will now lead the wave to maybe the next 2x, 3x, 4x in terms of payments?
100%, and I think this is the objective as well, right? I think the innovation in payment system is not to cannibalize the existing payment systems, but to expand the market. And we at NPCI work very closely with the ecosystem partners, which is banks, fintechs, to see, and you will see that, and obviously the data is being shown in the tier 2, tier 3 towns. You started seeing the UPI QR codes. We see the huge traction on payments. People say that pay by UPI, pay by the leading apps like PhonePe, Paytm, GPay, or the bank apps. So I think we have started seeing the shift to digital, but obviously, the shift to digital happens on a customer choice and customer comfort. So I don't think we are rushing to that particular point, but allowing the customers to adopt slowly to the digital payments experience.
Right. Now, see, over the last few years, we've seen that there have been non-banks who have, kind of cornered a dominant market share in certain areas and largely in the payment systems. There are, UPI is an example where banks overall, in terms of the customer experience layer, have all been packed into, a corner, right? And there are a couple of very large platforms, big technology firms who have now gotten that engagement model humming with the customers. Now, if you were to be in let's say a banker's shoes, what are some of the things that banks can do? I'm just being selfish here, right? What are some of the things we can do to regain that market share? So your thoughts?
So, actually the way I look at it, and somehow I feel that while the customer experience, the non-banks might have taken the lead, today the way the access to the UPI was defined, it's always through the banks, and banks also playing, the only banks can play the PSP role in that sense. And the way UPI architecture works, the way we have unbundled, that the money flow remains within the bank, which is the trusted and secure architecture, and the experience is given by the front-end app. Now, when you look at it, and just step back, I think it's a great question, and I have also personally thought about it a number of times. See, today, what is the customer need, right? And if you look at the top 250 million customers or top 200 million customers who are driving the majority of these UPI transactions, have more than one account, right? And that's my, whatever the data shows, and I'm just looked at high level, not at detail, but and when you look at that more than one account, the customer has a need to manage these two accounts very in a simple and secure manner, right? So when you look at traditionally the banks, the way banks have driven the digitalizations, which is using the internet banking and mobile banking, you actually get a single view, right? It's a great experience, but still I have to go back to the internet banking, go back to the mobile banking, and I can only see my account view. I think, and this is where UPI one-to-many and many-to-one principle worked actually, if you really ask me, because there was an inherent need that I add up my all accounts into one bank and then able to do the transaction, whichever, whether it's a fund management, both the accounts or, and today when you look at it, even the large bank or the market share is between 5% to 30%, right? So traditionally what happens is the 95 to 70% is actually outside the bank, right? And today your customer is fully connected to that 95 to 70%, right? So today he wants to integratedly bank with that, right? And when you look at, even that 5% to 30%, due to multiple accounts, you would see that 40-50% will have the bank's account as a primary account and some other banks as a secondary account. The another 40-50% of that segment will look at, the bank's account will be the secondary account and some other bank's account will be the primary account. So technically, I'm just saying that what customers were looking at is a one-stop shop, right? Where he can add his all accounts and start using it, right? And I think the TPAPs and the UPI experience actually solved that problem. And this is where I think our banks took a second step. Obviously, there were many issues which we were trying to solve together. Until you are aware, there are many other priorities which we are trying to solve. But I think what happened is, and now I think the banks are understanding that, right? Today you look at iMobile, right? iMobile is there solving all payments need irrespective of where you bring your account, right? And today we are talking to, the SBI. I recently met SBI chairman on YONO. Can YONO be the app for every Indian, while the SBI is a banker to every Indian, but similarly the Bob World, right? Can it give the experience of that agnostic experience, come to me and, I will give you the best in class payment experience, irrespective of where you have your account of, right? I think this experience has been missing, and, if you look at the trust in the banking system in India is very, very high. I think it's just a technology refresh we require. at the bank side, and create that independent experience, independent view. And I can guarantee you that once it's there, I don't see a challenge. Because and the other aspect which I would like to drive your point to, see, these 250 million users have already registered on UPI. They have already set the PIN. So technically it's a zero-touch onboarding, right? Even if, for example, any bank wants to launch a UPI app, and the only friction is download the app. The rest is all set. The same PIN is going to work, same credentials are going to work, right? So it's not a big challenge in that sense, provided we get it on at the top of our mind, right? Top of the banker's mind, if I may say so.
Great, thank you. Now, shifting gears, so UPI has been a phenomenal success in India, and I'm aware that there's effort to internationalize it. There has been G2G conversations around it. NPCI International has been taking some of the successes externally, and it's a great Make in India product that we are taking to the world. But the progress there has been slower than one would imagine. Now, that also given the fact that, I believe the Indian digital payments ecosystem is miles ahead of some of the other geographies that we've taken this to. So, when do you think we will see an inflection point in the uptake in some of the technologies that we are putting out there? Because, obviously, if we do that export, then, our customers who then happen to be either NRIs or even tourists who go around, it's much less cost, transactions, availability, etc., that they can have transactions on. So your thoughts on that?
See, what has happened is, the NIPL has been formed last year, and, we have been trying to work with many countries now, as good as, 30 to 40 countries now. The dialogue is in progress. Some of the countries we have seen a success, whether it's Nepal or a couple of African countries. The cross-border has been also a lot of action. We have seen that, we have connected back to Singapore now, and UAE now for bilateral connections. Bhutan has been already connected. So, what we are looking at, see, because of the COVID, the travel was almost like on the hold, and now we started seeing the pickup on travel. And I think now we should start seeing, at least in the geographies where we are present in terms of cross-border, to start picking up some volumes. That's point number one. Point number two is, when we look at our stack going back to the other countries, I think the government and RBI are very keen that, the way India has built up the public goods, can India help the other countries, right? And to building up their domestic payments, to be self-reliant in the today's geopolitical situation. I am sure that, every country, irrespective of their size, they would want to be self-reliant, right? At least for the domestic payments in that sense. And this is where a lot of work is happening, Akhil, and I think next couple of years you will start seeing a lot of such examples, that while we are trying to help the domestic payments of that particular country, we are also able to build up the cross-border, efficient cross-border mechanism to build the connections. Obviously, the government to government and the regulator to regulator connect is super important, without which it cannot happen. And I think today many countries now are looking at, we hope that Mauritius happens in next few months, and so variety of countries now looking at where there is a good outbound travel to build up a very efficient and give the better experience of the cross-border transactions. Now, obviously it is a time-consuming activity. Actually, it's not like two domestic players connecting to each other. It may take some time, but we see a solid story unfolding.
Right. So, NPCI is the National Payments Corporation of India, and payments being the operative term. But now, what we see in the digital space, and NPCI has been such a fantastic roaring success in payments. But, in the digital space, across the domain of banking and financial services, there's sort of, the boundaries between payments or credit, the liabilities franchise, they are kind of getting metamorphosed. Now there's a spectrum emerging. So will NPCI also get into some of the adjacencies? More like perhaps a digital finance corporation of India?
It's a great question, and see, okay, let me just step back. See, okay, I think there is a lot more to be done on payments, right? And when you look at, we would have seen, some of the initiatives like Future Phone, which came out of the RBI Sandbox initiative, the UPI Lite, the monetary policy also announced the RuPay credit on UPI. So we are actually in a scale up of BPS, the auto pay, the recurring payments revolution, what's happening in India. We do 5 million mandates on a monthly basis, successful mandates on UPI recurring payments, and now the amount has been increased from 5,000 to 15,000 to by RBI. So there is lot more, we keep talking in NPCI that there is never a dull moment. So there is enough on our plate to deliver. We are hoping that the credit card, RuPay credit card should on UPI should get operationalized in a couple of months' time. There are, we are talking to Mob cards, SBI cards, Axis Bank, Union. A lot of banks have given the interest to us, and we are hoping that we should be able to submit our proposal to RBI maybe in a next 10 days time, and once we get the approval, we should be able to start in 2 months' time. So a lot of work is happening. We are looking at how do we expand the market, right? And the objective is, how do we go back to 250 million users? How the banks can start doing smaller credits? How does 50 million merchants start accepting credit, which are not today? Obviously, we have to take care of the small merchant, protecting the MD. How do we don't charge the small merchant while the existing credit card using merchants can continue to pay? So many things are on our plate. The second part is, I fully agree with you that the boundaries are fading up, and a lot more new rules. And I think it's great to be in India at this moment, right? When you look at ONDC, OCEN, and the account aggregator, the health stack is. So I think it's going to be it's only exciting. We are actively involved in most of the initiatives up here, but obviously whether NPCI plays what role NPCI plays will be decided by RBI.
Fantastic, Dilip. Thank you very much. I think it's about time we open up the discussion to questions from the audience. So, can we have a question? Okay.
Hi Dilip, Sanjeev Saraf from Bob Capital. Good to see you and couldn't meet you today. The question is that while, as Akhil said, and correctly you also mentioned that the journey from just being a payment space to all digital payments, why haven't you at least thought about giving a solution to the equity markets? Because the equity markets payments are IPOs is just a starting point. But on a daily basis, the kind of volumes that go to the stock markets, if there was a mechanism in a similar fashion where payments could be made as good as UPI, the problem is the POA and the mandate and the regulation and the Stamping Act and all that. Are you doing something about it? That's the question.
Right.
So technically, this is a question for the market regulator and SEBI. But let me try to answer from a technical standpoint, because the world is more complex than a pure technical use. So let me add that disclaimer. So Sanjeev, the way I look at it, I think while the payment, whatever the RBI's innovation-led policies have pushed the needle on the digital payments, and I think the digital payments can be used by the market regulator very efficiently, very rightly said and suggested by you. And we also work very closely along with RBI, with the market regulator to see how we can be of use to them, right? To bring in more efficiency, more. And one of the examples you could have looked at the IPO as an example, right? Today looked at a very decent IPO. So over 50% applicants are on UPI, and we are now trying to change the architecture from pull to push, right? So which will kind of further drive the volumes of usage of UPI in the primary market. The secondary market also, I am very sure that you can leverage the capability which has been built by the digital payments, but obviously again, it's up to SEBI and up to the RBI to make use of digital payments in the. I think the use cases can emerge, right? Because we have proven the metal, right? Whether it's UPI, whether it's NACH. Now we have multiple payment systems during the day, so in a sense. The risk of the settlement has actually come down in that sense. So if we want to bring down the settlement timelines in the other transactions, take example of equity market, it can be brought down. I don't see any issue in that. Obviously, it has to be studied by the market regulators as in a totality, and I'm sure they would try to use the efficiency of payment systems into their operations as well in due course.
Right. Who's next? Okay. All right, we have one there. Okay. Well.
Good afternoon, Dilip. I am Deepesh. I am a faculty, and I would like to know how would you like to reorient the academia, taking a proactive steps in the interior part of the country. Yeah, so if you may.
Yeah, so this is again a great question, and we have been working with to try to see that how this whole awareness digital starts from the initial stage, and we have been successful with one of the boards, state board CBSE, to add the digital payment chapter into the school curriculum, and we have been working with the Central Education Ministry and at various states to include some awareness at the right at the school level, because I think the learning is very strong at the early age in life, and hoping that to get this included back at the right levels. But obviously, every state board has its own time to make changes back in the make additions in the learning course. But I think the efforts are on, and it's a great question. We at NPCI, we are very keen that every school board adds the chapter back on a digital payments, the digital services and the payment system as a whole, right? From an inclusion perspective as well into the school curriculum. So the efforts are on, and we believe it should have been done yesterday, but obviously we as a country we always want to do more than what we think. Yeah.
Right. Thanks. And before we move to the next question, I think just dovetailing with the question on spreading awareness, creating awareness. We've also seen a proliferation of cyber fraud in digital payments. Of course, I think as a proportion it remains contained, but given that digital payments in itself is growing exponentially, then the numbers do become large. So what would be the prescription on that front, Dilip?
So, and again, there is no silver bullet on this, right? We as an ecosystem, as you rightly said, while the fraud levels are much below the existing international standards, it is monitored very closely by NPCI as well as the Reserve Bank of India. And what happens is today, and I'll give one example. You go back to the search engine, you search for a bank call center, you see the fake link there, and you call up there, you believe that you have searched that link and it's a right link, and you call up, you trust, you are talking to the bank official there, and so variety of things has to be done. While NPCI has deployed the AI-backed fraud management solution, the ecosystem also has to make a lot of changes, right? So we require a central fraud repository. We need a mechanism to deal with these fake links fake ads at the social platforms. So variety of things that should be done. Actually, we keep working very closely with the Ministry of Home Affairs, the state cyber chiefs. The syndicated fraud efforts, right, are very high. And again, while the cyber sector, the law and order is a federal issue, so we keep working with the state governments to see that whether the pockets, how to deal with those pockets which are originating frauds in the payment system. So a lot of work. It's an ongoing journey. I don't think. It's going to continuous effort for next few years till the time we believe that the reasonable awareness and education is in place as far as the digital finance is concerned.
Right. The silver lining for me in this is some of the modus I've seen, Dilip, for frauds is just reassures me of the smartness and ingenuity of the population of the country. And some of the guys have come up with such fantastic ways to defraud. If only it was channelized well, I think it would be a very different scenario. But look, thank you very much for joining us, and it's been a pleasure.
Mr. Osbe, we are really thankful to you for joining us. It's on VC. We would have much better liked to have you out here maybe next time. But I think the messages which have been sent across have been thought-provoking and direct. I'm sure all of us have benefited a lot from it. Thank you.
Thank you. I apologize. Thank you.
It's possible you can stand and we can get a photograph taken. So okay. We can have it for a record.
Now, why don't you join me? Sure. Digital, well, I think very appropriate for Dilip.
Just hang on for a minute or so, we'll get a photograph taken.
Right. Thank you very much, Dilip.
Thank you.
And thanks a lot, Akhil, for conducting this in a different way. It's a good idea, which has worked. Okay, can we have the arrangements made for the next session? In the interest of time, I'm starting my announcements until we make all the arrangements. This particular session is called New Frontiers in Financial Inclusion. We have seen that the Reserve Bank of India Governor, Mr. Shaktikanta Das, had spoken a lot about financial inclusion. And I think the very encouraging news which he gave us was that the Financial Inclusion Index has improved substantially over 2019. Now, we all know that financial inclusion is something which both the government as well as RBI have been buttressing over and over again. And when we see things like Jan Dhan, we see some things like Mudra accounts, priority sector lending, I think all this falls within this particular ambit. Now, when we're talking of banking for beyond tomorrow, we're trying to explore what could be the new frontiers which we'll be exploring. And for this, we have another high-level panel which will be sharing their views with you. May I first welcome or request Mr. Vikramaditya Kichi to come on stage. Kichi sir, please. Mr. Anil Gupta, partner Microsave Consulting. He will be moderating the session. Welcome, Anil. First. Mr. Amit Arora from the World Bank. Third seat, please. Ms. Kalpana Ajayan, Regional Head of South Asia Women's World Bank. Welcome, ma'am. And last, Ms. Sucharita Mukherjee, the co-founder and CEO of Calidofin. And again, I would request Anil to provide the context, and then you can start your quizzing session. Thanks.
Thank you. Thank you very much. I hope I am audible to all. Okay. So I think we are going to do the second session after the lunch. Probably sleep might be setting in. So.
But we are not cutting down on your time. Please take
Yeah, yeah. So we have about 45 minutes, correct? Yeah. So maybe like we will change the gears. We have been hearing a lot about what's happening in the financial world. Probably we are trying to deep dive into financial inclusion space. And before we deep dive, I just want that probably let me do a kind of a count that let me ask a simple question. How many of you think that you are financially healthy? So those of you who think they are financially healthy, please raise your hand. Unfortunately, there are not many hands. I also know if I ask the other question, those of you who think they are not financially healthy, I don't see many hands. Or how many hands will raise up if you think that you are not financially healthy? So most of the people are still undecided. I think that's the nature of our work. And maybe let me move forward. In the morning, I received a mail from my bank. It says that we want to assess your financial fitness. So this was a new word. In our world, we typically talk about financial health, financial well-being, and why I'm talking about financial health. See, so far our focus has always been on financial inclusion. Financial inclusion has its set of parameters on which we are trying to assess the financial inclusion, but financial health is little evolved. So I'll try to give you a brief context before I come to my fellow panelists. So first is that if you see that what is that we have done in the space of financial inclusion, two things. One is that which Governor also spoke about, financial inclusion index, which covers basically access, usage and the quality. There are 97 different sub-parameters around that, and we have done fairly well. In the sense, the last data that I have, it says that we moved from 43.4 in 2017 to 53.9 in 2021. So it's a great achievement considering the diverse and the complex countries that we are. Second very interesting thing which was not directly mentioned so far, but it was discussed, it's all about digital payment index. So Dilip also spoke about how we have progressed, rather leapfrogged in the space of digital payments, and Governor also mentioned in his morning remarks. So this also contains a set of parameters, and we have moved very fast actually in that. So the data that I have, the March 18 was considered as base year, and in that base year, it was 100. We have gone to 304 in September 21. And the way we are growing, we may be shooting through the roof actually in this space. My question actually continues to remain that, is that enough? We have already focused on, say, access. Almost every household has one active account in India. A lot of people use the financial services, and when I say lot, I mean to say it's a number. If I look at in terms of percentage, probably it's not as a rosy picture as we would like to believe. So what is really happening? Actually, let's look at it from the customer perspective. What is that customer want? And that includes a lot of customers like us, though we are very well financially served. First is that they want a rightly designed and rightly delivered financial services that they can use based on their lives. So it's not that, I think someone from Edelweiss in the morning mentioned that home loan is a home loan. So they don't want home loan, probably they want something else under the garb of home loan. So there are different requirements, and hence they are looking for different type of solutions in the product. And secondly, they want to use this product the way they can use it. So probably here fintechs can help, and they can bring that kind of navigation or that kind of user interface which people can potentially use. The third is that we also want that financial services, they need to integrate ultimately with real economy. Because real economy is what is going to drive the social inclusion in the country, and that currency is the common denominator. So that is how it has to integrate with the real economy. And we have seen the digital revolution that we have in India, as Dilip also said that we are in the stack era. So there are multiple stacks that we have, and we are building much more on top of that. So we have all the right ingredients with us. So if I were to say that what exactly the financial health means, little complicated, but this is what it says. Financial health is a state in which an individual can meet current needs, absorb financial shocks, and pursue financial goals. Financially healthy individuals also feel secure about their finances. So it looks little loaded. Let me try to unpack it. So basically, it has 4 components, what we classically call it spend, save, borrow, and plan. Spend means like you spend based on what you earn. So you save. So the second, it leads to saving. So saving means you save on the basis of what you earn, and there is a threshold defined, at least 10% of your earning you should be saving for specific goal purposes. If person need to borrow, they borrow based on the requirement, but again there is a threshold so that there is less of over indebtedness. And plan is something that you provide for any unforeseen circumstances, or you plan for your long term, which could be something like a retirement plan. And why we talk about this, that what it leads to. So there are 3 things which happen. First is that financial security, that I think most of the people in this room, they are fairly financially secure, because they are able to meet their current and near current demand from the money that they have. Second is all about the financial resilience, and there has been a lot of focus on the resilience and the financial resilience side, more so during this COVID era when people lost the job. There was another estimate which came out in the market. We said that about 150 to 200 million people, they fell below the poverty line. So this basically, this is a shock in their lives, and resilience allows them to make sure that they are able to overcome those shocks, which may be temporary in nature or maybe little long term, the way we have seen in COVID. Third is all about that having the financial control, and financial control means that a feeling of control that we have on the finances. Very interestingly, there is an organization by the name Gallup. It conducted a survey of 10 countries, and it tried to understand that how many people feel that they are financially secure and they are in control of their finances. You'll be surprised to find what it comes out. Maybe 2 or 3 pointers for all of you. One is that GDP or having account, it has no relationship with someone being financially secure or in control of the finances. Second, a lot of people feel that they are in control of their finances, but the data on the basis of their financial security says otherwise. For example, in Bangladesh, only 7% of the people were financially secure versus 34% of people, they felt they were in control of their finances. So it's a revealing fact, and probably because this is a room is full of bankers, we understand the language of money, and probably that's the reason I saw very limited hands here. So with that, actually, let me move to my panelists. So we have very interesting panel here. So we have people, those who are doing it on the ground, by way of running their own organizations, and we have people, those who are we are working with multiple implementing partners, and they have global experiences. So let me first start with Amit and Kalpana. See, I think financial health has been a little bit complicated. It has been a little hazy. Like a lot of people find it difficult to understand and appreciate. And in the context of that, and most of the focus has always been on access of the services, and recently on uses. Quality is a relative component which has recently been brought into focus even by the Financial Inclusion Index. So how do you see this moving from, say, financial inclusion to financial health, which looks little futuristic, becoming mainstream? And any experience that you have based on the work that you do with your partners that you want to share with the audience here? So Amit, maybe you can start, then Kalpana can join in.
Thanks. I've actually always been a bank bencher, so a little uncomfortable starting this, but nevertheless. So Anil, I'll just step back and try and define the problem in a little different way, as shortly as I can. See, there are two ecosystems here. One is India and one is Bharat, as we all generally call, and both need to be seen applying a different lens. So financial health in Bharat is very different from financial health in India. So the Bharat part is largely very well catered to by the public sector bank ecosystem, and I don't think they get enough appreciation for what has happened in this country, or for that matter cooperative banks, the RRBs, which are part of the PSU banks. That's phenomenal work, as you said, in terms of access. So there, about 60 crore people are still at a stage where they've begun to move from access to usage. So we need to focus on usage. That's an intermediate step. And these are early days of that stage. Once we've covered ground on usage, I think that would be a very good stepping stone, which will automatically lead us to financial health in that ecosystem. So what is it that we need to work more finely in usage? If I can give a couple of examples. Since the topic here is financial health, can I go to a BC agent and ask for a credit bureau report of my own today? No, unlikely. I have not seen, and I work probably with all the corporate BCs in the bank, and I've been to the ground. Why not? That's a starting point. It's my report card to see where I stand today. But for some reason it's not available. So these are use cases that we need to work on finely. Identify what is the demand side need. Since as somebody said in the earlier session, that either we are a QSR or we are a fine dining. So in between there is a dhaba who provides very good quality food at very reasonable price and very quickly. So mind share for this dhaba in this room or the larger ecosystem is very limited. So we need to figure out solutions for that segment. Can I actually go to a BC agent and say, "Mera recurring deposit आप मेरे savings account में transfer कर दीजिए. I want a premature withdrawal," or for that matter, fixed deposit. That should be so easy today because of the infrastructure that we have. The risks are near zero. No business has zero risk. There is some risk in everything, but we've come a long way to figure out that all this can happen. So once we build upon these use cases, then I think we can move towards financial health. And like this, there are many areas that we need to cover. Can a PAX transfer money to their farmer member today electronically through the assisted mode? Likewise, can SHG transfer money to an SHG member, for the loan that SHG has taken from the bank? That doesn't seem to be possible today. So there are, like this, many solutions which need to be tapped, which can bring in a lot of efficiency, business cases on scale and sustainability, and we've just begun to scratch that surface. So for that segment, we need to focus more on building those use cases, which will automatically then build metrics for quality and lead to addressing the question of financial health. I'll park it for now. When it comes to India, we have large players who are coming up. A lot of partnerships are happening. Fintech players, co-lending, so on and so forth. So if you're able to do this in a responsible fashion, this will get addressed to an extent. But I will only say we need to look more at a household level than at an individual level to get a comprehensive picture. But more on that later. I don't want to take more time and pass it on to colleague here.
First off, good afternoon, and it's such a pleasure to be here, and it's even more of a pleasure to be in the company of my fellow panelists. As far as women's world banking is concerned, we believe financial inclusion is just the means to an end. We've always believed that a woman's economic empowerment is really the end goal. So we've never ever looked at financial inclusion with a narrow piece, but if it has to be women's economic empowerment, then we look at it from a point of four four aspects of economic empowerment. And we truly believe that that is indicative of the financial health of the woman. So when we look at the four aspects, the first aspect, of course, is the material aspect. I mean, obviously, if she's financially healthy, she's in a position to build her assets, has access to credit, etc. So that's the obvious material piece. What we believe will also add to the empowerment of the woman is knowledge and skill, addition of that. So she should be, if she has to feel empowered, she definitely has to have access to this knowledge and skills. Knowledge and skills in order to do what? In order to take the right decision, right? And that would in turn provide her with a voice in the decision making of the family. So what we call as, perceptual and relational, we follow the Mata Chen model of empowerment. And so this all-roundedness is what we call as empowerment. And to me, financial health is the path, is the step towards that, yeah. How do we actually, the two areas where Women's World Banking has been focusing on, because in order to take her there, the first piece is actually around the design of the products. We have this concept of women-centric design, and I'm going to make a statement here which will probably raise some, comments. But we genuinely believe that there is no gender-neutral product design when it comes to financial service products. Because gender-neutral, we, in our experience, believes is always, it always excludes women, given the context from which the woman comes. Whereas, if you have a woman-centric design, it automatically takes care of men and the men's needs as well. So we've been doing a lot of work around women-centric design of products, and so that's one area where we worked with our partners around the world. We operate in 60 countries, and this is a very key input that we are able to provide, in taking care of the women's empowerment. The second piece where we have been doing work is something that's been, it's been talked about from morning, and it kind of resonated with me when I was listening to it, which is this whole, digital and financial literacy. I mean, financial literacy, I think, is passé, everybody understands it. But I think today, with the proliferation of digital financial services, this whole digital literacy is such a critical component, and I don't think enough attention is being paid to this. And we've been, the theme around frauds, the theme around has been a consistent since this morning, and this is a reality. And so how do we really equip the women to, guard themselves? And here we face the biggest barrier, because how do we educate these women? And there's enough and more statistics, about the ownership of mobile phones. Across the globe, women, 8% of women, 8% less, that's the difference in mobile phone ownership. In South Asia, it's even more stark. 23% is the difference between ownership between male and female. So one is in terms of having a phone, and the second, of course, is in terms of, is she comfortable enough to actually use the phone to access internet? Because, all my material, all my knowledge on, and all the education is there, without a doubt. But I'm a woman from the low and the middle income, and I'm fairly reluctant to actually use the mobile phone to actually access the internet, and that difference again is a stark 20%. So these are natural barriers which come in the way of a woman actually getting this financial literacy, digital financial literacy. So we've been working, and here I must mention, we've been partnering with Bank of Baroda, and Mr. Kichi here is one of our key stakeholders. We've been doing work with Bank of Baroda's Jan Dhan account for the last few years. And our learning has been, and we've seen this, at play in both the rural market, and there was a base point around rural and how rural is here to dominate, and we see that too. And we started off with rural, and we've been doing a pilot, and then now we've expanded to the zones. three aspects that are crucial when it comes to the digital financial literacy is what we've understood. One is, of course, knowledge. What are the products that are available, for a Jan-Dhan? So, knowledge around overdraft, what's a savings bank account, and the micro-insurance products. Now, that's hygiene. But where we realize work has to be done, and we've been developing and we've been working along with, the team at the ground, is around attitude and skills. There's this lack of inherent trust in using the formal system. This is something that we know. So how to really engender that trust, and how to make her confident to deal with, even walking into the bank branch in the rural area. She doesn't feel that it's, we've done enough and more research, which clearly points out that she believes that the bank is not for me. Bank is for people with money. It's definitely not for me. These are the kind of attitudinal issues. So how to kind of work and, engender that trust. And the last piece, of course, is the skills piece, which is around, okay, fine, this is the product, now I'm confident to walk and engage with the various stakeholders, but how do I actually use the internet? So that whole practice and learn and show and learn, methodology is something that, we find, is extremely effective with these women. The other piece, of course, is the interesting work around the female women banking correspondents, the BC Sakhis. That's an area that we are finding very, very interesting. One is, of course, to ensure, and there's that whole advocacy piece around ensuring that we have more women BCs. Okay, and who are these women BCs? These are coming from the same community. This is the low and the middle income women, and these are the ones that are becoming, women BCs. So how to work with them to ensure, that there is comfort in dealing with bank managers, going to the ATM, going to the branch, withdrawing money. This is a very interesting journey for us. So work around digital and financial literacy is something that we believe that, can go a long way in empowering the women. And the last piece, and I want to end here, is that, anything that we do on financial health, there's got to be a measurability. It's all very nice to be talking about, oh yeah, we are doing work, but at the end of the day, we are dealing with banks, we are dealing with, FSPs, and we need to be talking to them in their terms, in the terms that, that makes sense. And so here we find actually outcome research, the tools that, around outcomes research to be actually the most effective. So, this is the way, we've been approaching, financial health. Yeah, thank you.
Thanks Amit, thanks Kalpana. Actually, Amit raised two very interesting points. One was all about that having the right use cases for this segment, what he prefers to call Bharat, and can we look at it more at household level? I think fair input. These are something which I think everyone is aware of. Kalpana, actually, very interestingly, you spoke about several works, several experiments that you have done. In fact, digital literacy is something which I think everyone talks about. It's like, this is how we look at it. It's more about the process, that how to do it. So people do say they understand that this is important, but how exactly it is to be done, that is all about the process. And as you said, that if you look at the customer experience journey, generally this is how we look at it. It's a knowledge, skill, aptitude and practice, because unless you follow entire user experience journey, people fall off. Actually, they don't really continue with that. So, and third very interesting thing is all about the measurement. I think measurement is something recent. Actually, last week only I was there in one of the summit in London, and we had a discussion that how do you measure the impact. I think this is something which is still evolving. I think no one has a clear answer that what is that we should be doing to measure it, because it's a very, very complex thing in the sense like how do you measure the outcomes of what's happening in your life. So I think I'll leave that topic for some other discussion. Let me move to Sucharita and Mr. Vikramaditya. So I think we have been hearing about inclusion, health and all those things. Both of you are practitioners. In the sense like you run a large bank and Sucharita, she's running a very large fintech as of now. So how like in your organization, directly or indirectly, how are you trying to basically handle the situation of say little futuristic, which is about the financial health. So this is more about the outcome of the people that you serve. So I want to hear from you that what is that you are doing in your organizations, or or directly, or maybe in partnership with others.
Can I go first? Yeah. First of all, thank you so much for this opportunity to be a part of this esteemed panel. I think both Kalpana and Amit made really valuable points around how to move from access to financial health. And it has a usage aspect and it has a quality aspect, and both are quite distinct. At Kaleidofin, we started with the premise that financial products as such are not intuitive to customers, not just to rural customers, even to urban customers. What customers want is to build an additional bathroom in their house. They want to send their daughters to medical college, right? They want to build their business, buy an additional sewing machine. This is what they want. This is the product that they are truly buying in their minds. And Mr. Rashesha in an earlier panel also said that he wants to move from products to solutions. And the big journey there is that you really have to combine many different financial products to form a solution. Imagine if you went to buy a bike and you were sold the brakes and the tires and I'm not very good at bikes, but whatever else goes into making a bike. Instead, it wouldn't be a great experience, right? What you want is a bike that's comfortable, that's cool. And this is what every customer in India, Bharat customer and Indian customer is asking for. And this is what we solved for. We said that, okay, let's move from products to solutions. We will combine credit, savings, insurance, payments to form packages that actually make sense and say that, you know what, I'm actually buying a piece of my daughter's education. That's what I'm buying. I don't actually care what goes into it. The second, point, which is a corollary to this, is that RBI actually, about a few years ago, included in its Charter of Customer Rights the right to suitability. Because this obviously means that the provider has to assess the financial health of a customer prior to providing that financial product. We're not just selling potatoes and onions, we are selling products that have multi-year impacts on the customer. So how do we do this at a cost which can actually be delivered in an affordable way? Clearly, wealth management, as we are served in this audience, is not the answer, right? We have to figure out how to make financial advice, financial planning available to all so that you can actually combine it and make the cognitive load much less for customers. So, our first flagship product was Kaleido Goals, which combined savings, emergency credit, and any obstacles to your goal, to your daughter's education. What if I have an accident? What if I get run over by a bus? What if I pass away? I know my daughter's not going to college, and yet I want her to go to college no matter what. So we combined all of these three distinct elements to form one solution that the customer can then cognitively understand, relate to, buy, and enjoy even. Today, nobody goes to YouTube and say, you know what, I just bought an insurance policy, because the experience is not like that, right? But you would say, I just took a step towards my daughter going to college. Now, coming to some other nuances, which Kalpana spoke about, gender-centered design. The design is equally important. For example, many of our women customers demand confidentiality as part of the package. They're saying that, I do not want the rest of my family, including my spouse, to know what I'm saving, what I'm borrowing. This is mine and mine alone. And I'm the custodian, and we have to respect that. So how do we incorporate this into the design? You know, we actually thought that, okay, you know, the male member of the household has a smartphone, let's use that. And that quickly went out of the window because it was just not possible, because obviously confidentiality was breached, right? So we actually said that, okay, you can actually use your best friend's or your neighbor's number because she doesn't want to use her husband's number. The third thing that I'd like to talk about is just the digital piece. I think the digital has huge potential, untapped potential. Today we have about 12 to 15% of customers actually doing digital transactions in India. How do we take this to 70 to 80%, you know, which is the adult population in India? And I think two things need to happen there, and these are infrastructural in nature. One is that we need to have better quality bank accounts. And everybody has a bank account, and that's great, and we've actually, as per the World Bank Findex survey, the gender gap is now 0 in terms of account ownership, but account inactivity actually remains one of the highest in the world in India. The second is cash in, cash out points. How do I convert the cash that I earn in cash to digital, right? And only then will the costs of distribution go down. So I think these are the few changes that we need to really move from financial access to usage to health.
So thank you, Mr. Anil. You said practitioner, so I understand that you would want to give a practical perspective of what Bank of Baroda would be doing on the field. So I think I'll, again, talking about the financial health, we understand that it appears to be a pretty new concept that we are talking about. But then I'll, like Amit, take a step back, maybe a decade, when we started on the embarked on the journey of financial inclusion. At that point of time itself, we had actually envisaged this particular aspect of financial health. If this financial inclusion architecture was basically built on 4 pillars. That was, one was universal access, may it be in terms of geographical proximity and the ease and simplicity of the account. Second would be the social security systems. Third would be, I think, credit and skill development and creating a credit history. Fourth pillar was actually talking about financial health. That was when we surpluses are creating, giving choices to people, investment opportunities, avenues for discretionary spending and all. So that pillar was always there, but unfortunately we actually embarked on the journey and we simply sort of took that out of sight. But now as we have matured over this decade, I think now is the right time that we start talking and talk about migrating towards this, moving towards this rather. So talking about Bank of Baroda, sir, we have been actually right from the day, like Arundhati madam said, right when we embarked on 26th of August 2014, within 9 months we looked at the actually excess, we actually saturated entire country with 1 account per household. Then we graduated to 1 account, every individual adult account was supposed to be opened. And then now we are looking at every person who crosses the age of 18 should have an account. So we are almost on the saturation point in terms of access. With 5 kilometer radius banking facility and all. Usage, yes, there is a challenge. 53% of these accounts are women. Despite that, the challenges in making them usable or maybe looking at digital financial literacy is the slight challenge in that. But at Bank of Baroda, we have been punching much above our weight. In fact, अगर हम देखते हैं banking industry के अंदर, our share is only 6% ballpark range. But in terms of financial inclusion, when we look at the PMJDY accounts, we have a share of almost 15%, that is 2.5x. And in terms of when I look at the deposits in those PMJDY accounts, it is 17%, much higher. So we have been punching much above our weight in terms of creating a niche amongst this financial literacy, and with a very clear objective that once these accounts are opened, maybe over a period of time with the social security also coming in, skill development and this thing coming, we would be creating credit history, we would be curating these accounts, inculcating some savings habit, and maybe over a period of time moving towards the financial health. That was the initial objective, and we have been following that. But having said that, how do we do that? Now that is very important. How are we moving towards that? So we have various avenues, like we have for the skill development that I talked about, we have 64 RCTs, which in the last 1 year have had 1,500 training sessions, training almost 39,000, 80% of which are women. We have our 86 financial literacy centers who have actually trained almost given digital literacy to 69,000 people. We have also centers of financial literacy. These are almost 1,100 centers identified by Government of India, out of which 93 are being catered by Bank of Baroda and 279 blocks of 252 districts. So that is one thing. Then our BC outreach, we have actually deepened our BC outreach to quite an extent. Like at the time of amalgamation, March 19, April 19, we had 9,500 branches and around 18,000 banking touch points through BCs. Today we have rationalized our branches to 8,200 but improved our BC touch points to almost 41,000. And that includes that BC Sakhi, UP Sakhi of almost 6,000 to 7,000 project of that. So we have again been emphasizing on our women empowerment in terms of BCs also. Then we have launched a Swavlamban credit card for the low income group, where we give credit card credit facilities to the low income group up to maybe 90,000 rupees per annum tak hota hai, then we give that. And we have been working with the Reserve Bank of India Innovation Hub also, which they are working for technological interventions and improvisation toward gender and financial empowerment of women. So there also Bank of Baroda is proudly the only PSB to be a scale-up partner with Reserve Bank of India, assisting them. I think our partners, World Women Banking is also there. And there also almost 60 fintechs did appear, and we are, partnering with them to scale up this thing. Again, as Madam said, we are looking at creating those sort of values, saving values, and maybe looking at that, nurturing the behavioral economics of these women accounts, because it's slightly challenging to actually curate them. So in partnership with Women World's Banking, we are looking at actually creating some savings habit, and maybe then slowly linking them with some credit, maybe overdraft or small credit, creating a credit history and curating them for the future leap. So these are all the initiatives that we have been taking at Bank of Baroda in terms of slightly moving from access to usage, and now from usage to financial health. In fact, from my perspective, I always say what you have said in terms of spend and all. I normally would say that one is every day and today and every day. Second is the rainy day, and third is the sunny day. So why every day and today we are basically looking at only maintaining ourselves, trying to match our income and expenditure and somehow live through it. When it comes to rainy day, we actually look at creating some buffer or a reservoir to fall back in case of any difficulty, in case there is maybe any eventuality like a job loss or maybe a serious illness. Or this can be either which way. It can be through the savings in the account, it can be through available credit, maybe even through credit card, it can be through insurance policies, it can be anything. But if for a rainy day, if you have some reservoir to fall back in case of need, that is the rainy day. And once you graduate over that, it's the sunny day. Sunny day is where you are able to make choices, you are able to have some discretionary spending, you have some investable funds, you have to look for investment avenues. So that is the thing. So we are slowly moving from every day to the rainy day and then to the sunny day.
Thanks. I think very interesting actually perspective to the same thing, and probably a new terminology also to say that. Just building on what you were saying. In fact, the work that has been done for Reserve Bank Innovation Hub. So as part of that, actually 5 of them, they were shortlisted, and some of them we are going to curate or accelerate through our Financial Inclusion Lab. So one of the inclusive fintech lab that we run in India is known as Financial Inclusion Lab, that we run with CII of Indian Institute of Management, Ahmedabad. So Charita, I think you raised a very valid point that people don't buy products, they buy solutions, and this is the reason most of my discussion, if you are watching it carefully, I prefer not to use the word product. So product typically means once it has been established and this is how people consume it, but the people that we care about, that we are trying to consider through financial inclusion, it's a solution for them because there's a purpose attached to it. You also raised that about that women confidentiality, and this is something which we have seen in many of our work, where women, they don't prefer even to go to the nearest BC because that happens to be in their village. And if they disclose something to that nearest BC, it's likely that it will go back to his home, to her home. So these are some of the things that we have seen. They don't look very intuitive, but this is how things are actually in the market. And sir, actually, I think you raised very valid point that how Bank of Baroda has really taken a lion's share. Probably you are punching above your weight, and instead of say 6%, which is your normal share, you are say around 15 to 17% in terms of number of accounts and the value in those things. So let me quickly move to the second round. Actually, I think we don't have much time, so I'll request all of you to be a little precise. I have very quick question. Actually, it's little futuristic in the sense like we know that where are we heading, and probably that's the right path in terms of sustainable organizations. So tell me, like, what are 1 or 2 things that you think that may happen which can strengthen this movement based on your experience and based on your work, and do you see your organization is going to play a role into it? For the second question, I know that answer is yes, but still I want to hear from all of you. Maybe you want to,
So going forward, it has to be quite even if you have to crystal ball gaze, it's to be very clear that 5 years down the line, the things will have completely changed, and it would be requiring absolute digital interventions, and we need innovative products. And I must tell that in the Bank of Baroda, sharing my experience, we have got into a very novel sort of a tie-up. We have created a Bank of Baroda IIT Bombay Innovation Hub, Innovation Center, wherein we actually go in for a faculty-led R&D projects, which look at certain projects in the BFSI domain, and these certain products with various research, incubation, and maybe development, and then we look at what sort of interventions and products we can bring for the financial inclusion and financial health also. So we are working on various options, and this is a very novel collaboration that we have done with IIT Bombay, where technical expertise is provided by IIT and financial expertise and support provided by Bank of Baroda. So that's going to be a very big game changer for us. Second is the digital banking units that we have embarked on. In this Azadi Ka Amrit Mahotsav, 75 DBUs were supposed to be opened by all banks together. We had to open 8. But we find this concept so enchanting, so powerful proposition, that we actually want to open these in a very significant number, taking the financial inclusion and financial health basically to a next level. Now this digital banking unit is basically a combination of self mode and assisted mode. So here we provide digital literacy and all, and this will be very penetrative and light cash and light cost model, but a high digital proposition. Third would be the Bob World that we are looking at, already have 20 million customers onboarded on that. And I see that with 114 mobile connections, with our population, 50% of it below 25 years, and the type of usage that even the rural and the semi-urban areas are seeing, I think if we see at the messaging app, in the urban areas or in the metro areas, it is 81%. And in the rural and semi-urban areas, it is 79%. So we are almost there, and with the demographic changing so rapidly, I think this should be a very big intervention where 20 million, or maybe by the end of the year, we are looking at 30 million users. Bob World would be a very powerful instrument. And another one thing that I'll say is we are looking from STP, like straight through processes, a few products for agri and rural banking credit more particularly. We had a product, similar product for our street vendor Swanidhi, where it was straight through process with the totally digital, without any human intervention. So similar sort of products we would like to bring so that we can penetrate the rural and agri credit market. So I think that should be the game changers.
So first and foremost, Anil, I would say customer protection and grievance redressal. As an ecosystem level, this is fairly weak, and lot needs to be done, and it's a complex problem. There are no clear answers who could do what. So more investments are required from all sides. Probably Center for Financial Literacy or FLCs could play their part, but much more needs to be done, and this is one area which, if we don't invest as much as is required, could derail the end objective of financial health. That would be one. Second, as I said in my first opening remark, financial health not of the individual but at the household level. So we need to have CRMs which are able to take that kind of a view. If a husband has taken a KCC and a wife has taken an SHG loan, do we get one view of that today? We don't. Unless until we can do that mapping, and this could probably happen more easily through effective partnerships. Perhaps, Kaleidofin or the likes could work with large PSU banks and bring that kind of a solutioning, which would be very useful. So I would say these two broad areas is something that I would be very keen that we collectively invest. Third and last, I actually wanted to ask this to Dilip. What would it take for AEPS and Aadhaar Pay to scale up to the level of UPI? 150 million haves have multiple options, but 600 million so-called have-nots or somewhere in between only have very few options, and that's through the assisted mode. If we can invest in giving them more choices and option and ensure I don't need to do a cash out, I remain cashed into the bank account and are able to do my subsequent transactions electronically, perhaps start in the assisted mode, that would be a trajectory which would be very, very helpful, leading us to the desired goal that you've been talking of.
Thanks Amit. Quick, Alpna, very quickly.
So very quickly, technology is a given, and so how do we, I come back to the original point that I made in terms of how do we make women comfortable with technology, and the whole digital financial literacy piece is something that we are going to be focusing on. The other area that we've been working with is on the advocacy piece, and this is an area that we've been kind of working on, but we kind of want to scale it up, which is that we have a very unique leadership and gender diversity program meant for regulators around the world. We've actually trained close to about, we've been doing this, and we've covered close to about 80 odd regulators around the world. We believe that this will help at the very root, which is that it would, we've partnered with Oxford in designing this program, and we believe that this would help the regulators to actually design gender sensitive policies, and the leadership piece would help them actually effect those policies in the market that they regulate. So these are some of the areas that we are thinking about. So yes, it's work at the field level, but equally work with all the critical stakeholders in the influence piece. We can't take our eyes off that, is what we believe has to be done in the future. Thank you.
Thanks. Thanks.
I must come in before Sunita comes in. So since you mentioned about this program, see today as a country we don't even get gender-wise breakup, be it of the supply side or the demand side. We don't know how many BC agents in India today are women, and how many, there are guessworks that we do based on some surveys, but this information is very conveniently available, but it is not available in public domain. So if we can encourage these kind of, indicators to come out more clearly, that itself will put a lot of thrust. I just couldn't resist. Sorry.
Agree. In fact, gender disaggregated data is one of the biggest agenda for us with the regulator. So, with you.
By the way, it is included in the RBI's National Financial Inclusion Strategy. Let's see, like when.
The annual report.
No, it will come. I think for everything there is a time. Yeah, quickly, Sucharita, please.
Yeah, no, I'll keep it quick. So, two things I'm very excited by to bridge the gap between India and Bharat. One is combine the power of technology, data science with assistance and touch. There are a lot of firms, fintechs out there working on direct to customer. What we need a lot of is also equally firms who work on assisted app an agent type architecture, because we really need that to work in a secure fashion. So KaleidoFin's all products are available in direct to customer and in assisted format, because we know that 90% of informal sector customers need assistance, and I think that that could really be a revolution. That's number one. Two, I'm very excited by the newest category of NBFCs, account aggregators, because I think it puts the data of customers in their own hands, gives them that ownership. This can be super powerful, because now this data, for example, we use such data to publish a score called Chi-Score, which is a supervised ML-based credit health, financial health score, which can be used to provide very tailored credit solutions, can be used by any field level institution, any bank. Again, has the power to catalyze that data into better financial products, leading to better financial health. I'll stop there in the interest of time.
Thanks, Sucharita. Thank you very much. Like before we close the panel, I want to summarize a little bit of it. But before I do that, in case anyone has any question, probably we can pick one or maximum two questions. Post-lunch question, it will keep you awake.
I think I have a question, if I could pose it. See, on one hand, we are talking in terms of access, so we have very good numbers which are told about Jan Dhan. But how much is the usage? Because if I actually see the average balance in a Jan Dhan account, it hasn't really changed significantly. You can correct me if my numbers are wrong. So this gives the impression that because we have a DBT, I have to open an account, I get the money, I take it out, and that's the end of the day. The second part is, I think, contrary to what was said by Mr. Asbe, we have seen the amount of cash which is held by households has actually increased. Irrespective of demonetization, people still like to hold cash. So one gets a feeling that while you may be able to open an account, may be able to put the money in the account, finally at the end of the day, people from the lower income groups would prefer to hold on to cash. So that becomes an issue. Second, if you're talking in terms of lending, leave out the commercial banks. Suppose I look at something like the MFIs, look at the kind of interest rate which you're charging, look at the role of the money lender plays even today in the bank, in the financial world. You get a feeling that while lots of things are happening, I think lots of efforts, we've gotten very good news from the panelists today, but the fact is that it looks like that we have a very long road to travel. This is just a comment of mine. If any of my facts are wrong, please do correct me.
Actually, none of your facts are wrong, and I do think that there is a long way to go. So, for example, why do moneylenders still play such an important role? A World Bank funded research study in Tamil Nadu, which is one of the most banked urbanized states, shows that people who are lending, customers who are lending from the formal sector have an equal amount borrowed from the informal sector, 100%, and generally slightly more than the formal loan. Now, the thing is that points to a couple of questions. I think quality of bank accounts and the kind of charges customers has to pay is one. Second is, has there been a cash management product devised for customers to meet their volatile cash flows? The answer is no. We don't. You and I have a credit card. The customers living in rural or very peri-urban districts do not. They do not have a product in which, let's say, for example, there's a medical emergency. You can get the money right there, right then, now. So my sense is, the good thing is that these are imminently solvable, but the ecosystem really has to come together in every way. And I think in this space, there is full scope for partnerships, and we don't really need to worry about competition at all here.
I just want to add one piece. I don't think you've got any of your facts wrong, but I think there's this one component that we probably are missing in the way we look at financial health, especially for the Jan Dhan accounts, which is the whole micro-insurance. I mean, that's a very significant piece of Jan Dhan, and oftentimes unbundled. Nobody's talking to this segment, or we're not readily speaking to this customer, and that's such a critical product from a resilience point of view. And if you were to see the indicators and the indices on penetration and cross-sell of the micro-insurance products, actually that's I would say, a satisfying number. We're not there yet, but I think that number is a very strong, directionally moving towards providing resilience for the segment. So I think there's work that's happening, and there's some parts that are working well, some parts, of course, we need to get there.
If I may say, I think, and that was what I wanted to convey in the first round, if the usage is not increasing, because that's largely, we as supply side players are not mapping their existing use cases and delivering suitable products. That's primarily the reason. So we define conditions for free transactions. I'm happy living with cash. You're only coming and telling me that, please, no, come and transact into a bank account, and then I say after 4 free transactions, I'll start charging you. I'll start taking these charges. So I'm happy at my home using cash. Another use case, banks lend to SHGs, give money, but what happens between the SHG and the SHG member, we don't have a visibility. So we need to create a product where we allow digital transactions between this ecosystem, which we don't have today, so on and so forth. So I think that's the requirement to fill this gap.
In case you also have a point.
No, in the interest of the time, I'll give it a go. The only point that I wanted to make was that though it appears that the balances have not gone up significantly, the usage has not gone up significantly, but if you fall back around 8 years back, when we opened zero balance account, 90% of the accounts were dormant, inoperative. Today only 7% accounts are inoperative or dormant to an extent. From balance of around 400 to 500 rupees in each account, today we have moved to a average balance of 4,200 rupees. So there is a way, but the type of economy that we are looking at the rural side, I think that's reasonable. We take a little time.
Thank you all. In case if anyone has any last question or...
Okay, in that case, we close the session. So thanks a lot. I think this has been,
yeah. So as we close, actually, I just want to remind about few things. One is thing that India is a very diverse country. We have a population of 1.4 billion. And out of 1.4 billion, nearly 1 billion is what we were discussing about in this panel. That's a point number one. Point number two is that we say that being poor is very expensive in India. So perhaps a lot of us don't realize that being poor means you need to buy everything at a higher prices, you need to pay higher interest rates, everything comes at a premium. So that's a second thing that we should remember. And I just want to leave you with few thoughts. One is that we have made a very rapid stride in terms of financial inclusion. In the sense India opened the number of accounts which were equal to whole of the world in last few years. So we have made a rapid stride, and this deserves a round of applause for all the bankers in India, more so public sector bank. So I think this is a great thing that we have done. It's now time to add another dimension. This is what I usually say even in the Ministry of Finance, that we have achieved Jan Dhan using PMJDY. Time to move from Jan Dhan to Jan Samriddhi. So this is the tagline that we have proposed to them also. So second is that if we make our customers financially resilient, it's very important for our sustainable business. End of the day, we are running enterprises. For example, all the bankers here in the room, whether they are providing any type of financial services or solution, they are serving the customers. If customers are resilient, your bank or your institution will also be resilient. This will be more sustainable in nature. Third is that we aspire for India where we are looking for wider prosperity, and this is the place. You are the people, those who can make that change. So not only be the change, be the harbinger of change. Thank you very much for listening to this panel. Thank you.
Thanks a lot, everyone. And now, as part of a token of appreciation, I'll request Mr. Anil Gupta to present a memento to Mr. Kiji. Okay, now I'll request Mr. Kichi sir, we'll do that, to present the memento to Amit. Ms. Kalpana. Ms. Sucharita. Finally to Anil. Thanks a lot. Thanks a lot, everybody. We'll be moving on to the next session. So this session will be coming on VC, so we just have the profile put up. We have Mr. Harshvardhan Modi from JP Morgan. He's joining us for a special address. Could we have the profile put up, please?
Hi.
Well, welcome, Harshvardhan. This is a different way of coming to our conference. Welcome.
Thank you so much for inviting me and allowing me to present the views on the major trends that we see in the next decade across APAC financials. Let me share my screen and, well, here we go. All right, here we go. Okay. Good afternoon, ladies and gentlemen. So there's a lot of big shifts happening as we speak. And I dare say some of these changes that we're looking at over the next 5 to 10 years across the region are probably way more important and longer lasting than just 5-10 year changes. We potentially are looking at some of these changes lasting multiple decades. So let's start with the first one, which is regime change in the DM, developed world inflation and rates. Now, we have had almost a 40-year straight line decline in rates and inflation. And now what we are looking at is, due to multiple reasons, supply side, we have had a lot of demand shock, positive shock. We had a lot of liquidity coming in. All of that are starting to lead to a very significant shift in inflation, and what that means is much higher interest rates. Now, that combo of higher inflation and rates ultimately gives us a degree of possibility of slower growth as economies digest this combination of rates and inflation, and this has implications, capital flow, and so on and so forth. We'll talk about that in a bit. So that is one set of discussions and trends which are shifting for the first time in almost 40 years. Second set of topics which are quite important is the Bretton Woods, what is so-called Bretton Woods 2.0, or geonomics, which combines with what is called climate realism now. And this combination is leading to a move away from just talking about lower cost when it comes to supply chain to who are the people we are doing business with. And that has, again, multi-decade implications starting almost now. And we'll talk about that, how it impacts banks in different parts of Asia and APAC over the next few years. And the final group of discussions is around digitization. Incumbents which were under the heat for a good part of last 10 years are now becoming challenges. So that's quite interesting. And of course, the DeFi, Web 3.0, crypto. I think what is way more important than crypto and gets less airtime, I guess, is the technology, not the asset prices. Asset prices is just a manifestation of some of the use cases, and how does it change banking? Well, then we'll get into that. So those are three groups of topics, if I may. Now, before I get into that, what I want to set the discussion on is, if I look at last 20 odd years, what is very important, if you look at this chart on the bottom left, is how has the global money supply shifted in, let's say, we have taken three slices between 2003 and 8, then 8 to 19, and then in pandemic. Especially what we are seeing in 8 to 19 is global money supply increased by $60 trillion. And this is in context of global GDP, which is between 70 to 90 trillion during that period. So these are big numbers, which led to GDP increase of just about 30 trillion and asset price increase till end of last year. Some of this has come off more than 160 trillion. So that's one set of trends which are shifting and has huge implications on how asset prices and economies work. So that's one. Second is a bit more mundane in comparison. If you look at the market cap of MSCI APAC financials or percent of total MSCI, it has been coming off almost in straight line for a decade. Because of lower interest rate, lower inflation, lowers my yield curve. That is just starting to pick up. And again, if we think about much higher yield curve over the next 5 to 10 years, some of these underperformance can shift and again has huge implications in terms of cost of capital for various banks and financial institutions. So let's delve into it. So the first point on inflation rates and growth, the great moderation which basically started once Volcker effectively won the inflation fight from 82 to almost 40 years to dot, that is basically now coming off. And a lot of reasons for inflation to become stickier. There are supply side, there is underinvestment in certain parts of the world and certain parts of the economy. There was huge liquidity got pumped in, as we saw on the previous slide, and there is a bit of a demand pickup post-pandemic. So all of these, and some of these have much deeper roots, which means that the inflation number that we are going to see is, especially in DM, in emerging markets, inflation has always been an issue. In developed world, it was not, and now it is becoming one. And these changes don't happen overnight; they take a lot of time. So we are into that. Accordingly, interest rates will remain high, and the DM world is starting to see Fed is taking the lead. We saw ECB finally moving up last night. So we are seeing very significant shifts in interest rates. Bank of England has had a number of hikes. Lot of central banks in EM are following suit. But what it means is, if inflation is high, rates are high, it has impact on growth and asset prices. Now, as we go through that process, and if we still start thinking about what happens to banks in that situation, banks with much better deposit franchise, with much better CASA, much better retail franchise, they are the ones who would do better. because by definition, higher rates plays into their strength, which is a low-cost deposit base, and more importantly, sticky deposit base. Because right now liquidity is ample, but if we do see higher rates for a while, financial conditions tighten, liquidity will become an issue. And all the work done by central bankers and regulators across the world on managing liquidity and CRA framework starts coming handy. So that's one thing to look at. Second thing, and this is true across a lot of markets, that even if rates go up, not every rate hike is getting passed through. Some will be, some will not be. Because if there is a growth concern, so the way I think about it is, the pass-through of the first 100 basis point, give or take, across markets in APAC will be almost perfect. The second 100 basis point less so, and the third 100 basis point, if you get there, probably not much. And we are already starting to see intervention in some places. Even getting a rate hike is very tough. Japan, Thailand, we had Europe just hiking rates just 24 hours ago. So it's not that easy for central banks to hike rates, and even if they do, it's not easy for all the banks across the region to pass those on. So that's one. And hence the implication for net interest margin will be quite different. So I don't think it should be a straight line increase in margins for banks across the region. Second thing, underwriting is always important. That's what banks are about. Credit transformation in addition to duration transformation. But if we are looking at a situation where growth does slow down over the next few years, it becomes even more important. When capital is adequate, liquidity is adequate, allocation of capital, even if it is not super disciplined, let's call it, it is still all right. But in a situation where growth does become a challenge, it is relatively, the credit discipline becomes way more important. So that's something which will become a very important driver of differentiation across banks over the next few years. And this is a generality, but if I think about banking, end of the day is a commodity business. What I mean by that is almost everybody knows what is the best mortgage rate, which bank is giving the best mortgage rate, which bank is giving the best, has the best deposit rates, and so on and so forth. So in that situation, banks which can manage the cost lines, which is the cost of fund, the OPEX, the operating cost, and the provisions well over cycles, they end up getting meaningful market share gains. And as we get into the rate hike cycle and slower growth, that becomes quite important. So that's, and we have seen some of it over the last few years, and we will continue to see that going. Now, moving to the second set of discussions on geonomics and capital realism, climate realism. Now, this is very, very important, and I said this is a multi-decade thesis developing now. Because a good part of last 10, 20, 30 years was about lowest cost center of production, or any country which gives the lowest cost goods or services, and a lot of our countries in Asia have benefited from that, but that is changing. What is becoming important is what are the geopolitical implications of trade, which was not as important. It has always been important, but not as important. That becomes very important. Energy security, national security, especially given the kind of issues we're having in Europe right now. So what is quite important is alliances and networks. Now, with all of these, what it means for us, for banks across the region, is capital flows. The driver of capital flow was almost just economic, or largely economic, for the part of last at least 20, 30 years. That becomes economic. So the political economic comes into play. And once political economy comes into play, it becomes slightly different. But what it also means is if you see the two charts there, the net exports and the balance of payment will start shifting over the next 3 to 5 years and meaningfully in 10 years' time. As that happens, which countries are able to attract that capital in terms of FDI, in terms of actually setting up manufacturing facility in the country. To me, one of the best examples of that has been in last 15 years has been Vietnam, where if you see consistent FDI coming in, and what FDI does is, especially into export-oriented businesses, is increases my visibility on exports 3 years out, and hence my balance of payment gets into some sort of positive spiral. And those shifts are super important. Vietnam was essentially China plus one strategy, but now it is becoming, now the G economics is coming in. Similarly, for energy, the way ESG was defined is starting to change, and it will have huge impact, especially in South and Southeast Asia, including India, including ASEAN. We should have meaningful shifts in capital. And there again, what matters is which banking systems have deep domestic currency liquidity. And what is the stage of development of the DC and ECM, the debt and equity capital market in the domestic currency in those countries. So that's important. And second, the corporate banks. Do the banks have adequate project management capability? What has been the track record of lending to large corporates in the last 5, 10, 15, 20 years? How well can they manage that risk? How well can they hedge that risk? And that's where the depth of capital markets comes in. So it's likely that banks with good deposit franchise, with long-term sticky liquidity, that is, as well as good, especially corporate underwriting, would benefit meaningfully, and the system will be more stable, especially if the equity and debt capital markets, local currency capital markets are fairly deep and well developed. So with that, let me move on to the last set of discussions, which is on digitalization. In my mind, there's a very meaningful shift in the last, especially 5 years, as a lot of these social media companies came in, ride-hailing, food delivery, chat apps. That customer experience has become way more important than who gives me the lowest cost of fund. And that basically has started moving some of the benefits that banks traditionally had away from banks into the technology-led challenges. But banks have learned that done quickly in the last 5 years. I think there's no bank which exists today which is a pure bank. Every financial institution is a fintech. Now, it's a continuum. Some are less developed, some are less developed back-end, front-end, middleware. Some have super well-developed set of back-end, middleware and stuff. But it's a continuum, and almost everybody is in that continuum. But what is very important is banks have basically said rent seeking is not an option. We have to add value to customer, and if we do that, and we have a lot of examples. We have examples in Indonesia. I was in Pune a couple of weeks ago. We have examples there. We have examples in China. We have examples in India, where what started with challenges coming in is now incumbents have built very significant capability. And Saurabh Kumar, who runs our India financials research, has done a fantastic work on that. And his conclusion is that over the next couple of years, as funding dries up for fintechs, it is the large incumbents, banks, which will benefit over a period of time in terms of building even better tech stack and digital experience for customers. So basically what we are getting to is banks which are leaders in technology have started creating not only barriers of entry on deposits and credit, but also barriers of entry on technology. And the banks which have done that and which are able to basically manage now the three cycles, which is the credit cycle, as in the credit quality cycle, the interest rate cycle, and the cross-sale cycle, will be able to meaningfully gain market share. We have one example here in Singapore of that, and I think over the next few years we'll have a few more. And let me close with a final discussion on crypto DeFi. I think there's a lot of stuff to talk about here, and I think this is a topic on its own for an hour, if not two. But the limited point I'll make here is, while crypto gets a lot of headlines, to me the most important thing is blockchain. There are genuine use cases, and I was speaking to someone in JP Morgan. We've started doing intraday repo based on blockchain in a permission network, which is completely automated using smart contracts with third parties. And slowly but steadily, the use case for the permission blockchain network is becoming much bigger. This is almost utopian, and we are yet to get to the point where we get public networks, to do transactions in public networks, but it's a start. And the way this is changing, this can have literally quantum shift in the way banking and financial services are delivered, and this is not in the realm of fantasy anymore. We have realistic use cases, and we've already started delivering those use cases to clients. In Singapore, there is a working along with MAS and a couple of other institutions to do cross-border remittances at institutional scale using blockchain technology, which is seamless, much faster, much cheaper. So I think that is where we are getting into it. I won't get into CBDCs. This is a topic which when every country is looking at it, in last count 80 countries are looking at CBDCs. But my sense is ultimately this is a much deeper discussion on what money means to the society, and how does that change in the next few decades. So this is something which will take time, and I think a couple of large countries will launch it first, and then you'll have some of the countries follow it over a period of time. We have a couple of examples, but we need to see some large economies getting into it. And with that, so these are some of the stuff that we have done, but let me kind of go back to the conclusions back at the top. Three sets of large trends. One is higher inflation and rates and slower growth. The main benefit banks is basically banks with better deposit franchise, better underwriting capability. Second, this entire shift on trade. It is not about lowest cost. It's about who is a good partner in thick and thin, and even if it will pay up a bit, so be it. And that will have huge impact on capital flows and FDI. And the third one is the way we deliver financial services. It is not going to be digital in the traditional sense of the word, but use of blockchain starts with permission networks, will probably become more public network at some point in time. But that is a very, very big change once we get everything on chain. So it's again not utopian, it's already starting to happen. And with that, let me stop here. Thanks a lot.
Thanks a lot, Harshvardhan. Does the audience have any questions for him? Please do raise your hands, and you can send the mic over. Well, I just have one question for you. When you're talking of CBDC, it's fairly provocative. How do you actually see this as replacing currency, or will it be something running in
parallel?
So yeah, it divides opinion, to put it mildly. This is something which will, every society and every economy will have a debate internally to decide what is the right mix of privacy versus convenience. And my sense is in multiple markets where which are more attuned to privacy, will find it more difficult to get CBDCs going in full form. Most likely to be more wholesale CBDCs to begin with. Retail CBDCs probably will be a bit more easily adopted by countries where privacy is probably less of a concern relatively.
But will something like CBDC offer some kind of competition for banks? Because what is the need to hold accounts in banks if everything is anyway electronically held with the central bank?
Yeah, see, we can peel that discussions into multiple ways, but in theory, yes. But that is talking about retail CBDCs. If CBDC gets restricted, if it's wholesale, if it's just M0, it becomes less of a retail product. And think of it, Central Bank is not going to do KYC for customer. If something doesn't work, there is no operator who can help you with stuff. So banks will exist. They're even technically today, every payment we make in any economy ultimately gets settled by the central bank. It is not, if let's say move money from bank A to bank B, they're effectively getting settled at the central bank level at the end of the day. So in some senses, I think it's an evolution, and it will start with wholesale CBDCs in most of the markets, and retail CBDC takes time. I think in markets where payment networks are already quite heavy, retail CBDC, the need for retail CBDC is that much less.
Thanks. Any question from the audience? Okay, thanks a lot, Harshvardhan. Really appreciate taking time off to enhance our conference. Thanks a lot.
Thank you so much for having me.
Okay, now we're having a short tea break. I would actually suggest that can we arrange the stage? The next session is on innovative technologies and new business models in digital banking. We have another power-packed panel discussion, so kindly come back soon.
everyone please join in. We'll commence the sessions shortly.
Could everybody settle down, please? Ladies and gentlemen, can you please settle down? We're running behind time, so we would like to start the session immediately. Could everyone who is standing please be seated so that I could request the panelists to come up on stage.
I've cried for you 1,000 times. What you gonna do? What you gonna do? What you gonna do? What you gonna do? Love and peace. What you gonna do? What you gonna do? What you gonna do? What you gonna do? Love and peace. What you gonna do? What you gonna do? What you gonna do?
Okay, ladies and gentlemen, we start this next session. This is our third panel discussion. We had two special addresses. So this particular panel discussion is a discussion on innovative technologies and new business models for digital banking. I would first request our Executive Director, Mr. Ajay Khurana, to come on stage.
And I love you too.
Welcome, Khurana ji. I would next invite Ms. Chetna Sinha to come on stage. Ms. Lizzie Chapman. Ma'am, could you come up? Mr. Pranav Arora. Welcome, Pranav. The last seat. And last of all, Akhil Handa. Now, I think right from the time the governor started speaking, it has been technology, technology, technology. I thought maybe in inclusive banking there would be no technology, but we had technology there also being spoken of. So I will leave it to Akhil now to get into the provide an in-depth view about what we expect from technology in this particular session, and we have the right panelists here to share their views also. All yours, Akhil.
Right, there you go. So thank you very much, Madan, and welcome to the esteemed panelists. I hope everybody's had their teas, coffees, and we can have a lively conversation for the next half an hour or so. Very mindful of the time. I don't want Madan to pull me out of the chair. Now, we've heard about, of course, the governor talk about the importance of technology, also the challenges that confront the incumbents in terms of being able to adapt quickly, get onto the digital bandwagon, perhaps even bring out new business models. I think in the fitment of things, we have this panel which is titled Innovative Technologies and New Business Models for Digital Banking. We had Harsh talk about how incumbents are also becoming challenges in many ways. There is now a well-established model globally which has a large established legacy player will seed in 100, 200 million US, create a challenger bank and let the challenger bank build on a new franchise under a new brand and then compete with the parent bank. And then it's almost like, let's see, who wins out the red and the blue team. So with that, I think we'll start with Quran sir first. Sir, bank has had, been on a transformation journey for the last few years. And, I think there has been a nice pace at which we are cruising. But this conversation is about banking beyond tomorrow. And if you look 5 years from now, right, how do you think the digital transformation for the bank in particular and the industry at large will shape up?
Yeah, good afternoon, everyone. First, I would like to talk about what transformation is happening in my bank, in Bank of Baroda. We have taken up in a very big way the new form of new way of banking. That is Bob now. We have taken the transformation project. Wherein keeping in view that tomorrow's banking, we have started internally. We have started that paperless movement. So focusing on totally paperless branches by bank, and for the customer front, in the branches, almost all the journeys which are required for the customer, that is around 45 already done through tablet, that is in assisted mode, and for direct customer usage, that is Bob now. The way we have modified our app, that is now we can say it's a super app having 250 services. So here it is in addition to the normal banking of invest or that is borrow, you can shop also. So this is how we are keeping our customer engaged, and almost 2.2 crores of customers we have already activated there, and it has been told focus is to go much beyond that, and almost 3 crores we will be touching very soon. In addition to that, our other journeys, we have started video calling to the customer directly. Instead of customer coming to the branches, now we are calling to the customer to know his requirement. This is also an addition. That is what is future banking we think of. We have worked on, also we have started taking that is analytical based collection, which is without any manual intervention. Collections are taking place through SMS or video call or calling to the customer. So that is how we have taken up our digital agenda taking forward, and we have for our technology also we have made it ready for the future, gone for microservice based architecture, which will make the any changes in the going forward, whatever changes are required, which will be very agile and very fast. And we are making our all our applications cloud ready to give the customer better customer to the service, better experience to the customer. In addition, we have upgraded our data center. We are also coming with the new testing center of excellence for all our testing purposes, and our data lake, which is I will say this it's a very big addition to us, where we are all the analytics are getting done there, which is very helping us to for pre-approved loans or for our collection or for all any other purposes also. This this is helping. Akhil, your question particular that how the next 5 years the banking is going forward. I believe that it is banking is going to beyond our apps or our branches. It is going much beyond that. It is, I will say, will be the embedded banking. The banking will be available where actually it is required. Like when education loan to customer is taken admission, then their education loan will be available, or a customer has selected car, their car loan will be available. So this is for that purpose, to give a customer to better experience to the customer, and it is in 3 clicks that those things are available. So we have to keep ourselves ready for those our services at that level, if we have to be ready for beyond tomorrow.
Sure. So banking becoming invisible, more embedded finance, and I think that's cue for actually for me to go to Lizzie now, because she is, I think she's a bulwark. She's a torch bearer of when it comes to embedded finance in the country. Runs a fintech company whose reason for existence is really Checkout Finance. So Lizzie. Of course, your thoughts on the future of embedded finance, and what are some of the key innovations you're seeing emerge in the space?
Yes, that couldn't have been a better segue. I think you must have planted it. But that's exactly what we do. And the genesis of our business was exactly this question. Do people need banks or do they need banking? And the question is, can you provide banking services? And I love the previous discussion of, let's not talk about products, let's talk about solutions. But can we provide those solutions contextually and at the point of decision making? Because that will both reduce operating costs, risk costs, marketing costs for the provider, but also create a much more seamless and natural experience for the consumer. When we had that idea 7 years ago, it was considered quite crazy and disruptive, and today it's absolutely understood and very natural. And I think what we're proudest of in the last couple of years is how we have managed to bring that concept to many existing financial service providers in the country and work deeply within the existing ecosystem to bring this concept and these solutions to even the existing customers of traditional banks today. And that's the way we think. Modern fintech and embedded finance is very different to the earlier fintech genre. So in the early days of fintech, it was all about fintech versus the bank. The fintech will do better than the bank. The fintech will be faster, leaner, more agile. Banks are dinosaurs. And I think what's happened in the recent times, especially in India, and why we're most excited about this market, is a complementary awareness between the technology company and the bank. The technology company is very good at touching the customer, providing these solutions, working within a digital ecosystem in the embedded way. But banks will always bring the stability and the regulatory awareness and consciousness. And if you can gel those two pieces together using the best pieces of both sides, truly that is the ultimate solution for the customer, is our view. And that's what we've seen in the last 2 years, particularly coming out of COVID, is a very, very deep awareness from banks that the customer has changed. So pre-COVID, it was lovely to have these discussions, and digital agenda and digital initiatives were very nice to talk about at conferences, but the bank wasn't necessarily prioritizing them above BAU. COVID was a rude awakening that completely end-to-end digital servicing and the speed at which the customer can evolve and change in their expectations caught many by surprise. And so banks that have emerged from that with an open mind and a willingness to collaborate with the digital ecosystem are seeing phenomenal growth at this time. And it sounds like that's exactly what Bank of Baroda is saying.
Sure. And, I remember, pre-COVID, there used to be, of course, I've heard this many times that, the conversation we are having in the south of Bombay will remain in south of Bombay, will not go out of it. But of course, I think COVID has actually helped propel this beyond the shores. And I think that that actually brings us to ma'am, you operate in beyond cities, areas which are grassroots, which are very connected. You do connected banking. Is this the trend that you are observing in the geographies you operate in as well? And what are some of the key financial innovations you're seeing in those areas?
Thanks, Akhil. Let me say, or let me talk to you all, as you mentioned, that where Mandeshi Mahila Cooperative Bank operates. Who are these people, and how do they see bank or a digital banking? So let me take you to the weekly markets. In India, we have like more than 75,000 weekly markets. Now, after running a bank, starting a bank and running for 2 decades, many times, even today, I feel that I need to learn more from those women. And when I say that, what I mean is that, let me give you an example. A lady named Saraswati doing a vegetable vending on the road, selling in the digital market, selling in the vegetable market vegetables. I see her that she has a saving account with Mandeshi Bank. So she doesn't require financial literacy. She knows that I have to save, I open a bank account. But still, she is taking loan from moneylender. So I go and tell her, Saraswati, that you have an account with bank, you are saving, and you can take the SHG loans, joint liability group loan. That's how we see, marginalized community, right? SHG, JLG. So why don't you take loan from them instead of moneylender when you are paying such a high rate of interest? She tells me, I know that. Don't tell me that I am paying a very high interest. Then she tells me that, but I want loan in morning, I want to repay in evening. What is she explaining me? She's telling me, understand my cash flow. Another thing she says, I do not have a time to come to your bank or even time to stand here and give all the things to you. You find out the ways how to do banking with me. So what is she saying is, my time is very important, and design your process in such a way that you reach me. So I do think that this was a learning for me from this lady in the weekly market, that how do we do banking with her? Because I felt that was and she's ready with everything. She's not, and then after that experience, what we did was that we did the digital diaries of these women, understand the cash flow, design the product based on their cash flow so that they can take loan in morning and repay in evening, and not full amount, whatever according to their flexibility. Of course, all bankers are sitting here, they would say overdraft facility or cash credit loans, right? That is it. So when we are sitting here in South Bombay, I do think that future banking in such women like Saraswati. And I'm so proud to share with you that today she has trajectory of her digital transaction with her, and if we want, we can decide based on that how much amount that she is requiring today, how much is the business is today. So when I say that, what I mean is that with this type of banking, not only you are doing digital banking, doorstep banking, providing flexibility, but you are getting the data, micro data from the last mile, and with that data, I do feel that we have to actually create a business model, and with this enriched data, how we can give more to them. And so I would just like leave and park the thought here, but what would I like to share, that the lessons I learned, and I would say that we did talk about Jan Dhan account and how do we make it active, but the second part of Jan Dhan is overdraft facility to the people who are part of the Jan Dhan account, and it is possible. You have to design in such a way that you have their cash flow data, working capital, everything with you in data, and then design the product. Then she will never go to the money lender.
Great.
Thank you.
Fantastic, ma'am. That's a fantastic segue to bring in Pranav. Pranav, you represent a global technology firm, and from your vantage point of what your clients, your banking clients may be using, what are some of the key technologies to serve the needs of customers such as Mandeshi Bank's customers or embedded finance? How do we get into a just-in-time? Because it is a good ambition, but how do we get there? In the morning we heard Madam Bhattacharya talk about banks are very fond of rip and replace or lift and shift, right? So how do you see the paradigm evolving?
Yeah, thanks, Gil. So two parts to this. I think the first part is that there are these three progressive frontiers of technology which are coming on. The first one's obviously the phygital leap, making everything digital, API enabled, enabling embedded finance. That's the path that most banks are on. The second leap after that is the human plus machine bank. I mean, just like we have human colleagues, we're going to have lots and lots of bot colleagues. You have seen all the AI capabilities. AI can paint, AI can write. AI will definitely be able to write a credit appraisal memo or solve for embedded finance on the go. So that's the next evolution in terms of, the human plus machine bank. And the third one, which is once you have become a lot more digital, once you have all of this AI, is the move towards the decentralized autonomous bank, the DAB or DAO construct, which is what is built on all the blockchain rails or on all the decentralized ledger rails. So that's the evolution, right? So for banks, this phygital leaf, even if we accomplish all of these things that we're talking about, is not going to be the end of the story. It's going to be, step one on that ladder. Within step one, for all of these just-in-time pieces, I think the technologies are fairly well known, whether it's micro front ends, microservices, APIs, open banking. I think all of that orchestration or all of those technologies are well known. The challenge is in building together architectures which give you the agility to do this at speed. And over there, it's not about thinking about one technology, but thinking about rather the bank in terms of a few mega platforms so that you have the agility to react with speed and to do this innovation. For example, this product, so you need a product platform around your core banking to be able to build intraday products. And you need then to be able to reach them in different languages. So you need a platform that allows you to communicate in different languages. So I think the banks will need to think in terms of platforms which will be able to support this.
Sure, a lot of food for thought. I think for those of us who are glued into our phones, they're probably searching some of the key terms that you've thrown around, Pranav. Moving on, sir. Now, we've heard around the spectrum of what the next frontiers look like. What is the role of, now you have a lot of fintechs that will come on the, by some estimate, there are about 7,000 fintechs operating in the country. Even if, a fraction of them become big and giants, what would be the role of institutions such as ours, public sector banks, over the next decade? So, yeah.
Okay. Public sector banks, traditionally we have been, if I call that digitalization of Bharat that someone was referring, that is the majority of the population. I think we have, played a very big role while establishing the infrastructure that was the JAM, the Jan Dhan account, 41 crore account were opened, which has, helped the country to take its agenda of a digital India, and that the thrust of faceless, paperless, cashless economy. What actually the government wanted. So that there we have played a very big role presently, and entire direct benefit transfer, and then came the business correspondent with the micro ATMs with the Aadhaar enabled payment, and all these 41 crore customers were given ATM cards. So I believe that in the payment, when the payment revolution was happening, when the totally digitalization was happening, I think this infrastructure has played a very big role, and because of that we have been able to reach, as Dilip Asbe was talking, that to reach the level of more than 10 crores transactions. I think that infrastructure public sector banks have made available. Now going forward, the next revolution is towards the lending, where actually the all the innovations are happening now. Public sector bank role, especially for the mass, all these 41 crore customers for Jan Dhan account. So these for them. It is, I think it's a very big role we have been playing, that is in, the government has supported with the Jan Samarth, which is end-to-end digital disbursement of all government-sponsored schemes. Presently, it starts with the central government, and the target is to bring all the state government and central government schemes in this Jan Samarth portal. So I think here again public sector banks are playing already started working on it, and playing a very big role there, and the government agenda on the reforms. If we look at there, the agenda is to make all the products available digitally from end to end, with the help of any SL. All the documents are digitally printed and stamped, and end-to-end loan can be dispersed digitally. This is what is the government agenda under EASE 4 and going forward EASE 5 also. So I think this revolution, if we do not want to miss public sector banks, and they have like Bank of Baroda, I think all of us, we have been very active in making all our journeys, starting with the personal loan, of course, which is already been done by us, and all other kind of products also, which will be digitally available for the entire public. I think this is what is the role we are going to play.
Sure, sir. So now shifting gears, in the morning we had a fantastic deep dive into the mind of the regulator, and the governor did talk about the evolving regulatory regime and crystallization of the rules around the fintechs and lending, digital lending in general. So, so first question to you, Lizzie, is how do you see some of the headwinds? And fintechs have been recently in news, and they've been in crosshairs with the regulator now. How do you see that shaping up? And then, ma'am, to you, just tailing into that, what would be your key asks from the regulator per se, or what would be the support dispensations that you would require to enable a far greater penetration of the financial services in the rural part of the country? So, Lizzie.
Yeah, and actually the questions I think are quite linked. First of all, this idea that there are regulatory headwinds at the moment is very much a media storm in a teacup. I think any serious fintech practitioners right now are looking at the way the RBI is behaving and consulting with an enormous amount of admiration and respect. I've operated in many jurisdictions around the world, and I can absolutely honestly say the RBI is one of the most progressive, intelligent, thoughtful, engaged, and informed financial regulators in the world. So we're very fortunate to have a regulator that is taking such a proactive stance to understand the industry. The fact we even have a fintech department within the RBI is truly unique. Very few countries have such a thing. And how open and engaged they are to the industry is very remarkable. I've made multiple presentations to RBI in recent months, both as an entrepreneur, but also as the president of the Digital Lending Association, which is an industry body we created. And every single presentation we've made or conversation we've had has surprised us with the depth of understanding of how the industry works. What I believe is happening, and we're very pleased to see this, is the rules of the game are being set before the game is being played too long, which is absolutely essential when designing a healthy fintech regime. What happened, unfortunately, in many Western markets was this sort of run fast and break things model of venture capitalism, which led to unsustainable and non-inclusive business models that were frankly designed for venture capitalists and not for the end consumer. What the RBI has done is witnessed that, debacle and said, before we grow too big, let's set a guideline regime that allows for sustainability, i.e. no boom and bust from global tech or global VC, sustainability, inclusion, i.e. how do we design products that truly enhance the lives of your customers and this country, the majority of the population of the country, and at the same time reduce systemic risk. If you take those three objectives in mind, right, inclusion, sustainability, and lack of systemic risk, any practitioner in the industry would want guidelines that create that operating environment. So I think it's very, very progressive and proactive. But I would say one plea, if I can have my wish list to the RBI, is move a bit faster, because ambiguity creates more opportunity for rule breaking and bad behavior. And we'd actually prefer to see even more clarity as soon as possible to create level playing field.
I think the governor said the rules are coming next week. Good. So it doesn't get faster than that. Yeah, your wish has been preempted. So, ma'am, over to you.
Thanks. So, when we talk about the penetration in the rural areas, or when Mr. Khurana, you mentioned about this whole direct benefit transfer digitally, I would like to share another thing from after COVID. What happened? When there was a lockdown, there was totally, everybody was inside home, but there were people who, all of us knows what was the situation, and there were people who were doing their business daily, and then how do you make sure that they are going to earn tomorrow? And how is it possible? I would just like to share the way, as Mr. Khurana, you explained about the digital journey of direct benefit transfer. Let me explain you that what happened with the customers of Mandeshi Bank. Women said that we want to buy a material and we want to sell it. Maybe it is vegetables, maybe it is like they have a buffaloes and cow and milk, and also we want to continue our business, because otherwise nobody is going to go to bed, otherwise we'll go with the empty stomach. So what we did was that, why don't we design a digital platform where from the KYC to application form to credit rating tool, I'm just emphasizing credit rating tool, not high mark rating, because they may not have that high mark rating very good. Credit rating tool, then sanctioning the loan, disbursement of amount, and then buying your raw material or buying whatever you want as a treating as a working capital. And I am so proud to share with you that we generally feel that will this population be able to handle it, address it, will they be, and we talk so much about financial literacy for them, right? You know, in that whole process, for whom we had to do financial literacy? From the supply side, not on the demand side. They were aspired, they wanted to follow everything, but on supply side, fintech provider, supply side, we had to say like, you know, this is possible, they will be using, the transaction has to be small ticket size, everything, be prepared with that, prepare a credit rating tool digitally, see that. And so I see that penetration, why it is challenging? Because supply side has to understand the cash flow, understand the processes, particularly, not only product innovation, but the process is very important. How do you go to their doorstep where they are very fragmented. So I think that is more a challenge. So when I say about financial literacy also, I would say financial literacy for suppliers to understand my client and their cash flow, design the product in such a way that you don't just get SMS, but get a voice SMS, so that she feels confident that yes, I have heard that my amount has been transferred. And this is happening. I'm not talking something very new. But I would also like to add another thing. When we move with such thing, and when in country like India, you have millions of people who know graphics more than numbers, right? I mean, I don't want to use words like, but they are more used to graphics. So you have to design that way. But at the same time, there can be a over borrowing. There can be like other risk also. What do you do in that? And here I feel that, and I would give you just another example, which I learned from that lady so much. We got a woman, Lakshmi. She said that my husband has run away because of over borrowing. I cannot run away. I have my children. They are going to school. He has run away, but I have come to the bank that I won't be able to pay the loan as I have committed, but help me. Our managers got nervous. They said, no, you have to repay. Why, how can we, like you have to, what is your house, how many assets you have? I felt that, I told our managers, you are so lucky that the client is coming to you and telling you that my husband has overborrowed, has ran away, and I want to repay the loan, but help me. So I do say that when we talk of financial literacy, we talk about addressing this challenge. When we penetrate in rural areas, we are going to get such cases also. And my question is, are we prepared for that? And I would say that yes, we are, because when you have such clients, then you have, why can't we have a counseling centers for such, when you penetrate in those areas, for those borrowers, for those savers, and how it is possible. And there is no need of brick and mortar for those counseling, right? We, as Mr. Khurana, you mentioned about the video banking, all these things. Our population and people have smartphone. I just would like to also say that in the beginning of COVID, when we did the mapping, we had only 10% women owning, were having a smartphone. But today, that has gone to 60%. It's not, I don't say that everybody is having smartphone in India, I don't want to, but they aspire for that and they want their own smartphone. So I would just say that we are in a situation where we will have to learn from the people from whom we have taught continuously, but with the solutions which we come forward will be solving the problem of last mile. And with that, I would very humbly say that when this lady who defaulted and she came and then she got the counseling and now she has taken a loan of 500,000 rupees and had bought the machinery, and she's doing business, and her husband has returned back. What I'm trying to say is that never give poor solutions to poor people. They are smart, they know the solutions. It's matter of listening to them and provide the solution. Thank you.
Right. Yeah, that calls for an applause. I can't top that one. So, very mindful of the time, we'll just do one quick round where, I would request you to keep your answers very brief. I don't want Madan pulling me out of the chair now. We'll start with you, ma'am. It's often feared that digital, and we talk so much about digital and technology, are we losing sight of certain populations in the country? Could this rapid march onwards be exclusionary for certain sections of the society? Ma'am.
Yeah. You're asking. Not at all, number one. I mean, I say that UPI is UPI is playing the role which I would say that otherwise would not have happened. But while doing that, I do think that some voices which, when I was coming here, I called our Mandeshi Bank's digital counselor. She's not even 10th standard. She has not been able to complete. Rupali Shinde. She goes and speaks at BRICS Bank. I asked her that, what am I going to speak here? What are the voices which are coming from the field? You know what her answer was, and very brief I'll tell. She said that, many times when you do the transaction, and transaction is failed, right? Your money, some error is there and you couldn't complete the transaction. Many times it takes 7 days to get your money back. Now she said that our women do not have additional money and they cannot wait for 7 days. And she made Mandeshi that it should come within 24 hours. And we are doing that. And we are doing it because we have to understand that we are going towards a population who is not sitting on surpluses, but still wants to do everything.
Right. Thank you, ma'am. So that's very useful, actually. To you, fintechs, opportunities or threat for the banks? I see Lizzie giving a little smile there.
Yes, I will answer in two ways. Actually, fintechs are, I will say, the way the kind of technology they are bringing and the innovation they are bringing, it is almost impossible to stay away from them. We need the way banking is going so fast, and we have to reach to unbanked people, and even our own 16 crore customer if we have to reach, and going beyond that, and give them the customer experience, the kind of experience where what they are expecting, looking at the market, when they look at the when they compare them banking with the kind of Instamart or that kind of apps. So I think we cannot stay away from fintechs. Fintechs are with us, and in almost every process we have we have collaborated, and this collaboration is still going to be much stronger. And in addition to improving the customer service, going to the unbanked or underbanked mass population, their technology is really going to help. On the other side, when you said it's whether it's and of course we have certain challenges also while handling with them. The kind of since morning the talk is about the regulatory compliance, and then some other threats of security, data security risk might be there. The challenge what actually fintech, when the fintech companies, when they they get the good number of data, and and then they started working as a competitor Many of the fintech companies have now become big tech or big banks. I think we have to, both the side issues are there. They are going to be our competitor also. There are challenges while handling them, but these are the companies where we cannot remain away from them, and on every field we need fintech companies. This is what I would like to say.
Sure. So fintechs are here to stay. We need to have a balanced approach, right? Pranav, open banking. We see now a universal move towards account aggregators and the account aggregation system. Of course, this is something that has been done in the EU. Is it the way for the legacy banks? Is it a threat, or can it be an opportunity?
No, I think it's a massive opportunity. I mean, if I look at Bank of Baroda or any of the other public sector banks, you are sitting on a massive, balance sheet. You have massive surpluses available. If you look at credit deposit ratios of any of the public sector banks, there's so much give, nearly a 10% point uplift that is available, right? So if you leverage open banking today on the corporate side for, or let's say, or leveraging even fintechs, so much opportunity. And there are multiple plays, right? Open banking is great for you to get all the opportunities of embedded finance. Open banking is great for you for leveraging fintechs. So there's just so many ways you can use open banking. And not just on leveraging your balance sheet, but let's say even for creating a bunch of value-added services for your corporate customers. So let's say anything on cash forecasting, treasury management tools and all. It's a massive opportunity, I would think.
Sure, that's very reassuring actually. Lizzie, final word to you. Could there be a UPI moment for fintechs in India? And if there is one, being a lead innovator, I would say, what could it be?
Yes, it's happening. UPI was just the trailer. I think UPI is such a brilliant example of empowering the consumer to make choices that work for them. And I think everybody was surprised by how quickly the consumer voted with their feet and said, I will use this product. I remember when UPI first happened and everyone said it'll be a South Bombay phenomenon and it'll never be in the vegetable market. And I can tell you it's in the vegetable market, how quickly that adoption has happened. What will be the UPI moment for the remainder of financial services, to me, is actually linked to the previous question. It's empowering the consumer, not just with choice, but with their own data. And we're on that path right now. India is unique in the world by designing a data system and data philosophy in financial services, which is about the consumer owning their data, not the bank, not the fintech, not the tech company. Consumers will consent to what they do with their data to choose to opt in to sharing that data to create the service product solutions that they want. It's day zero today, but the potential for that entire schema, not just in financial penetration, but empowerment of consumers to design their own solutions, as we've been talking about today, is truly exciting and revolutionary. So the next 10 years are going to be way bigger and faster than the last 10 years, I can guarantee.
Sure. In fact, I remember, back in 2016, 17, when UPI was just getting off the ground, there was so much talk of UPI, and we were looking at the numbers, and then when I deep dive into the numbers, it surprisingly was tier 2, tier 3, tier 4 that actually got onto UPI before metros got on it.
Correct.
And I think yes, you were right there.
Yeah.
So do we have time for a question? Yeah. Okay. So maybe one question we'll take. Okay.
If there are no questions from the audience, if you can tolerate my question, I can just ask 2 quick questions.
For sure. We can bear with that.
Okay. So even though I'm an employee of Bank of Baroda, an employee of a bank, I'm asking as a layman. Okay. That today when we say that loans can be given in less than 1 hour, what kind of due diligence actually happens? Is it a banker's headache if I have to give a loan at less than 1 hour's time? The second issue which I had was that even today as a layman, when I'm putting in a transaction of 20,000, 30,000, I say, okay, done. But I see my transaction hasn't gone through, which happens even today. I get terribly nervous until I get to know that my account will be recredited. So these are the operational issues. So do you think that technology is running just too fast, and as consumers, as customers, we are not really keeping pace with it because we have all these kind of tensions? Any view from that?
I'm happy to take the decisioning due diligence question. I think we have to question any limiting beliefs we have as bankers, and I, as a former banker, I've questioned many limiting beliefs that I had. I truly also believe that how can we possibly trust AI to make credit decisions better than human beings? But we have seen consistently in our business over the last 7 years that over time models can learn faster and more accurately lend the human touch. And the best test of that was actually the COVID period, where we saw the performance of our models, the speed at which they could adjust to new inputs of data, literally pin code by pin code, minute by minute, was far faster and far more accurate than a human judgment system. So whilst we have humans designing the systems, the decision-making authority now is actually better, more accurate, and more inclusive if we remove human judgment, in my opinion.
Sure. So you'd like to take the second question? Madan gets nervous if he doesn't see instant settlement.
Yes. No, you are right. You are very much right. I think Madam also was talking about that why it takes 7 days to to credit back the money which is. See, even the Reserve Bank of India has also come up with the solution, which all the banks at NPCI level they are collaborating and working on it. That majority of the failed transactions which will be done automatically, which will be reversed automatically. This is what one kind of that is going on. I think soon that will be ready, and that will be taken care of. Your, I think I will say 90%, more than 90% customer will be very much satisfied that those days will be are going to be over. Then when it takes time, but when actually there is there's a dispute. The actual whether this money came out or not because it is got stuck somewhere in ATM machine, which presently they are not that much advanced. I will say that where you can even sitting at some centralized place, someone can find out whether where the actual cash got held up. So this kind of issues might still remain, or where some kind of disputes are there, whether I withdrew or somebody else withdrew. But majority of the failed transactions, I'm very sure these are going to be taken place, in time.
As the CDO of the bank, I'm yearning to jump in on this question. So let me just take a shot. We settle almost, between 8 to 10,000 crore rupees a day in digital transactions. And I can tell you, Madan, even if there is 10 rupee, 15 rupee that does not, the number of escalations we get is just tremendous. So in our own good interest, we settle everything as promptly as possible.
That's very reassuring. Achha, thanks a lot for this very engaging session. And now I would request our Executive Director, Mr. Khurana, to give a token of our appreciation to the panelists. First to Ms. Chetna Sinha. Ms. Lizzie Chapman. Pranav Arora. Now we'll have it as a family affair. Khurana ji, please give it to Akhil, and Akhil will give to Khurana ji.
Okay.
I think this has been a very exciting session at this hour of the day, so I think credit goes to everyone out here on the panel. Many thanks to everyone. We'll be going over to the next session, which is not the last one. We have a last one coming later. So now we're going to talk on ESG finance. Can we just get table ready? Can you also change the bottles on the stage? Get fresh set of bottles placed here. Okay, right now we are having this particular panel discussion on ESG finance and tackling climate change. I think all of us are aware of the problems which are there on account of climate change. Any of us planning a holiday to Europe is definitely going to take a different view right now. Everything is because of climate change. That's what it's been attributed to. So right now, may I please invite Mr. Joydeep Dutta to come up, our Executive Director. Mr. Anirban Ghosh. Ms. Hetal Dalal. Mr. Mukund Rajan, or Dr. Mukund Rajan. Welcome. And Ms. Priya Subbaraman from NSC. It's a pleasure to have all of you. Dr. Rajan, if you could just set the tone about what we're going to discuss, and then we can start the Q&A session. No, not required. We've shown it on the screen. Sorry. Thanks.
Lovely. Thank you so much, Madan. I know we are a little bit stretched on time, so we'll try and keep this as succinct and precise as possible. There is clearly growing momentum that we're all seeing on the ESG agenda, that is environment, social, and governance. The COVID pandemic has really helped to create a greater focus on many of the key aspects of the ESG agenda, particularly the ability of businesses to navigate risk and their ability to show resilience in the face of these kinds of black swan events. And now, of course, climate change is looming large as the next major driver of economic transformation and ESG focus. And that's driving frenetic activity around the world in terms of adoption of net zero targets. A major force for change is coming from the investor community. Already funds that control over $120 trillion of assets around the world have subscribed to the United Nations Principles for Responsible Investment, or the UNPRI, and several hundred firms from across the global financial sector representing more than $130 trillion of assets under management and advice now form part of what is called GFANZ, or the Glasgow Financial Alliance for Net Zero, committed to raising net zero ambitions across the globe. There are also regulatory interventions that are forcing the pace of change, and we're going to talk more about that in the panel. We're seeing a number of other stakeholders, including members of civil society, think tanks, customers, and the judiciary, who are also becoming very vocal in India on the challenges that face society from an ESG perspective. And some of the best companies in India, the best regarded companies, are in fact now beginning to strengthen governance relating to ESG at the very top, at the level of the board. So companies like Infosys and Airtel have created ESG committees of the board. Others like Tata Steel have in fact merged the mandate of the CSR committee of the board with ESG. So to help us unpack what is really happening in the ESG landscape and to interpret the impact all this is having on the banking sector, we have, of course, very distinguished panelists who are going to be able to cover the whole cross-section of issues ranging from regulation to compliance, investor interests, corporate outlook, and so on. So I'm going to start with Priya. And I'm going to request Priya, based on her experience with the National Stock Exchange, to really describe the current ESG landscape in India and some of the key drivers of change, including regulation, that you are seeing in this landscape. Priya.
Hi, so there are a couple of things that we are seeing. So we all know that as the regulator, for the past 10 odd years, we've been having this business responsibility report. But what has changed in the past 2-3 years? So we did one report about 1 year ago when we looked at 50 companies of which are part of listed NSE World. This year we're looking at 100. That report is not yet released. But the way we looked at it is like this, that, so we looked at four, obviously the E, the S and the G, but we also looked at policy. Because my experience of all of these years, as well as, India is a very prescriptive country. You have regulation for just about everything, which tells you what to do, how to do, and when to file the report. So we said, let us see how people are doing on, our top companies are doing on E, S and G, but also let's see what is happening on the policy side. So unsurprisingly, our experience has been that the policy side, almost everybody has a policy. You'd find very few companies that don't have a policy on their website or in their written document or whatever. The next is the G, where there are, so from a governance perspective, when we looked at various kinds of reports and etc. that are filed, we find that the gap between the companies that's at the bottom and the company that's at the top, the gap is relatively low. So, at least from I spoke about BRR, at least from a tick-box perspective, just the G also is happening. Now we come to the E and the S. The companies that are at the top, from an environment perspective and as a social perspective, and the companies that are at the bottom, there's a significant gap. So that's one of our findings. But one finding which frankly I think should encourage all of us is the fact that when you are at the top, you're top in everything. So what we did not necessarily find that E and S is great, but you know what, governance is poor. I don't think that can happen. But so it wasn't as if the social factor was ignored. So when you were at the top, you were at the top. And I will just take 30 seconds to actually go to some of the benchmarks, that indices that NSE has. So we have 3 indices. One which, 2 of them were started way back in 2011, and one index which we introduced with a base year of 2014, but which we introduced in 2020. So there's some interesting observations from that as well. So the ones that we introduced in 2011, so obviously we've got more than a 10-year history. We have found in comparison to both Nifty 50 as well as Nifty 100, we have at least 1% difference in yield or returns. Between, so the data is out there, whoever wants it, I will send it, but at least 1% difference between the returns. So, the reason why it's interesting, obviously, it's little different from, say, for example, the 3-year return, 5-year return, 7-year return, but the 7-year return is actually possibly one of the better ones. So it's not as if it's a new phenomenon, suddenly people put money in it and the return is taken off. That's not the case. So that's one thing which I certainly wanted to make. The other thing which I wanted to talk about is, I mentioned one particular index which we introduced in 2020. So what that index does is actually look at the company in various, already which are in various sectors, look at the leaders in that sector, and then see whether or not, how their performance has been vis-a-vis the ESG metrics. So therefore, if a particular company is really a very, is known for its performance, is sitting in the index, has a particular composition in the index, basis obviously its share price, impact, cost, all the rest of it. In ESG also they're doing well. So it seems to me that good behavior, perhaps, there are 2 things. When I say doing well, they're doing well from a returns perspective, return to shareholder perspective. So I think good behavior is being recognized and rewarded by the market in a little different way. I mean, that's part of what I would like to bring here. The second aspect you asked is what are the drivers of change? You've already mentioned the investors. You've already mentioned other stakeholders. There are 2 other levers of change again. One is the government. SEBI is one of the first globally to actually come up with BRSR. And what they've really said is, so essentially what they have not done is to say you go through GRI or IR or anything like that. What they've really said is you use whatever metric you like, you just make sure that you talk about it in making that assessment. And we think that this step of SEBI will actually bring in a lot of consistency and will bring in a lot of uniformity in the reporting. So that I think is one of the key things which should benefit corporate India. from that perspective. They're doing a couple of other things as well. In 2021, SEBI came up with a paper, discussion paper, where they said that if people are going to be using, for example, SASB or any other sustainability metric, you must state what is that metric, how are you using it. Again, that is also a transparency measure, as I see it from the regulator. So the more transparency you bring into the system, the better it's going to be. There's going to be more trust and obviously, better it's going to be for the market per se. So those are the regulators' part. The third plank, so to speak, is really the next generation. I mean, that's what I see. The next generation thinks about its own, ecosystem in a very different way than, what I would have thought. So I think the next generation is equally, is pushing forward the agenda. Ma'am mentioned about, so next generation, rural India, there are a lot of other drivers, which perhaps we did not realize the intensity and the contribution of these drivers. That is really, I think, pushing things forward. So that's all I have.
Terrific. Now, very comprehensive, and I think it's very reassuring to hear that there is a correlation that's already being seen between good ESG performance and market returns, and I think there'll be a lot of interest in the data you have on the 1% yield difference that you're already seeing. Anirban, I'm going to turn to you now. What are forward-looking companies like the Mahindras doing about embracing an ESG agenda? And particularly on the question of climate change, how did you all go about crafting your target date for net zero? I think a lot of bankers would be very curious how this process works and how do you actually define that date. Over to you, Anirban.
Thank you for the question, Mukund. You know, we've been working on sustainability for about 15 years now. And if you look around, you'll find many organizations who will say that they've been working for a similar period of time. So I would say forward-looking organizations have already got started. But this is not a game which is a competitive game. It is, we'll all win together or nobody will win, because you cannot have a sustainable business in an unsustainable world. So forward-looking companies, if they have to do anything now, it is to get more people involved in the game so that we make progress. Your second part of the question is very interesting, that on how we set a date. Actually, initially the whole idea of being net zero was felt to be quite incredible. And I was even once told that just because you're in sustainability now, you think anything can happen. But with the experience we had in implementing decarbonization projects, we saw that if we were to be able to take it to the logical end and make sure that we are not making a contribution anymore to putting carbon up in the air, we do need to get to being net zero. And we did a little bit of math and a little bit of projections and looked at the possible path that renewable energy was likely to take in the country, and felt that on scope 1 and scope 2, we could get there by 2040 or so. You know, we'd already signed on to a program to double energy productivity. So that gave us a base to project on as to where would energy productivity take us. And then as renewable energy came in, how much more would we be able to cut decarbonization. We already had a very robust million tree a year program. So we said if there are any residual emissions, we should be able to offset it by that. Scope 3, however, is a different animal altogether, especially for an automobile company. That we are still trying to sort out. But using energy efficiency, using renewable energy, and using the possible offsets through the Haryali program, we see that we can get to net zero by 2040 on scope 1 and scope 2.
Terrific. And for the audience, for those who are not aware, the India net zero target is 2070. So this is 30 years ahead of the Indian target. Hetal, I'm going to turn to you now. We talked about, Priya and I, the role of investors in driving the ESG agenda. Now, a big part of what people expect from investors is engagement with businesses they support. And following from that are the stewardship commitments that institutional investors in particular are in a are able to sort of discharge responsibilities around. In India, of course, you have stewardship regulations. There's a code that each of the regulators for mutual funds, insurance companies, and pension funds have defined for the institutional investors in those sectors. So how are you actually seeing the execution of these stewardship mandates, and how quickly is that likely to be able to transform the ESG landscape in India?
Fair enough. So if you look at how stewardship responsibilities have come even into Asia, right, I think it's split equally between some being more investor focused and voluntary, some being more driven by regulation. In India, the regulation has actually kicked in to say that asset managers have stewardship responsibilities, therefore need to engage with companies on some of these issues. But the trajectory of the asset classes is different, right? Mutual funds started voting on shareholder resolutions far before the other insurance companies and pension funds. So they're a little bit ahead in terms of just simply voting on shareholder resolutions, looking at governance, looking at what some of these things mean. The insurance and pension funds have actually come in later. What happened for insurance companies is that while, IRDA came out with a stewardship code directly, which meant that not only did they have to vote on shareholder resolutions, they had to engage with companies. So it's had a different stages. These asset managers had different stages of experience. When you look at how the engagement today is, I think asset managers understand governance very well. They've seen governance failures, they've seen shareholder wealth creation because of governance, wealth destruction, because of governance failures. And therefore that is still an element that has a reasonable amount of focus. On ENS, I think asset managers are still circling around how to address some of these issues and what are therefore tangible long-term risks because of this, right? You marry that with how the funds are really reacting. Now, when you're looking at ESG, for example, right, if you leave aside simply governance, you're saying these are long-term risks which are going to play out. But the asset management industry is largely active right now, and therefore they have a 3 to 5 year horizon. So trying to marry a 3 to 5 year horizon with a long-term risk is what a lot of the asset managers are circling around. The other piece is passive investment. Now, there's a philosophical difference in how passive investors look at ESG risks globally vis-a-vis in India. So when you look at, and if you look at Larry Fink's letter a couple of years ago, he said that if you're a passive fund and you're basically going to track the index, it is far more your responsibility to engage with companies because you can't really exit the equity so quickly, right? So therefore, it's your responsibility to engage with the companies and address some of these ESG risks. In India, passive funds are looked at more in terms of being passive. And therefore, the entire engagement level and the entire sort of even voting has tended to be a lot more on the lower side, actually. Passive again, but notwithstanding. So I think the asset management industry has understood governance well. On ENS, they're still trying to figure it out, but I think there is a little bit more attention to the way some of these issues are getting handled, right? And therefore, there is focus on this. The constraint, therefore, comes in the consistency of data. So even if I'm an asset manager or if I'm a fund manager tracking, let's say, auto, or let's say I'm tracking IT, right? The lack of consistency in data makes it difficult for me to therefore assess in a very tangible manner. It's not as easy as, financial performance where you have, your metrics. And therefore, there is a certain element of relative ranking which is going on in terms of being able to make choices and being able to build that into the investment decision. So to me, this is really where the industry is. Will it evolve? Yes, I think the industry will evolve and find its footing. There are several aspects which are coming in, as Priya talked about, that there is also an effort to standardize the data, to create better comparability. And therefore, we find that over a period of time, to me, I think the asset management industry will also evolve to make this, to be able to build this in a much more tangible manner in their investment decision making.
Do you see a possibility of the kind of activism that you're seeing in developed markets around climate issues, for instance, changing boards of directors, placing nominees on the board and so on, coming to India as well in a hurry?
So I think we're seeing activism on the governance side because that's what really people understand well. I think over a period of time, it's not too far to think that this is actually going to happen. The big difference when you see activism in global markets vis-a-vis Indian markets is really the structure of the market, right? Today, India still has a largely family-controlled equity structure. If you look at the data across, let's say the 500 companies, you're still seeing about 50-55% equity being held by promoters. You have roughly about 30% held by institutional investors, and you have the remaining held by retail market. And yes, there is a transition to retail investors moving more towards through mutual funds entering the market. So therefore, you are seeing a slightly increased institutional investor ownership. The other thing you are seeing is that companies are growing, raising capital, therefore promoters are getting diluted. So once that dynamic changes, it becomes far more difficult for companies to ignore the investor view. Having said that, when you look at the startups which are getting listed now, right, a lot of them are held by private equity. The founders are not considered promoters, and they're diluted, right? Most of the founders own less than 10%. When the private equity is going to exit, which again is post-listing tends to be a 3 to 5 year horizon, the degree of activism you're going to see in some of these entities is certainly going to increase. And looking at activism on climate is not too far away.
Thank you. Joydeep, how are banks, including Bank of Baroda, perceiving this whole landscape that's now changing so quickly, and climate risk in particular, and how are they beginning to prepare for these challenges?
I think in the morning, Arundhati ma'am also asked a similar question sort of to the governor in terms of when can Indian banking system also see a sort of a timeline of commitment to say net zero, etc., like it has happened in the case of say large banks globally. So that again, that's a question mark. But at the same time, I think the situation is not as it was maybe a few years back where it was just a fashionable term. Right now, banks have moved into green lending, etc. But again, I think it's time to go beyond the good intentions. It's time to also look at what results you get from the ESG agenda. And also have a calibrated approach or a orchestrated approach to going about this entire ESG agenda. Right now, it's being done in bits and pieces. Some things are happening across banks, but again, as I said, it's not really orchestrated. So that is something that is there, and what needs to be done in terms of the future, I think there are, of course, a lot of issues that need to be tackled in terms of challenges, in terms of preparation, which you asked also, but I'll maybe cover that in a later part, but let me talk about a little bit on the landscape of ESG in terms of the banking, from a banking perspective. So what's the opportunity landscape, so to say? The India Energy Report that was published by the Ministry of Power, they brought out a funding requirement for climate change transition in India to the tune of almost $1 trillion by 2030. And out of which, of course, renewable energy is the biggest piece. And in renewable energy space, I think the funding requirement up to 2030 is approximately in the range of INR terms, 35 to 40 lakh crores. And that is the landscape of opportunity. Of course, there will be a lot of different types of funding that will be done, not just the bank funding, but then it's a substantial opportunity space. And again, it has to be done in a sort of a methodical manner, calibrated manner. So that is on the corporate lending piece, the wholesale banking, where the wholesale banking comes in. Apart from that, I think there's also a retail and MSME green lending space, which also is again very, very substantial. So that again, the potential of that space is again in the next 5 years, it's approximately to the tune of around 7 to 8 lakh crores of funding requirements that is there again in this retail and MSME lending space. This is the space where you have the electric vehicle transport sector, we have the energy efficiency, consumer durables, we have the green buildings, we have the water and waste management. So all these come under this space. So 7 to 8 lakh crores. And again, in this 7 to 8 lakh crores, which in the next 5 years, I think what is in the next 12 months is only on the electric vehicle segment. I think the disbursements required are to the extent of almost 30,000 crores. Just 12 months more, in the next 12 months. And apart from that, this MSME value chain will again require another disbursement of around 20,000 crores more. So just in another next 1 year's time, the figures that are required is almost to the tune of almost 50,000 crore rupees. Just in this small retail and MSME space. I'm not talking of the renewable energy and the corporate lending side. So that is the opportunity space. So that is where I think a lot can be done if we go about it in a proper, methodical and a calibrated manner. Banks, most of the corporate lenders in India, most of the corporate banks in India have been into a lot of environment risky segments, so to say, maybe in the power sector or oil and gas, metals, chemicals. So again, these are sectors which are emission heavy. Probably we will have to banks will have to look at probably gradually withdrawing from this. Of course, it cannot be immediate because there is a growth aspect to it. So it has to be a calibrated withdrawal from these sectors and at the same time increasing your footprint as far as the renewable part is concerned. So that is where I think the direction of travel is, and it is being orchestrated. But at the same time, I think there are a few things in terms of preparation that banks will have to do. You talked about how well we are prepared. We are still probably just preparing ourselves. We haven't yet, I think, reached a stage where we can say that yes, we are fully there. It's in the works still. So I think as far as the preparation part is concerned, one is of course the electric vehicle side. We have to come to a sort of a product proposition. Even on the electric vehicle side, there are different types of product propositions that can, or value propositions that will be required for different types of customer categories. For example, there could be a retail customer who is taking a EV scooter, for example, the Ola scooters variety. And there, the solution that probably we will be requiring to give is a digital model, a digital distribution model with the OEM. At the back end, of course, the solution is from the bank side, but then it flows in seamlessly, and then that is where you actually are able to do, this is a small ticket loan. And it's a small ticket loan. If you have to do that at scale, you will require a digital solution. And that digital solution will actually enable you to do it properly, because then you can put the scoring, the scorecard, the guardrails, etc., and then you know which customer to finance and whatnot. So that is where that model can get applied. But that for a different customer category, you will have probably a different type of model. It could be a partnership model with an aggregator. For a corporate, it could be a different type of integration, salary integration for their employees. So different type of models will have to work out, and that exactly is the challenge or the preparation that banks will have to do. Apart from that, of course, the underwriting, scoring model, etc., those are hygiene. The collection piece, again, I think because if it's a granular loan, we will have to have a proper collection mechanism, put that again in place before we actually go at scale. And of course, on the electric vehicle side, I think the battery risk, etc., those are still evolving. There are some clarity still required. The market is also, I think, we are still not really sure on the battery risk side, how the battery risk management will be organized actually. So all these things are work in progress, but I think these are things in terms of preparation that we need to take care and put in place, and that should enable us to have a little more orchestrated strategy, and that will take us ahead.
Excellent. Thank you very much. I think Joydeep also just gave a new idea for fintech companies on the EV side. trying to enable a lot of digital lending for the retail market. And of course, EVs come with a whole bunch of attributes, geolocation, issues around range anxiety, which can be handled online and so on. So I'm sure there are some youngsters now taking notes of this session. But an important point you made, Joydeep, and I'm coming to you next, Priya, is there's a calibrated approach. This is a journey, right? It's not going to be that on day one you're somewhere, and day two you've already got to where you want to be. It's going to be constant progress, often incremental baby steps. So on the ESG space, is there actually a value in being an early mover? Or is it possible that the market and running an exchange, this can potentially punish you if you're a little too early in the game? And also I'm curious, the NSE actually came out with a unique framework, NSE Prime. For members of the audience, NSE Prime is really a framework that prescribes higher standards of corporate governance for listed companies compared to what the regulations require, with additional disclosure requirements. So I'm curious how that whole experiment, if one might describe it as that, has worked out, and how you're seeing companies really adapt to that kind of proposition.
See, at least insofar as the environment is concerned, I don't think there is a question of a first mover or anything. I think Madan said that we would not do a holiday in Europe today. 3 years ago, it would have been the aspirational space to be when you wanted to go on a holiday. So I was just looking at a cartoon, I think day before yesterday, and Simpsons. And Bart Simpson was complaining about the heat. And Homer Simpson tells him, this is the coolest summer for the rest of your life. So I think we know where we are in terms of environment. We are probably much later off the block than we should have been. But I take your point in terms of calibrated approach, because sometimes the pendulum can actually swing and go on to the other side. Joydeep spoke about EV batteries. We're really not sure, but even to make EV vehicles, there's a lot of minerals that need to be so therefore, if the solution, it may not be the most fashionable solution, but the solution could very well be that increase efficiency by 2x, which is what Anirban was talking about. Sometimes we tend to be less calibrated, and therefore my view is that the market will certainly punish the less calibrated, not so much because markets know, and I sort of believe in the power of markets, and I'm really hoping out of the 1 trillion, $500 billion will be raised in the markets and listed space. So that's my anyway. That's my DNA in terms of market. So, coming back to NSE Prime, we launched Prime. We have not started taking the applications in, because there's a lot of work that needs to be done by companies before they can actually come into Prime. But for us, what has been exceedingly encouraging is that many companies, and not just the top 20 companies, but many companies, including MSMEs, much smaller ones. MSMEs, I mean, the ones that are on our SME segment cannot be a prime company at this stage. But the much smaller companies in the main board are actually coming back to us and asking, how can we be in NSE Prime? What can we do? Because NSE Prime is an objective assessment of corporate governance. Therefore, there is that much faith, saying that if I become an NSE Prime company, if I can use the logo, if I can use some of the exposure around NSE Prime, then I will get the necessary visibility with good quality investors. I mean, at the end of the day, that's what it is. The necessary visibility with good quality investors, and that, to my mind, is more a concentric circle of success, because good investors will get better investors, and so on and so forth. So I think we've the questions that we are getting, and the incisive kind of questions that we are getting, is very encouraging. It's not that we are getting very peripheral. Will you give us will there be grandfathering questions? We are getting exceedingly incisive questions. how will this work? How will this particular clause, this subsection work? So that's giving us a lot of comfort that once all the necessary processes are over, because there is the directorship changes that need to happen, more directors need to be taken, where directors are already directors in many more companies, that term has to get over and so on and so forth. So we are very encouraged with the kind of questions that we are getting at the moment.
That's very encouraging to know. Anirban, we heard from Joydeep again earlier about the opportunities on the ESG landscape. And I'm curious, for companies, how do you see ESG becoming a strategic advantage? How do you sort of look for opportunities in innovation, in R&D, and really for making an impact on the market ahead of competition? How do you see that whole space working out?
Actually, as I was listening to Joydeep, it was quite clear that Bank of Baroda, if not banks in general, have identified the opportunity space for banks in ESG. And I was delighted to hear you talk about the opportunities in the MSME space, because this seems to be just the right time to move into the MSME space. Not just because many OEMs have been training MSMEs, their suppliers, on what to do in sustainability and ESG, and a lot of experiments have already happened. Small pilot projects have already happened. So I personally think that this is the right time to scale up. And since the projects that the MSMEs will implement will be similar to what OEs have already done in their premises, and every project has great return on investment, there is no risk to the capital and there is no risk to the money that can be lent to the MSMEs. So this is a good time to go there. Joydeep, I heard you talking about sectors which you may want to withdraw from. But there's another conversation starting now. The transition is going to be quite long. And the sectors which are high emitting sectors will have to look for ways of working which have lower emissions. That will require money. And that is a huge amount of money that will require to go into transition technologies and perhaps even get to a state where that technology is working in those industries in a net zero manner. And a third area where I don't think the opportunity is quantified yet is the whole area of circularity, which is just about getting going. Yes, it will get covered partly by existing industries, but there will be many more industries that will come up to deal with this whole issue of circularity. So if we add all this up, I guess the economy is going to grow a little bit more robustly than we are even imagining at this point in time. Actually, you know, sometimes ESG is referred to as being non-financial, and sustainability reporting is referred to as being non-financial reporting. I think once you get started, you will very easily realize that there's nothing non-financial about ESG. That there is a way in which it impacts the performance of the business in a positive manner, which is probably why Priya finds that 1% yield difference in companies which are practicing ESG, which also end up turning out to be companies which are governed well. And if we take note of this and we recognize what it is that adds value to the business by doing ESG practice, then again the question that Hetal raised about figuring out what matters in the ESG space for investors is something that will become a whole lot easier. So just to summarize, great time to get into MSMEs. Many of them are ready to invest to make the change, and a lot of homework has been done already.
Thank you, Anirban. In fact, the point you made about non-financial, in fact, now there's enough data to suggest that intangibles account for the majority of corporate value, in some instances as much as 90% of corporate value. And a lot of that is around things like brand equity, reputation, and so on. And ESG is all to do with what sort of helps you to demonstrate that. So Joydeep, we just heard about innovation in the corporate sector. I'm going to ask you about innovation in financing, and in particular your suggestions on how we can actually see more capital coming into sustainable finance in India.
So on the innovation side, I think the innovation will be in the delivery models, in the product proposition, some of the product propositions that I talked about, the technology part, the digitalization of processes, the underwriting, scoring patterns, etc. So I think those, the innovation will happen there. The capital part, of course, has to be organized through various sources. The capital will, there are a lot of funds, etc., which are getting activated. I think the FM also in the last budget had announced a fund, a thematic fund, which will go into sustainable development. So that is again good development. We have some other funds like the India Equity Growth Fund, which is again one of the largest funds, which is again active in this sustainable development space. The bank lending is there, the green bonds are there, the ECB space is there. ECBs have been liberalized for green projects to actually access overseas funds. So all these sources are there. I think the government also and the RBI also has priority sector definitions to allow small renewable energy and social infra to get classified as priority sector. So again, these priority sector will also, because of the classification of priority sector, this priority sector lending itself will be a source of fund or capital for projects, ESG projects, etc. So I think there are a lot of sources. It will all come in together as we grow this space.
Great, thank you. And Hetal, with all this financing coming in, is it going to be a worry that we're going to see a lot of greenwashing? And is that already beginning to happen? We saw a few weeks back these raids taking place in Germany, for instance, around this issue of greenwashing. And for the audience, really, greenwashing is misleading information communicated by businesses to present themselves as being environmentally responsible and ESG friendly. So is it yet an issue in India? Do you see it becoming an issue or a problem?
Look, I think you can't deny that there is greenwashing. I think the question is degrees. If I look at the level of greenwashing that we see today, right, to a large degree, I think it's the eagerness of companies to be able to display the fact that they are ESG friendly. A simple example would be, we are an equal opportunity employer, yet women form 3% of the workforce, right? So we do see this. There are pockets where you see some of this actually happening. I think the pressure on companies right now, vis-a-vis what you see at a global level, is different for India. I think globally the pressure is significantly greater in terms of being ESG friendly. And therefore the need to showcase what they're doing and the competitiveness of that in that particular industry. In India, I think you are seeing a new customer segment, which will, let's say, buy more sustainable cotton, or, you know, which is in the retail segment going to be demanding products which are more environmentally friendly. But a very strong push which impacts the competitiveness or impacts the financial performance of the company isn't really getting seen yet. I think once that pressure increases, yes, greenwashing itself will become a major issue. But at this stage, I think from Indian companies' perspective, it's not as much as you would see globally. With the money coming in, maybe. But right now, I wouldn't say it's a priority. It's something that we should all be alarmed about. I think companies, at the stage that we are in India, I think companies are far more focused on first gearing up to become ESG friendly rather than really looking at greenwashing so much.
Correct, well said. I'm going to get into a final round of quick questions and request all the panelists to keep the responses as crisp as possible, and then we'll turn it to the audience and then wrap up. So Priya, quick question on, amongst the various specific issues that business and banks are facing, perhaps the biggest challenge, which is not necessarily very visible, is cyber security. And as head of regulation and regulatory affairs at NSE, you must be seeing a ton of these threats pretty much every day. These impact issues of privacy, customer experience, business confidence, and even national security. how much attention do you think is being paid both by the banking sector and businesses in general in India to this issue?
I think the banking sector and any sector that's regulated by, so therefore by bank, by RBI or SEBI or IRDA, etc., are actually far more conscious about cyber security. There are regulations, there's very clearly duty owed to their constituents as well. Therefore, the level of, as I said, consciousness is much higher. But from a corporate perspective, corporate India, I think the boards are curious, but they aren't really, so they're asking a lot of questions, they want training, etc. But I don't necessarily see the same intensity with which you see regulated entities. In fact, to me, it seems a bit like, if I were to look at to me, I don't think the risk has been completely well understood. It is just one of those things. There's a lot of focus on hardware, software, but less so in cyber. It's almost, there's this joke there that you order mineral water with ice. You've defeated the purpose of the mineral water. So there's a lot of focus on hardware, software, technology, ye chahiye, wo chahiye. But this insidious piece of, that a small malware can actually throw your business out of gear for many, many days. And perhaps the thing is also, the effects are much longer term than that. Could potentially be longer term than that. That, I think, is just, is dawning upon corporate India, but in a more theoretical way. I think there's a very long way to go.
Strong note of caution there. Anil, but quick response from you. You already touched upon this, the scope for innovation and the way the needs of the MSME sector are managed. One, could you elaborate on that, and maybe one clever idea for Joydeep to work with the Mahindra Group on supporting the financing needs in sustainability of MSMEs?
The clever idea is a bit of pressure, but let me just stay with the innovation bit. Actually, when you start on this journey, it is often difficult to imagine that you can get to a place where you will work in a decarbonized way. And figuring out ways to reduce emissions, reduce energy consumption, reduce your costs, in every context leads to a lot of innovation. The big ones are obvious to see, but here's something I saw when I went to one of our factories. So we have there are plenty of machines there which, if it were to stop working, it is very difficult to find out from a distance. So all they had done was, there was an exhaust fan, and they put a little paper fan on top of it, which from a distance you could see whether the machine was working properly or not, if the fan was slowing down or what was happening. Now what this did was it enabled them to ensure that any issues that came up in the plant or in the manufacturing line were dealt with very, very quickly. So very small innovation, but something that helps in managing the whole process. Similar little gadgets were used to see whether something was overheating or not. And this helped to manage energy consumption very, very well. So every step you take in energy efficiency and in circularity, because let's take another example, say you have paint sludge coming out of the paint booth of an automotive plant. Now typically you would follow CPCB guidelines and send it to wherever it had to be sent to. But then we ask the question, if we don't want to send anything to landfill, what do we do with this? So we've figured out that you can get turpentine oil out of it. You can dry it and make it into powder, so then transportation is easy. And then finally we find that you can send it to a cement plant for co-processing. So these are just two examples. There are plenty more, and within the Mahindra Group, what we're trying to get to a situation where we send nothing to landfill. So we've got to do something with the materials that today, that earlier were called waste, and today we look at it as byproducts. Now any of them gives an idea to Joydeep that okay, we should help businesses do more and more of this and therefore create value. Just by managing these wastes better, over the last 3 years we've been consistently adding 2 to 3 crores to the bottom line. And I don't think we've even got started. So huge amount of opportunity for innovation, not just in our factories, but also at supplier factories, because they pretty much do the same things as we do, but on a different scale.
Terrific, thank you. Hetal, some months back, SEBI came out with a consultation paper on ESG rating providers and whether they should be regulated. So quick question to you on the role that ESG ratings could play in India going forward, really helping investors to make better calls on businesses that they want to support. And do you see any challenges in that whole space?
I think investors are looking at a more domestic understanding of ESG factors. AMFI, for example, has empaneled a set of players, including IIS, in terms of being able to provide ESG ratings. I think and I suspect the way these investors are going to use it is really to look at, in terms of relative ranking. There's going to be differences in methodology which makes it difficult for comparability. And also how you look at some of these things, right? If you argue that, for example, just look at what's happening in global markets, right? Tesla got removed from the S&P 500 ESG index and ExxonMobil came in. So it's how you interpret some of these issues and how they become relevant to the market is really one of the challenges, and therefore the consistency of the methodology. The other piece is just the quality of data, and I think that remains a challenge even now. The BRSR has come in. It's a very comprehensive document, I must say, but the question is really, are smaller MSMEs, which are actually come under the umbrella of coverage, are they really equipped to handle some of this? I find larger companies also attempting to do a BRSR this year, saying that we'll try it out, but we don't have the entire data in place. So I think getting the data quality and the data consistency will be a challenge for all ESG rating providers. But that doesn't mean that it shouldn't be done, right? It has to start, and therefore just ensuring that, it's simple, right? What gets measured gets done. So if you just look at that as a philosophical bent, you are saying that you do have ESG ratings providers who are therefore going to ask for material information, look at a comparability, and give you at least, if nothing else, a relative ranking, if not an absolute number. And therefore it allows funds also to benchmark how they progressed. You have a lot of ESG funds, right? But therefore, in their stewardship responsibility or in their investment decisions, have they managed to improve an overall portfolio score? And I think some of these elements will be helpful. So by and large, as a development, I think it's good. Is it mature? I don't think so. But over a period of time, it will. And I think that's really where it will become more valuable.
And for members of the audience, if you're interested, there's a slightly different take, I think, in the latest Economist article, which has a cover story on ESG ratings. So I'll leave that to all of you to see separately. But I think Hetal made some very good points there. Joydeep, my last question for the panel to you. I think Anirban had a very good suggestion, and I'm curious how you would sort of respond to that suggestion. And the deeper question under that is, what kinds of skill sets do you think banks will increasingly need to develop in order to play a bigger role in the movement of sustainable finance?
No, on the skill side, I think it's a new developing area. So I think as we move ahead, training cannot be undermined, or skills development or upgradation of skills, etc., in understanding the entire ESG space. Say, for example, even the certification or some sort of standards which are followed. So again, the ESG ratings concept, the people who are handling the proposals in the banks, they must understand all of these ratings certifications, how they are done, because these are used to evaluate projects, right? So, and if the people are not really conversant with them or how they are done, then of course there will be some sort of a gap. So that is one. Second, I think the entire risk assessment when we do a credit evaluation is I think now has to be strengthened to capture the environment risk, the climate risk aspects. Of course, we have already started doing that, but I think there's a lot more that we need to do. The banks do an internal rating of any proposal that comes when we do a credit evaluation, and then apart from the external rating. So the internal rating captures environment risk and climate risk for the particular client for whom the proposal is being assessed. So that is something which is integral, and that has to get strengthened. That sort of upgradation in risk process, the risk practices, etc. Because if you get into, say, the renewable energy financing, it's again project financing. So project financing has its own technical skill sets. So you need to get into the entire project financing skill sets upgradation, which again banks had sort of not been doing for some time. In one morning session, I think it was also discussed that we were earlier doing infrastructure financing, we left it, now again getting into that in some way. So that is again an area where we will have to develop in terms of skill sets and upgrade our skills. I think one geography we also saw some good skill-related information which came out, which is Singapore. In Singapore, there's an Institute of Banking and Finance, and also the regulator there, the Monetary Authority of Singapore. They have actually brought out a list of some 12 to 14 technical skills and competencies, which they have now made it mandatory for any person who is in the role of, say, handling anything related to sustainable financing, etc. So he has to have those skills, or he has to be certified in those skills. So that's a good sort of a guidance for other geographies, because of course they are much more advanced in terms of their practices, etc. So I think it's a good learning that we can take from them. So these are some areas that I think in terms of skill upgradation or skill requirements, I think we need to go ahead with.
Terrific. Thank you very much. I think we are pretty much out of time, but could we could take questions from the audience. If anyone has a question, could you please raise your hand? Yes, please. Yasir, just the mic is coming.
Hi, my name is Pitalwala. The question is for you, Mr. Roy. With respect to green financing, we see a lot of players who are attaining scale in India, for instance, in the renewables energy space. Look at overseas markets when it comes to raising green bonds. How far do you see the Indian banking system being competitive in being able to make available funds for green financing, particularly on the debt side, in a competitive manner?
So I think, as I was mentioning also earlier, so the green financing part, of course, banks are doing. So it's not that banks are not doing. Of course, not in as big a way as probably would be expected, but I think the journey has started. So I think we will be looking at banks getting into the renewable energy space, add also the green financing part in a lot more significant manner going forward in the days ahead, rather as compared to what was being done so far. So that's something that will be that will grow in momentum and traction going ahead.
One of the things we'll of course need is also the emergence of a green taxonomy for India, and the Ministry of Finance is actually working on that. I think that will also incentivize a lot more green or sustainability linked issuances in the Indian market. Any other questions?
Mukund, if you indulge me, I have one more question, but for Anirban.
Sure. And then we have one person, and we'll stop with that. Yeah, go ahead.
Mr. Ghosh, you talked about getting a good ROI on ESG projects as well. If you could take us through the perspective of how did you go from a cost center to a revenue center or something that can stand on its own feet in front of the CFO, when you look at ESG projects, that would perhaps help a lot of corporates really in that journey.
Wow, if we did manage to do that, then I'd probably have a different designation. But what we do is to enable the business functions, implement projects which give good returns so that they don't have difficulty getting those projects funded. Typically, energy efficiency projects would have a payback period of somewhere between 2 to 3 years, plenty of them less than 2 years. And you can see that this translates to return on investment greater than 24% in most cases. There are lots of such opportunities available in almost any factory. And it's not difficult to understand that, because when we set up these factories, we were more interested in making sure that energy was available. And there was also the equipment that used the energy which had a certain amount of efficiency. Over the last 5 or 10 years, wonderful new machinery has evolved, and we are able to then replace the old ones with the new ones and get great returns on the investment that we make. So yes, it is indeed investments that are, like you said, which could have made my department a profit center. We did tot up the numbers once. They looked rather good, and the revenue expenditure for the department was very small compared to the value we'd added, which is probably why you're seeing many, many more chief sustainability officers in the industry now.
Okay, last question. There was somebody who stood up. Yeah.
Thank you. Our distinguished speakers just rightly said that having a forward-looking ESG agenda on board is not a competitive game. It means it's not important that how many companies having forward-looking agenda on ESG. It's important that how many companies not yet started thinking about ESG. So we need a collective action. And for collective action, we need a common baseline on ESG standard. As we know that ESG policies and standards are evolving very quickly across the globe that lack common baseline among the universally agreed guidelines, that is GRI, ISB, and TCFD, and of course BRSR. So I just have a question related from Mr. Mukund, that when we are going to have one common baseline universally agreed guidelines so that we can have a collective action to meet the biggest threat of the country or across the globe, that is climate risk. Second question, sorry.
Let's keep it at one, because I think we are pretty much out of time, and we'll take the other one offline.
Yeah.
But just on the frameworks, I think the BRSR, as you rightly mentioned, is now mandatory for the top 1,000 listed companies from this year onwards. That will provide the baseline. There is going to be work that the International Sustainability Standards Board is doing, and they will come out with hopefully what becomes a universal framework, and work on that has already started. So that would be the other parallel that could be compared with the BRSR. So those will be the two that in the short term I think we should look forward to. You've been very patient. Thank you so much, Madan. And thank you to my fantastic panelists. Very, very rich experience that was talking today. Thank you so much.
Yeah, thanks a lot to everyone. And, actually I was very strongly tempted to ask a question, but I'll be delaying my own session which comes afterwards. It was something to do with the ratings and annual reports, which are cheat sheets on what all you do on ESG. That's what annual reports are. So I wanted your comments basically from Hetal and Priya, maybe some other time. Anyway, thanks a lot for everybody for staying on for this particular session. And now, as a token of our appreciation, I would request Mr. Joydeep Datta to hand over a memento to Mr. Ghosh first. Hetal. Now to Priya. Now to Dr. Rajan. Now we'll have a slight reversal of roles, Dr. Rajan, to present to Joydeep. Okay, thanks a lot everyone for coming, and thanks a lot for this excellent panel discussion. Okay, we have the last panel discussion coming about. We're calling it a round table. We'll require 2-3 minutes to change over. Please don't get up. Please be in your seats, because we also require an audience when the economists talk. So please don't get up. Okay, we need to add something on the stage. Friends, could you all please settle down? Everybody standing, please sit. So we can formally begin. Okay, we have the last session, which is called the Economists Roundtable. So, in fact, one of my friends out here, Firoza, asked me why are you calling it a round table when we're not going to sit in a round table. The answer is very simple. When you have several economists sitting together, we always go round in circles. So I thought it's not a bad way of defining an economist's roundtable. So to bring some kind of sense and some kind of sanity in this particular discussion, we thought let's get somebody from the markets. So I think our executive director, Mr. Devdutt Chand, may I invite you to first come up on the stage so that you may be overwhelmed by all of us economists blabbering away, but professional has it probably, Mr. Chand. And now I'd like to invite all my friends. I'm not going to introduce them. I think everybody knows everyone, and they're all close friends of mine. Lata, DK Joshi, Samiran, Saugata, please come up on stage. We have made you wait for a long time, probably to gather your thoughts about how to keep puzzling everyone with your comments and views. And now I'll hand it over to Lata to take over. Lata, it's all yours. I'm also joining it.
Hello? Okay. Ladies and gentlemen, I know it's trying your patience having extended the session to start about an hour and a half late, but it's an esteemed panel and I'm sure they'll be able to make it worth your while waiting for this panel. What we are basically trying to do in this panel is to look at the state of the economy over the next 5 years and look at what can be the funding requirements and how we can best muster those funding requirements. As bankers, you all will have more to contribute, and the economists, more in terms of where they see the economy going and what are the funding requirements. That's the theme that has been given and has evolved by our collective thinking. I thought let me introduce some urgency into the discussion by starting with Mr. Chand, asking him whether you're seeing credit growth already. We have this Friday number from the Reserve Bank, and today it says 14% credit growth year on year. That's a damn good number compared to a year ago number of 6%. So does it feel, or is it all low base and inflation which is leading to high capital requirement? Your thoughts, Mr. Chand. Has CapEx picked up?
Yeah, let me clarify first that I'm not an economist, but I'm an applied economist. A similar scenario happened with me in 2012, where again, with a group of economists, I was there and somebody was asking me what you are doing in this particular thing. So I said that I'm not economist, but because being in the market for long, so I'm an applied economist. So coming to your question on the demand side of it, we have seen good traction of late with regard to demand picking up in the economy. So whether we talk about the corporate loan book, whether we talk about the retail in terms of the kind of demand coming. So this possibly is the first quarter in the entire last couple of years where the growth of advances is far more than the growth of deposit. So a scenario you can, although the deposit base is much larger, but the moment you talk about something a growth like 10-12% on the advances side, it's a very important in terms of reversing the scenario that happened in a couple of quarters back.
No, what I wanted to find out is whether you can feel it in the number of proposals that come. Is there an urgency in their ask for money, and which sectors? Who's asking for money? Is it all retail? Is industry coming?
It is industry, typically retail is also outcome in terms of the industrial demand, because there would be people getting enough money. But on the industrial side also, we have seen a good run in terms of cement, steel in a couple of quarters back. And the demand typically is very strong either of these two segments. But then when we talked about capacity utilization, normally we see a higher investment demand coming moment the capacity is more than around 78 or 80% kind of thing. So we have seen those kind of capacity, a lot of company achieving and then talking about capex now. You'll not saying that the entire demand has come back at this point of time, but significantly we are seeing good traction therein. And that typically being seen in terms of the liquidity which has gone down in the system as compared to the earlier quarters. So in that way, I am very positive with regard to the traction that we have on the industry, industrial demand.
Liquidity is going away also because the Reserve Bank is selling dollars.
Yeah.
They have sold, like Samiran was pointing out over coffee, they have sold 8 billion in the week ago period, and before that it was 6.6 billion. So substantial amount of liquidity has been withdrawn because of that. But let me toss the question then to DK, Mr. Joshi. You may have studied it, several sectors. Do you see what Mr. Chand is referring to as capacity utilization reaching a point of triggering capex?
Well, I think it is happening, but it's not across the board. If you look at sectors which are linked to infrastructure, for instance, because government is pumping money into infrastructure, building roads, 76% of the NIP is towards the road sector, roads and bridges. Now, sectors linked to that are your construction activities, steel, cement. So these are hitting the levels of capacity utilization where you will see investment happening, and it's already happening.
The Q1 numbers are also showing commercial vehicles as having done very well. If you
Yeah,
can.
but I think we don't see capacity expansion there because that's an industrial sector, and the utilization of capacity in the overall automobile sector is around 60%, not enough to trigger new investments. And so I think it varies from sector to sector. Where government is investing, I think the related sectors are doing well. Now, I think coming to the other side of it, it is by the size. So even within cement or even within steel, the larger companies are the ones who are investing because they have much higher capacity utilization than the smaller ones. The smaller ones are not in a position to invest. So it's a very skewed kind of investment activity that is taking place. So it's not uniform, first of all. I think that's the case. And then I think there is another layer of investments where I think there is a general move towards greening. I think so investments related to that, they are happening at a moderate pace, I would say.
Solar and wind energy,
Yeah,
perhaps.
so overall, I would say that I think if we are able to maintain investment to GDP ratio of last year, which was around 32%, I think that should be a good outcome for this year, where government's own ability to invest has reduced, and the money I think they are pumping in infrastructure is not creating the same amount of infrastructure because every component, every input has become more expensive.
So you would say that this 14% actually is also because of high inflation?
Yeah, partly because of inflation. I think that would be a good outcome, I would say, in this difficult year.
Okay. Well, before I come to Samiran, let me ask Saugato, since you're also the economist for a bank. Saugato, are you getting the sense that this 14 can become 18 or even 16? Is there enough traction?
Thanks, Lata. And before I start, thanks to Bank of Baroda for giving me this opportunity of being here. Wonderful privilege. So I agree that there is now a significant amount of new capex across multiple sectors. Other than the infra-related, there are the other mid-segments, chemicals, specialty chemicals, consumer electronics, etc. So even there. Problem is, for the medium segments, what Mr. Joshi was talking about, the bigger guys have enough cash reserves on their own, because remember the amount of deleveraging that has happened, the amount of cash, internal accruals that they are sitting on, they are probably not going to come into banks for a large part of it is only the middle segment which will come in for bank credit. So there are other factors which are driving bank credit other than the true capex demand. As Mr. Joshi said, as Mr. Chand said, a lot of this is because of the high commodities prices, a significant increase in working capital.
Are you seeing the acceleration, is my question.
So, I wouldn't be very surprised, because remember, for every one of the last 4 or 5 fortnights, bank credit growth has been going up.
Yes.
So 10%, 11%,
Rising at a rising
12%,
pace.
absolutely. So I wouldn't be terribly surprised, and particularly now that the market-related rates are going up, so there's an increasing diversion, not just that, from the external side, all the ECB refinancing because of the higher cost of funds from outside and the higher the amount of refinancing that is needed because of the dollar depreciation. So because of that, I think multiple sources are now in play. So true capex, working capital, diversion from market funding, etc. So I wouldn't be very surprised if for a few fortnights at least, you begin to edge up from 14%, 15%, 16%. But overall, I think you will revert slowly back to this 12% odd growth rate.
Oh, okay. That's coming back to a different theme altogether. We were jogging in the same place, and now we have to start jogging forward because this is banking for the future. So now the first futuristic question to you, Samiran. The whole preparation for credit growth is that the banking sector needs to prepare for what kind of growth? Now, the golden era of credit growth was the period from 2002 to 2008, when we saw 25 to 30% credit growth in some years. And at that time, the nominal GDP was 15%, almost routinely. What is your sense about the next 5 years? Are we likely to get something like a 6% real GDP and 12% nominal? If that is the case, then what kind of credit growth? Should we expect credit growth to be 18, 20%?
So first of all, let me thank the organizers for having me here. It's actually an honor and a privilege. And Lata has reserved the difficult question for me, asking others about what has already happened and asking me about what is going to happen 5 years down the line. So let me start off by saying that none of us have the crystal ball to think so far out. But let me put it this way, that at a very broad level, I think that we were doing about 7% GDP growth pre-COVID. Post-COVID, if I build in little bit of long-term scarring from COVID and little bit of the fact that the global economy is likely to be a headwind rather than a tailwind, then if India gets a potential GDP of about 6 to 6.5, I think that's a pretty good number to have without creating too many imbalances. On a real GDP of 6, 6.5, if you take an inflation number of somewhere between 4 to 5%, you will end up with something around 11, 12% of nominal GDP. Now, the period that you were referring to, as analysts, we had a rule of thumb that credit growth is equal to 1.5 times nominal GDP growth. Now the rule of thumb has become credit growth equal to nominal GDP growth. Or let me put it this way, that if even that is true, everyone will be happy. So I think about that 12% credit growth should be a good estimate to start with. And then comes all the questions around both the composition of that credit as well as the fact that who else is going to compete in that credit space. Is that going to be a disintermediation in non-bank? Is there going to be more retail versus more corporate? Those can make this growth rate number go 1 or 2 percentage point higher or 1 or 2 percentage point lower than what we are thinking around that 12% number. But I don't see a 20% plus credit growth that we had seen in that era ever coming back on a sustained basis.
Thanks for that. That lays the ground on futuristic thinking, albeit with the caveats and the assumptions that we have to make. The potential output, is it what it was before COVID? Unlikely. Even before COVID, there was a kind of a secular slowdown. With the gift of hindsight, we can now say it looks secular slowdown. Some people have called it the lost decade. Your thoughts on a similar question, Madan? Would you agree that with these assumptions that we should not look at 7 to 8, but more like 6 to 6.5 growth and that kind of an inflation and credit growth assumption?
So actually I have a slightly different view, because I think that the Indian economy has the potential to grow by around 7 to 8%. Maybe leave out this particular year and let's assume that we have normalities subsequently. We don't have any more wars or any kind of these problems. So with 7 to 8% growth in real GDP, and I think inflation is always going to be around 6%. If I think to assume it's 4%, I think that's an error. So we're actually talking in terms of something like 13 to 14% growth in nominal GDP. Now, I think the earlier we had this ratio which we could easily drop, saying if nominal GDP growth is X%, it'll be 1.5, 1.2, 1.3 times. But today we see the entire dynamics is changing. We have seen that we have a new financial institution which is going to come about. We also see the corporate bond market where a lot of emphasis has been put. It hasn't quite worked out so far, but I assume it's going to work out at some point of time. So there's going to be a bit of disintermediation. I think the external commercial borrowings route is going to become also an active source of funding for companies. So in this kind of a scenario, I think dependence on banks for long-term finance may actually get moderated. So it's going to be more a case of saying agriculture, retail, maybe certain extent services. But if you look at core manufacturing, core infrastructure, they may be looking for alternative sources of financing. Currently, I think we're not seeing too much happening out there. And we don't see too much of private investment. We're not quite sure when it will pick up. And I think when we talk of government spending, I think we tend to exaggerate the importance of it, because 7.5 lakh crores out of maybe 70, 75 lakh crores cannot really move the entire thing. But once it starts moving, I think there'll be greater emphasis on the corporate bond market, and the dependence on bank financing may get moderated. So therefore, I think 13, 14%, we may probably be growing at 13, 14, 15%, but not definitely a multiple of that.
Okay. Well, Madan, I must only say this, that when I was a cub reporter, early 90s or mid 90s, I have been hearing that banks will be disintermediated by the bond market since then. It's a panacea, it is a area we are still waiting, a world we are still waiting to arrive, but hopefully
Actually, Lata, sorry to interrupt out here, but in case the bond market is not developed, then I think our all dreams of saying 5 trillion economy is going to be dashed.
Yes.
I don't know if that's a part of the agenda, because if you look at a funding requirement, even at 30% capital formation of an economy which is 400 lakh crores, if you actually say where is this money going to come from, if it's not going to come from the bond market, I don't think we'll be able to finance it. Okay. Then we'll probably have to forget that particular dream.
Yeah, no, I take your point that we need that. What we need and what we get are different things. And by the way, just an anecdotal point, I had interviewed Mr. Kamath when he took his job in ICICI. He had just come from ADB. I was, of course, way more raw. But he, 10 years later, told me, you know, when you asked me how much capital India needs, in the first question he had expressed, coming from ADB, that, you know, so much of capital is lacking. We need infrastructure. He had some big number like 1 lakh crore at that time in the mid-90s. And by the time we came to 2005, 1 lakh crore was really nothing. What he was trying to convey is, once that animal instinct of growth enters, then the money comes. Projects become bankable. And if it is not there, then M1 sits where it is. It doesn't multiply. But anyway, that discussion for another day. I take your point that, you know, hopefully the bond market will disintermediate. But let me, before I come to infrastructure, which was one of the themes I wanted to discuss, I want to ask Mr. Chand about even retail credit. At the moment, that is the mantra of all the banks, and a couple of sessions, very interesting fintech conversations you'll have had. Do you think that the extent to which digitalization has grown, you know, there are, I spoke to a government official who is extremely excited about even the insurance money that is being given based on Aadhaar. You know, some 365 rupees per individual in the bank. If the person dies, it can be claimed 2 lakh rupees. That kind of digital infrastructure is available. If digitalization and artificial intelligence or machine learning is developed to that extent, that we are able to extend credit to the hitherto denied segments, do you think that can be an engine of credit growth and economic growth?
Absolutely. There are two things which I believe the digitization is doing for the credit part. One is that it's converting the need into a actual credit in a very quick time. And in an earlier scenario where there was typically a case where somebody would go to a branch, seek for an credit, then there was a usual process in terms of giving that disbursement. Here is a case wherein in a quick time the need is identified, he onboard into a particular platform, and then the credit is given. So in terms of the velocity, in terms of turning the credit is quite high as far as the digitization process or platform onboarding is concerned. The second aspect, which is very, very important, as you rightly said, that my customer base in terms of the credit need is significantly higher. Earlier, the only customer where we used to target is a walk-in kind of a customer where the customer base has been very low. So here is a case where because of the digitization process, anybody can onboard into this platform. Similarly, the Bob World kind of thing that we have that app is significantly improving this penetration with regard to onboarding new customer. At the same time, giving a faster the credit, converting that the need into some kind of a credit loan requirement. So that significantly increased the market base and also the efficiency of the system from the customer point of view, at the same time the bank's point of view. So the bank's point of view, every time I onboarding somebody on a digital platform, then I am reducing my operating cost. The moment I reduce my operating cost, the ability of me to give a final pricing is much higher. So in that way, it's a win-win for the customer and also for the bank. But again, let us look at digitization for a segment which is slightly low in value. We can't think of digitizing every customer, so we have both the models running in terms of digital onboarding of customer in a platform that is what we call Bob World. At the same time, again through physical branches also, even if we source that lead through a physical, but trying to take the journey something a digital so that we can have a faster, efficient disbursement process as compared to the process earlier.
Okay. Now let me check if the economists are equally cheerful about a consumption cycle being kicked because of digital lending or simply more data being available to hitherto untouched segments. Samiran, if I can start with you. We are all talking about a K-shaped recovery and we did that over coffee as well. Does that impede consumption from becoming an engine for growth? Or do you think that digitization can still push the envelope and we can have a larger segment demanding credit?
It's a tough one because as we know that the India consumption story has been going through phases. So if you look at a 20-year history, and this is the sort of high growth period for India, 60% of growth has been contributed by consumption. So the ups and downs of growth gets contributed by investment and exports, but consumption provides a steady part. But within that, there are two distinct phases of consumption. The first phase is the 2002 to 2014 sort of phase, where this consumption growth was supported by significant job growth and income growth. The next phase of consumption growth has been a period where the consumer has supported his consumption through leveraging, which is by reducing household savings and by increasing household borrowing. Now the question is that going forward for the next decade, which of these two models of consumption are we going to see? Are we going to see a reversal back to the first model? For that to happen, we need a significant capex growth first, because that capex growth will create the jobs and incomes which will support that kind of a consumption growth. Or we go for the same leveraged consumption. It's possible, because even today the household savings to GDP is not low. It's still quite high, can be brought down. And household debt to GDP, which has been pushed to about 40% of GDP, we know countries which have lived with much higher levels of household debt to GDP. So it's possible to continue that model. So if you are talking of digitalization, lending, contributing to consumption, then we are willy-nilly saying that this will be more of a leveraged consumption story continuing for another 5-10 years, not so much the story of the other variety. For that to happen, you need this digitalization of credit going to industry and in industrial capex starting, which will start a consumption growth.
Actually, to extend the point, what kind of growth will create jobs? I mean, even industrial credit has created wealth, has created profit. It's not necessarily it's actually jobless growth, which we have been talking about for a goodish bit. Samiran, want to extend the point?
So, I have always been a big votary of this, that in India we have a barbell problem in employment. So on one end of the spectrum, everyone has a huge demand for jobs, of skilled jobs, where there is not enough supply. And then on another end, you have too much of unskilled supply of labor and not enough demand. And to me, in short, the solution is to create more number of construction jobs. The period that I was referring to where we had that job full growth is the period where 52% of non-agricultural jobs were created in construction. In India's capex, about 40% of India's overall capex is connected to the construction sector, either it's infrastructure or real estate. I know that even construction is becoming less labor intensive, but still if we can push all sorts of construction and construction jobs, that's where we will get most people employed in non-agricultural jobs, and that's where we can get a bit more job full growth. Our estimate is that if we can grow real investment around 8% for the next decade, which will take the total investment to be about $14 trillion by 2030. In 2030, in 1 year, we will be doing $2.4 trillion of investment, which is equivalent to just the pre-COVID year of entire year's GDP. So we will be repeating that just as investment in 2030. If we can do this, then given our estimate of employment elasticity, we should be able to create about 45 million jobs over the next 7 years. And that's just about going to cater to the 10 million people who will be entering the workforce every year for the next decade. Why the number is slightly lower? The 10 million would have been 70 million. Why is 45 million good enough? Because not everyone wants a job. In India, the labor force participation is low. So with 45 million jobs, we should be okay. But these are blue sky thinkings. People can debate, discuss, and have different views.
No, I take your point. These are blue skies. As you pointed out, even construction has become largely less labor intensive, and it is only housing construction that is still labor intensive, especially rural housing construction. So, we have to go after job growth as a goal in itself, and it may tie in with the Awas Yojanas, perhaps it already is. But Mr. Joshi, what do you see as the likely scenario, given that savings have already started to drop? So now I'm coming to the other estimation from you. Savings, will that help us? How should we think about savings growth from here on, since it has been on a decline in the past 5 years?
Yeah, I think you're talking of household savings, I presume.
No, I'm even talking about the entire savings to GDP. Even that has not gone to the old 23-24% which we had in the first decade of this century.
True, actually it had gone beyond that also. So I think savings has been a casualty of, I think as Samiran was also pointing out, I think you are more focused on consumption. I think consumption story, earlier I think since independence, consumption as a percentage of GDP was falling. I think it's only in the decade of 2000 you started again seeing a very, very sharp increase in consumption, and then we saw stability in consumption to GDP. And I think if, now I think if I look ahead, what I would see is that I think there is going to be some hit to consumption as well. I mean, and because the K-shaped recovery is eventually going to play out with lower, and it's already, we are seeing consumption getting hit. Now the ability to save, I think for a large part of the population doesn't exist. I mean, so that's also true. So I think the savings will probably remain concentrated in the upper income categories, the majority of the saving
and consumption actually.
Yeah, savings. So I think in this case, if you were to fire growth and if you were to grow fast, I think you need some savings. I think gap between savings and investment is typically met out of foreign savings, which is you might have to run a higher current account deficit if you want higher growth in the economy. So I think maybe 2.5 to 3% CAD would become a norm, I mean, if we are growing faster.
Okay. Yeah, you're giving this advice at a time when current account deficit is not a very happy word. It's what we are regretting, actually. Saugato, your thoughts. Will savings be a hindrance to growth?
Not really. So first, two parts to the answer. One, a little technical, I'm not going to get into that, look it up on the net, guys. The credit multiplier. Credit creates its own deposits. So that, if we can get credit going, that will help savings.
The animal spirits that Mr. Kamath
So
spoke
animal
about.
spirits, in economist lingo, it's the credit multiplier, money multiplier, credit multiplier. So that will probably develop savings in the system. The second issue on the digitization, coming back into the credit and the second issue on digitization, the data and digitization environment, the digital stack, the digital infrastructure that's been built in, I'm very confident, I'm very, very optimistic on a critical segment, credit going not so much for retail consumption, but to the MSME segment. That, I think, somebody told me a long time back that now 85% of rural adults have a CIBIL score. That's huge. So the point is, this digital infrastructure that's been built up is generating massive amounts of data that can be mined, that can be used for using analytics, using advanced techniques, etc., the AI, ML thing that you're talking about, to create credit to this particular segment, the MSME segment. Just imagine...
Which is also labor intensive.
Which is labor intensive, which is the consumption segment, because it is this MSME, the micro and the small, which are the largest consumers. All the kirana stores, etc., the retail stores, it is this part which is the consuming class. Small ticket consumptions. Just imagine that if we can imaginatively use the GST and database. I mean, we have multiple databases in play now. If we can imaginatively use the GST and database, the amount of data that's been, information that's been generated, real-time information, if we can use this, leverage this to try to extend credit to the MSME segment, we are there. We are there in terms of investment, we are there in terms of capacity, we are there in terms of employment, jobs, etc., and savings. So I think this virtuous cycle somehow needs to be accelerated. And this digital story that you're talking about, I think is particularly suited to this micro and the small segment of the MSME segment.
Catalyze investments and credit to that segment. I take your point. But Madan, you know, the bigger problem that you wanted to intervene now?
No, I was generally saying, we just had a question, cross question to Swagat. I think the small segment is hit so hard. I mean, so I don't know how they're going to come back. I mean, that's also a big question mark. I mean, just availability of credit is not going to be enough. I mean, they've lost their competitive edge after.
No, so this is again, I mean, very briefly, this is the same segment of consolidation that you were talking about, the big segment, which is the same thing which has happened to one of the most remarkable things that we have seen after the series of shocks that we have seen over the last 4 or 5 years, series of shocks. The situation of I mean, we are not really seeing any major deterioration in asset quality, in asset stress, even in the MSME segment. So I'm told, and all of you would be much better informed than I am in this, the MSMEs that have come out of this segment are extremely resilient now. So their cash flows have improved, their systems have improved, their automation systems have improved, so everything, they are a much more resilient lot.
Mr. Chand would know, what's your sense? Is there demand from MSMEs? I think we saw IndusInd Bank's results, for their MFI has contracted. That I remember very clearly of all their numbers.
If I compare the earlier quarters, definitely yes. But then have they come to the extent of the pre-COVID level? Answer is no. So, but one of the focal point that you have been talking about all this consumption story is that in the financial market, can we use the labor market indices slightly more? That answer is clearly yes. Because we as a country...
Can we use the, sorry I missed you.
Can we use, in the financial market, can we use the labor market indices? Okay. Which is like in the developed country, they normally use job role, the employment data and all. So that as a country we can do to correlate the financial number growth vis-a-vis what is happening in the underlying market.
You're doubting whether that much is data
I'm not doubting, but then that would give a fair assessment with regard to how we as a country we should grow. I mean, that going
No,
forward.
I take your point, but I think, in terms of data being available on those segments, we are hopefully on the threshold of the ONDC also becoming a reality. If that online network of digital commerce takes off, because we have the NPCIL's UPI is such an outstanding success, one is very hopeful that they will be able to make a similar success of ONDC. But you know, over there, purchasing power is needed. Ultimately, someone has to buy, even if you put the rails on. And that is a big doubt I have. That question to you, Madan. I'm fresh from an interview with Sanjeev Mehta on our channel. And he repeatedly says that urban consumption is not bad, but rural consumption is a genuine problem for Hindustan Unilever. If everyone would know, they should know, because they also sell small sachets of shampoos and other small ticket items to tier 3, tier 4 cities. And his position is unambiguous that rural demand is actually contracting, or has contracted at least in the quarters gone by. His numbers are dependent on premiumization. And that comes back to the K-shaped recovery. That, you know, we are depending that only the upper part of the K is going to keep giving us growth. And the lower part of the K, you know, we are a nation of 1.34 billion, but an economy of 300 million, or so it seems. If that is the case, then can we dream of a faster growth and digitization being of any use at all?
If we're talking of faster growth, I think what's really required, we all agree, is that consumption has to increase. And today when we are saying that consumption of, say, levers or any of the other companies are complaining that rural demand hasn't increased, I think we should remember one thing, that we have been afflicted by inflation. It's been cumulative inflation, probably which is not captured accurately. None of us believe that inflation is 7% today. We're paying higher prices for almost all the daily household goods. And this is something which actually affects the rural folks more than it affects the urban folks. So I think given the fact that we haven't created enough jobs, we have high inflation, and we also have a case of saying that there is considerable inequality in the country, we're always relying on the people in the higher echelons of income to drive overall growth. So whatever we are seeing today is, when we say recovery of services sector, it's okay, all of us who are well-to-do, we are all planning our holidays, we are going to hotels, that kind of thing. But are we actually seeing people at lower income levels consume more? The answer is probably not. And I think that is something which we have heard, not just from levers, but from a number of these FMCG companies relentlessly in the last couple of years. And we had this problem even before COVID, consumption not increasing. So we were always saying that that's the time when this whole concept of jobless growth, I think that was an exaggeration.
No,
but
actually,
it was not
that Arvind Subramanian's paper, which I guess all of you must have seen, Arvind Subramanian and Soumitra Chatterjee of Ashoka University, a very detailed paper on how only the top decile matters to consumption, which is again coming back to my 250 million, 300 million number.
If you see that whenever India's GDP growth used to grow by around 8 to 9%, I'm looking at just the organized sector corporates balance sheets, where we get the headcount number, it used to grow at around 6 to 7%. Today what's happening is we're growing around 2.5%. So that itself says that even the corporate sector, which is organized, where we have authentic data, we have not seen too much of job growth. And we have pandemic, work from home, companies are also economizing on labor force, lots of people have lost their jobs, and they're not in a hurry to hire more people. So I think we have run into this kind of a syndrome that consumption is something which has not driven the economy so far, and it has to drive the economy finally. We have seen how the Chinese model has collapsed. It can't be an investment-led growth. You need consumption finally. We need more jobs. We need more income to be generated.
Yeah, so that has to be something which is to be politically driven. This kind of a growth strategy which creates more jobs and creates more income and consumption at the lower end of the K. With that, let me turn to infrastructure. As Samiran pointed out, I mean, as all of you have been saying, infrastructure can perhaps create that kind of jobs, but that also requires that kind of money. Mr. Chand, to you therefore, what do you see in terms of the hope of a bond market which can fund that kind of infrastructure? As Madan has been pointing out, bank-led growth perhaps will not be able to finance the kind of infrastructure we need. Do you think the NABFID, an idea or two for the NABFID which Mr. Kamath will be leading, to raise money for infrastructure?
Precisely, the requirement of funds by the banking system for infrastructure is going to be huge. And one way the institutions do have the capacity to fund to a very large extent. But suppose you talk about 5 trillion by 25, 26, possibly there would be requirement to fund it through the bond market. And bond market, as you said earlier also, not to the extent currently where you can say it's very broad-based to fund that. There need a lot of changes in the structure, rigidity in the bond market to fund that kind of a requirement. But I believe that going forward, market is picking up. The primary market in the bond market is still very strong, but the secondary market is not there. So unless and until the secondary market is quite strong, possibly more and more primary volume cannot be generated because the market is again restricted to few of the issuers in that case. Again I say going forward to fund the infrastructure bond market is the key. But then current institutions do have the capacity to fund to a very large extent, so it won't impact that way the plan we do have. But then we need to improve the bond market for creating capacity in terms of funding the infrastructure also going forward.
Yeah, that's, Mr. Joshi, let me come to you on that. You know, the big reason why we are not able to make bonds that attractive is because fiscal deficit is high. That makes interest rate very high. That means that your bank FD itself gives you the returns, and therefore it is not the infrastructure bonds do not generate that return to keep the infrastructure viable. They have to give even better returns, inflation plus. You think that we are anywhere near being able to deliver on an market-driven infrastructure growth?
Well, I think it is possible. I mean, it's not that it's not possible, but you will have to depend more on innovations in the bond market. Now, for instance, I think the infrastructure in India, only 10% of that is financed by bond markets, which is extremely low. And I think the pension funds, the insurance funds, I think they have the appetite for long-term investments. And the infrastructure investment is full of risk, so it's the risk perception that doesn't allow you to. So now what I think, what government is moving in the right direction, I think, the operational asset carries much less risk. So you can actually sell those operational assets. I think there are various ways.
You have the InvIT and monetization.
It could be InvIT, it could be infrastructure debt funds for the debt instruments. I think InvITs is more for equity. So I think these instruments will allow you to unlock the capital, and they can offer the kind of return. I think if you look at the InvITs today, they're giving, I won't call it a benchmark for future, but they're giving the inflation plus return right now. I think that much I can say. So I think there is a possibility, but you'll have to clean up. I mean, it can't be, so government creates the infrastructure, takes the risk, and then sells it, sells the operational assets.
That's the takeout.
It used to be called takeout financing. Now we have more fancy names for that. I think that is how it will eventually, and I think there is a huge demand. There is a huge supply of bonds that's going to come if the NIP has to take place. I mean, even if 60% of that has to take place. And CRISIL's assessment was that there's not enough demand for that kind of funds. So you will have to create that demand. I mean, it could be through the opening up the bond market more for the foreigners, or basically bond index. I think that would be a better way. There would be other factors which are required for creating more demand for the bonds, and I think those things, if you do, then it's possible to bridge the gap. Otherwise, the supply will be there, but not enough takers will be there. I think that's the situation we foresee.
The unfortunate position we are now is that even in sovereign market, the foreigners have only bought about 20% of the available, of the cap available to them. Madan, you wanted to add something?
Yeah, just on the bond market, I think we should remember one thing, that the corporate bond market is meant only for high-rated paper. Yes. So if you're not AA, AAA, because the buyers of it are going to be insurance companies and pension funds or provident funds, you can't force them to buy inferior paper. So I think we need to develop a junk bond market, number one. Number two, we also need to make sure that enhancements are given, because infrastructure projects are not going to be AA and AAA. So how do you make sure that this is given? I think CDS was experimented with earlier. I don't think it's taken off. But we need to keep playing with these tools to ensure that a BBB rated bond actually gets the status of an A or a AA rated bond through these enhancements. I think that's the way out we have to work. I think I was in the rating industry earlier, so this is something which I thought I could express.
IIFCL was given that terms of
IIFCL has not really
reference.
quite worked out, if you see. Yeah.
They were told that enhancements was one of their verticals.
No, that's true. I think just to add to that, I think if you look at the infra operational assets, the foreign pension funds are lapping them up. I mean, the Canadian pension, etc. So there is a demand for them. I mean, it's not that, it's just that you have to
Isn't lapping them up a strong word?
You can look at the CPDQ is quite active, I think, in taking operational infrastructure assets.
Name 5.
And then I think the Brookfield is buying
Isn't that marginal? Brookfield is marginal.
Well,
I agree
but I
Canadian
think
funds
that-
have bought. No, and that is really going to be my question to Samiran. Samiran, can we make infrastructure attractive to foreigners? We have for the longest time thought that that is a window available, but they are not even buying sovereign bonds today. I am a little skeptical about how are we going to make it attractive to get foreign capital into Indian infra.
On a lighter note, if infrastructure is not attractive to domestic guys, why would it be attractive to foreigners? First, we have to make it attractive to the domestic guys, right? They understand the projects better than the foreigners. But I think all my colleagues on the dais, and they are experts and they're giving very good suggestions on how to operationalize these things. But let me wear my professorial hat and take a step back. Ultimately, what are we trying to achieve here?
We are trying to get money for infrastructure.
Right. And there, the question is that money does not fall from the heaven. It's the same circularity of money that we are talking of. If the overall savings in the economy is not large enough to fund both government's infrastructure, private manufacturing, private infrastructure, then you can do as much of quote-unquote market development as you want, but still it will feel very tight always. And that will keep your interest rates elevated, that will make projects unviable, and it will not work. There are two ways to break this. One way to break this is what you asked me, which is, can we get foreign money? Yeah, we can. If we can, then it's great. Then it solves the puzzle. And the other way is the tough way. The tough way is improve productivity so much that the returns on these things are so good that it starts encouraging and promoting savings, which starts building this gap. I don't think we will be able to cut back on investment. We can only promote savings, and that can happen from a more productive thing. And I will say those cliched words that we have to do more reforms to get that productivity. Just to give you a sense of numbers, normally you require about 3% productivity growth in an economy for it to run smoothly at around 7% GDP growth. In our experience, even getting half that productivity growth has been difficult. So we have a lot of work to do. If we can get that right, I think then everything else will fall in place. Otherwise, we will keep on tinkering on the margin on this market development and that market development, but it will not feel like we are going on a roaring speed.
I take your point entirely. I think that sums up the future of the next 5 years. It is in our hands if we are able to improve our productivity. Better education, more education, related, sensible, quality education perhaps is one way of improving productivity. It's in our hands if we have to improve productivity. I think with that message, let me throw it open to the audience. I'm restraining, you will get, yes, please.
Can I add one point on the bond market? We are sitting in a huge opportunity vis-a-vis bond market. So having been in 2022, the opportunity is huge. There are two things required for a bond market. One is that to have a strong primary market, we need to have a strong secondary market. And currently the secondary market, the volumes are very low. So Mr. Madan rightly pointed out, somewhere we have to make the market more of the rate call rather than the credit call. And the moment you reduce the credit risk call in terms of the CDS, what you talked about, maybe some institution in terms of bearing the first loss kind of a thing, and that would support the secondary market, and secondary market in turn would support the primary market, and then we'll have a very active bond market.
You know, I was naive enough when the IBC was passed that the junk bond market is the next big thing that we will talk about because the legal system would have improved. I mean, we are twiddling our thumbs now over IBC as well. I hope what you say is right. Yes.
One little point. The junk bond market in India is very vibrant. You produce a 17%, 18% return HNIs will lap it up. It is that middle segment which is the problem. Which is on the
B
primary
segment.
side, so junk bonds are, you will fly
Yeah,
out the
but
window.
yes, I
I mean,
agree.
absolutely. So that's.
Okay, that still gives some hope that things will at least be resolved. No, since we have made all of you all overstay, including the panelists, I'm taking the liberty of cutting short the panelists' time, and we can take questions for another 5 minutes. It's unfair to make people stay beyond 7:15 on a Friday. So, yes, sir, please. You'll have to introduce yourself. The gentleman over there, if he doesn't have a mic, I have. You'll have to please stand up, be brief in your question and direct it to one particular person so it's faster.
Sudeep from Hinduja Group. Question to economist Sugata Bhattacharya. And the question is, our neighbors, Pakistan, Sri Lanka, Nepal, and we hear tanks in China. This is the contextual environment. Where do you see India's economy in this context? Do you see it as a threat?
A little out of syllabus, but are you saying that it is, I didn't get the question.
I'm also not very.
I'm saying this is the environment around India
Yeah.
where the economics of these countries are a problem. So do you think it's going to affect India's economy?
Not really. Our exposure to these countries are relatively small. I mean, it's but the geopolitical context is definitely something which needs to be looked at very carefully.
Anybody else? I would think that, the EM is there as a basket, but I don't think these countries determine foreign investment into EM. So I would hope that that doesn't deter. Any other question? That's an indication that the economists have solved most of the questions that people have in their mind.
Maybe, Lata,
okay,
we have
there's one
managed to
more.
go around in circles, which I said in the beginning. That
No,
everybody
there's
is
a
confused.
question there.
So now is the rising rate cycle, as we can see. So the spreads are also going to rise in the corporate bond market. So how that is going to be a hindrance in terms of raising capital or in terms of financing?
Mr. Chand,
it is open to any of the panelists.
Okay, let me say one thing on the rate cycle. Even if some rate actions are still there in the like in terms of RBI raising but overall market won't go up significantly high because the run has already happened. The only thing would happen in terms of the short-term curve slightly aligning more and reducing the spread between the 10-year and short-term. So in that way, I don't think, and now also going by the commentary that we receive everywhere, it's almost picking out kind of a scenario, and possibly the day market would see that the CPI would go below 6% maybe in October, November and December, there would be a run in the market, in the sense positive side. So not concerned at all with regard to rate hike. Market is well adjusted. We are very resilient and very strong economy. Relatively, we have done very well in terms of be it currency, be it the bond market, or be it any other segment of the market. Equity also, we are at near peak. The correction is hardly 5% as compared to a higher percentage elsewhere. So overall market prosperity is very strong. We don't think any spread adjustment, any disruption anywhere in the system.
Right now, rate hike jacking growth is not a concern.
Yeah.
That's a short point.
Even if a case, just to supplement, even if that repo rate led to a higher BRLR, that is the rate we charge to the retail customer, the inquiries are still very strong, the demands are still very strong. So it's a realignment in the economy, but there is no concern at all anywhere. We are very, very resilient and strong economy.
Well, with that, we will wind up this discussion. The key takeaway is that, there is, well, this is absolutely the last question.
Yeah, this is regarding the bond market development open to any of the...
Gayatri, you should introduce yourself. It will,
okay, I'm
people will be
Gayatri from the Economic Times, and being contemporary of Lata, I would say the disintermediation argument goes back to Chakravarti Committee report since the 80s, and there is still the same.
I was acknowledged then. Okay, go ahead, Gayatri.
No, so my question with regard to bond market development, is there anything regulators can do to lift the bond market even at this stage, given the kind of reforms that have been carried out for the last since the 90s? What more? But the bond market is shallow. The regulations have been incrementally trying to facilitate the
I would put it to the rating agency guys.
No, I can actually put
Madan
actually I can say something that it's quite an absurd suggestion, but I say like we want to develop the CDS market. It doesn't seem to make sense today. Why don't you make it mandatory that every bond issuance should have a CDS? The rate will of course be low, the cost will be low for a AAA rated company. That's how you're able to make sure that even the lower rated bonds could enter the market.
I think there will be a pushback, but anyway.
I would agree. I mean, the CDS is an important cog in the wheel. I think it hasn't taken off. So I think from the regulatory side, the other measures,
like credit enhancement, CDS.
The expected loss ratings, etc. I think these are in the pipeline, and these will I think will take off at some point in time. And I think as far as the other issue is.
What can regulators do?
What can regulators do? I think they have been nudging. I mean, they have asked the corporates to raise certain amount from the bond market. So this kind of nudges will continue. But fundamentally, I think you need from a macro side, you need a stable inflation environment, a credible monetary policy. I think that is important. In the countries which have bankruptcy laws which work, I think the bond markets have developed much faster. I think so the IBC is a good news on that front, and it should be. I think there are a lot of things that need to be taken care of there. I think it's still taking a lot of time to resolve. I think all those issues need to be sorted out. I think that will become, that will also become a support for the bond markets.
Okay, I'm going to break my own rule. I want to ask all the economists over here, what is the kind of inflation rate you all are seeing over the next 5 years? Will 4%, will the MPC's target of 4% be the average of the next 4 years? Or do we have to accept that it is going to be more than that?
Should I go first?
Yes.
So I think it's going to be 6% because I think India was never a nation which had 4% inflation. Okay. So when the MPC came in, if you look back 10 years, I think in 8 out of 10 years we had above 5%. So how the 4% number came up, I'm not quite sure. There must have been models. I think all the economists come up in models to show 4. And it was fortuitous that the moment we had the MPC, we actually ran an inflation of 4.5%. So I think 6%, 5.5%, 6% is the normal inflation in a country like India.
Okay, actually,
we always have a tomato shock which comes in October, November, which pushes up the inflation.
Okay. No, I want a one sentence, if preferably a monosyllabic answer also. Saugata.
No, I think 5 to 6% I think is okay, because I mean if we are aspiring to grow at 2 or 3% higher than developed market growth, we'll have to pay a price. Okay. I mean, so that premium.
Actually, none of you know that Lata is also an economist in this panel, so she will have to answer this question first.
That's wrong. No, the moderator has some privileges, and that is she only asks questions. Okay. I believe the forecasters, the RBI's forecaster gave 5%. So there you are. That was my answer. I normally do polls. I don't participate in the poll. Mr. Joshi.
Yeah, I would say I think around 5% and the reason is the food inflation is going to be a major challenge because of the climate related issues with food. I think so the central bank will have to take cognizance of that and be a little more tolerant of I think so it will float in the upper band, not move towards the lower band.
Okay. The economists have not spoken in circles. There are some concrete takeaways. They do not expect 4%, but 5% as inflation. Chances are that the savings rate, gross savings rate is going to be about 18%. So, the credit growth as well, if it is going to keep to nominal GDP, one-time nominal GDP, we're going to see 12 to 13%. So the bankers have some key takeaways from this panel. But the most important one, if you have to break out of this jinx, we have to improve productivity. And that's a more social call that we have to improve education and productivity. Thank you very much. No more questions over the coffee. Thank you very much, everybody.
Yeah, thanks a lot. And the last part of the formality.
Over to you, Madan, if you have to make a formal thank you.
As a token of our appreciation, I'll request our Executive Director, Chanji, to first give a memento to Lata. Now to DK Joshi. Samiran. Saugata. And now may I request Lata to give the memento to Chanji. Thanks a lot. I have one more formality to do. Vote of thanks. I'm waiting for everybody to sit down. I'll make it short, and it's more a case of acknowledging all those who helped to bring this program. First, I would like to thank my MD, Sanjeev Chadda, a close friend of mine also, for giving me 100% encouragement, no barrier to doing what I wanted to do. So I think we've had this great program, first time for Bank of Baroda, and I would like to thank him, number one. Second, I would like to thank Akhil. He's worked day in and day out. I used to leave home at 7 o'clock. I never stayed beyond 7. But I think Akhil has gone through everything to make sure that things work to clockwise precision, which I think it did, except we couldn't control people talking more than they wanted, than we expected them. So I think that's the second thing. Then my entire team, you all can just stand up, Dipanvita, Sonal, Janvi, and Aditi. And I would also like to acknowledge the work put in by Apurva from a marketing team, Firoza. I'm afraid your teams, I'm not too conversant with all your names, so it's the entire team, and of course all our vertical heads for getting all our clients, important clients for this particular thing, and for the entire audience for staying on till 7 o'clock. And I think there, Lata, I think your magic did work. I think everybody was interested in this particular session, saying Lata is there, then it has to be good, and I think all my close friends out here, I think have contributed to it. So thanks a lot. And of course, I think I don't have to repeat what was said. I think it was reiterated by the governor about what we could be looking at banking in future beyond tomorrow. That's what we called it. And we had very useful insights provided in all the sessions, inclusive banking, digital banking, ESG. And then, of course, we had the NPCI head also telling us about it, global banking coming from from JP Morgan. So I think it's been a very comprehensive conference, a bit tiring for me. I think I must be probably the oldest person in this particular room. And I've managed to still hold on, though I'm sitting right now. I've been standing the whole day. So anyway, thanks a lot to everyone, and good night to everyone.
I just want to say Mr. Chadda's interview of the governor put most journalists to shame. It was better than any interview I've heard. Thank you.